soon. So let me just work that out so that they have that shared with you in the chat or maybe email to you before we commence the session today. All right. All right, so that will be placed in the chat soon. So I think we can resume. Great. So maybe if we can just take today, we're not going to stay for too long. If you can just take like 5 minutes, the next 5 minutes, to put something in the chat box about maybe some special things you learned over the past 2 meetings that we had. Of course, the people joining this call, you all have varying experiences when it comes to financial modeling and all that. Maybe your knowledge and all that may vary across. So maybe you've learned something new. Evans, someone could not hear me. Am I audible to everyone? Am I audible, please? You can put something Yes, I can hear you. Okay, we can hear you, Julia. Yes. So I think this problem with Evans's internet. Okay, thank you very much, guys. All right. So if you can just take some 5 minutes to type in the box what you studied over this period, something new that you studied, or something new that you think you can improve upon, something new you've learned from here that you can use to improve upon your work. If you can type something on it in the chat box for me in the next 5 minutes. So let's start now. And by 9:55 GMT, let's get that done and begin. So I'm waiting to see. Okay. Revenue modeling for banks. That's from Daniel. Okay. Hotels. Who else have something to say? Okay, so Ikea just dropped that in the box, so you can check that out. Okay. Okay. So which is said the hybrid method of building project of projecting revenue. Okay. Okay. And Justice said how to build thorough assumptions, factoring in industry data, among other things. Okay, that's true. And Olayinka said the revenue models for banks and also the way you model for debt was also something new I've learned. Okay, thank you very much for that. Um, okay, some two more. Victor said, I learned how to build robust models, forecast financials, and analyze complex data to drive informed business decisions. Great out there, Victor. And so Bear said um, about the various sources of data for financial modeling purposes. And Tari said how to come up with assumptions for modeling revenue and cost of sales and debt. Revenue, cost of sales, and debt. Great. Great. All right. Okay. And Uche said also the amortization breakdown was a new method and an eye-opener into banking industry projections. Okay. Okay. Great. So I'm happy that you all have learned something nice, something good. So there is feedback. So at the end of the session, I may share a feedback form with you. Maybe during break or break hours or something, I will share a feedback form so you fill the feedback form for me and have it returned. Thank you. Great. So let's get into today. We're talking about MTN. So let me share my screen so we do some work on MTN. Now, so I'm going to be providing the background here. What we want to look at is this. So we know MTN is a listed telecommunication company here in Ghana. It's been listed for just some years back, not too long. And okay, So listed for some years, about a years back, and then about a years, and they've been trading really well on the Ghana Stock Exchange market. At least their shares are quite liquid compared to several other companies listed on the market. So what we want to do is that we are going to pretend as investors. So let's say we work for a PE firm, and the PE firm wants to take a position in MTN. In other words, you want to invest in MTN. So your responsibility or your task here is to forecast the financial statement of MTN for the next 5 years, and then calculate some basic statistics. Or let's make it for the next 10 years, and then calculate some basic statistics. What the PE firm, the investment committee wants to know is that they want to be able to determine what will be the valuation of their investment in 10 years' time if they make an investment today. Now, you are just contributing to the investment process by forecasting and calculating the relevant cash flows that your bosses will be interested in for the purpose of valuation. So the PE firms usually, you see them using EBITDA multiples for determination of the exit valuation of a company or their portfolio companies. So the idea is that you need to be able to come up with an appropriate EBITDA at which they believe they could exit their investment. Now, so we want to start that by first modeling the entire financial statement, forecasting the balance sheet, the P&L, and the cash flow over the next 10 years. And from there, we will be able to calculate some of these statistics that they need. So you're going to follow me, and we're going to be developing our assumptions together. We're going to be thinking through things together. And it's not just going to be my work alone. You'll see a number of things that we've already studied, and you may not see some of them because of the limitation on data. So this is a real life work we do. Now, so if you are ready to start, or if you are ready for us to start, I want you to say hi already. Just write ready in the chat box for us to get into it. Good. Guys are ready. Ready. Great. My screen is visible. You can all see my screen. Now, let's define our worksheets properly. Today that I'm going to be doing this, I need to find a way of pushing this to a place that I can. Some of this is somewhere here. Maybe better for me. Okay. All right, so let me just define my worksheet, but then let me take off the grid lines. So I go to view, and then I take off the grid lines. Then I come here. I want to call this site historical trading or data analysis. Let me just call this data analysis. Data analysis. And so I'm just defining my worksheets accordingly, right? And the first side of the data analysis, let me take off these grid lines as well. I want to look at historical trading. Historical trading. And here, I want to look at some moment so that I don't have this disturbance from my phone. Now, the second side, I want to, so when we look at historical trading, of course, then we can look at modeling of assumptions. So model assumptions and development. So model assumptions and development. And the third side, of course, the model assumption development will have to, just giving some worksheets divided. All right, so the third side, here I want to start talking about operating assumptions. Then here, so with operating assumptions, I'll be able to talk about how I'll analyze the historical costs and also look at historical revenue. And that is what I'm going to be doing with the model or operating assumptions. And when I come to the next item, I would like to discuss working capital. So I can just do it WC, working capital. So with the working capital, from what you studied, we are going to be looking at receivables, we look at payables and all those kind of working capital items. One thing we actually wouldn't have time to discuss is Capex and depreciation. So we are going to look at it here. Capex and depreciation. Yeah. So let me take off the grid lines as well from here. Then from here, you look at funding. So after Capex and depreciation, we look at funding. So with the funding, we going to start looking at matters like debt and equity movements and all that, dividends and all of not. Okay, so once we are done with that side, then we can now summarize our financial statement. And so we can call this one model output. Can call that model output. And with the model output, I want to have my P&L. Then I will have my BS or balance sheet. So BS, balance sheet. And then finally, I have my cash flow statement. But you see, that's not all. I would like to analyze my output, right? So output analysis. We're going to do some simulation work today around this. So today is a very important session. We are going to be implementing all that we studied and other new things that we've not studied, but which I wanted to treat here. Okay. Now, so output analysis, and well, here, let me just say return analysis. Then here, I want to talk about earnings and cash flow analysis and cash flow risk. This seems like a lot, right? A lot of work we are coming to do. Yeah, that's true. We're going to be doing a lot of work today. Maybe let me just duplicate this here, put it here. So that I can call this historical FS. One thing I feel very lazy doing, but which I have to do, is just to get some, to tap some colors here, just to define this. You know, let me just use this color throughout just to define the various worksheet dividers. You know, just for the fun of it, right? To look okay. Okay. So I'm taking my time to build these things. So if there's something you don't understand, please draw my attention. Draw my attention. I really want to get a point home today as much as I can. Okay. I want to take my time. I don't want to rush it at all. All right. Now, so this summarizes the procedure we want to go through in building this financial model. So I think there's some charts there. Let me check what is going on. Where do I get a recorded version? Someone said YouTube. Yeah, if Julius, in fact, you are a great guy. I've missed the 1 and the 2. Watch the one on YouTube recorded. You are a big man. Thank you, Steven. Thank you for the feedback. And also, the CFA Society in Ghana made it possible, and the team that I work with here as well. So today you get to know the team that have really been working with me on this. So you get to see their faces. So just stick to us, and you get to see them. They'll be really wonderful. All right, good. So MTN. So this is a financial statement of MTN we have, and so it starts with we have the statement of profit or loss. for 2020, 2021, 2022, 2023. So 4-year financial statement. And then the good thing is that we will be able to have a 3-step growth period, at least. It's sufficient for us to do a proper analysis. Now, so we see the revenue of MTN here. We see the other income. We see the revenue of MTN. We see other income. Then we see the cost of sales items, right? We are going to reorganize this properly. This is the cost of sales items that we see. We see EBITDA reported. Then they reported depreciation and amortization separately, as we can see here. And we have operating profits after taking out depreciation. You know, EBITDA is before interest, tax, depreciation, and amortization. So after you take your depreciation and amortization for EBITDA, then you have the operating profit. So that's the only difference between EBITDA and operating profit. It's a matter of just those depreciation items. We have the finance income. Then we have the finance cost. Then we have the profit before income and tax. We have the national stabilization, I think, fund levy or something. Then we have the income tax expense, then a profit after tax. Now this for MTN. So you can see profit growing consistently. We're going to be performing all this analysis. The profit has been growing consistently. Then we also come to the non-current or the financial position items, and we have the total assets displayed here. We have the non-current assets displayed here. We have the current assets as well, mobile money floats. You can see that here, separated from the cash and cash equivalent, right? Good. Mobile money flows separated from the cash and cash equivalent. At least those are restricted cash. These items, the mobile money floats, are restricted cash. And then also we have the growth and sustainability levy or something we have here, income taxes, we have financial assets and all that. Great. So we have the equity section as well. So this is actually total assets, right? Let me just clean up this a bit. This is all part of the work, right? When you take financial statement like this, sometimes you may have to do some cleanups. So total assets is what we have here. Total assets is what we have here. And this one is the total for non-current asset. This is the total for current asset. Then we use the total asset, which is a summation of the current and the non-current. We have the equity side here. Then we have the non-current liabilities. And we have the total for that. We have the current liabilities. And also we have the total for that. And then we have total for liabilities itself. Then we have the total for then equity and liabilities. And of course, when you sum up equity and liability, you should have that equal to the total asset because of the accounting equation, which is asset is equal to equity plus liability. All right, so we have the cash flow statement as well. We start with profit after tax, and adjustments are passed against profit after tax, and to get the operating cash flows and all that. So we're going to go through all these things. We'll go through all this, and then I'll be telling you more story as we go through this. So at the end of the day, when we forecast, we must ensure that our financial statement is in balance. And there's nothing we can do about that. We just have to ensure that it is in balance. That's what we need to do. So we have a lot of items here that we'll be working with. Cash generated from operations, then of course there are some adjustment passed. So these are actually real accounts, real financial statement, real life items. Therefore, it's a good way to start it. We have the net cash flows from operating activities. Then these are cash flow from investing activity. It starts with purchase of PPE, proceeds from disposal of PPE, and all that. Then we have the net cash flow from investing activities all presented here. Then we have cash flow from financing activity as well. And here also have its own thing. Then we have the net increase in cash and cash equivalent. Then the cash and cash equivalent at the beginning, the cash and cash equivalent at the end. Wonderful. So we have what we need to work with. just for completeness purpose, let me define moments. Let me just take off that. For completeness purpose, let me just define this side as well as the cash flow from operating activity. So cash flow from operating activities. We've not started anything yet. We're just looking at the data we have. Operating activities. Okay. Great. One thing I also want to have down is to get the financial statements itself available. So in case we need it for anything. So let me just show that, right? MTN. So I need just the 2023 financial report. So MTN Ghana 2023 financial report. Just by side. So if we need to clarify anything on the 2023 financial statement, we can quickly move to look at that. So all right. So just having that also down. Good, 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 good. Now, so let me open the MTN financial statement, the annual report itself, and then have something to show. So on your screen, you can see the annual report of MTN. Now, it's trading as MTN, but registered as Cancom PLC. So this is the 2023 annual report. Now, there are a lot of details that we have actually taken out. We've abridged some of the details on the financial statement because some of the items are very minute, very small items, which we may not want to focus our attention on forecasting. So this is the financial statement itself. If you want to take a look at it, just to have some understanding, if you want to have some understanding of how the actual financial statement in the annual report looks like, you can always get to this. So you see the revenue from contract with customers, then those other items, all that I just showed to you now, you'll see them all here. Then when you come to the balance sheet, you see the balance sheet items as well. But there are some few things that we've assembled together so that just for ensure completeness, right? We don't want too many things to go through. So you see their financial statement. So the projections we are doing is at the level of the group rather than the level of the company. That's why you'll be seeing items like the mobile money float and all that. Now, so if you look at the mobile money float, for example, you see that it's under the group. It's under the group. But when you come to the company, you don't see it there because the company here is the MTN's own primary business, but the group includes the MTN mobile money as well. So from the group perspective, you're going to be seeing that, but from MTN as a company, you won't see that. But when you take mobile money company financial statement, you are likely to be seeing these floats there, right? Good. So at a group level, all those things are consolidated together. All right. So there are a lot of details here that we've not presented there. Just want to show. So let you know. So we have this here. In case we want to refer to any notes and read more about something, we can always go back to read. So I'm showing you how these things are done in practice. You see, I could have gone to read this and tell you that, oh, in the annual report, they said this, they said that. But in case we have confusion about something, what do? We get into the annual report to read it. And we're going to be doing that even in the session today. If there's any confusion around anything, the best thing to do is to resort to the annual report. Okay, now let's get back to the Excel that we've been working with. Yeah, man, Excel. Okay. let me pull down the annual report rather, so I can get the Excel on. All right. So now we have our Excel ready for us to start our work. So we've already defined the, can you see my screen? I think someone just, okay, it's visible now. So I hope you can all see my screen. Great. Somebody said, what is the level of rounding? Figures in thousands? Yes, figures are in thousands. Sorry. Let us all use the Q&A for question related to the session. It is easier to follow questions using the Q&A. Thank you very much, Angela. Meaning of restricted cash. Please, restricted cash. I will explain that when it comes to issues of net debt, they are cash that you can use to pay off your debt, right? I'm not sure MTN will go and use the money kept, the floats to use to pay their debts. They can't do that. So those cash are restricted, cannot be used. Just joining for the first time, how I get a previous slides and all that. So I think those issues will be addressed by here. Good. All right, so now we have the historical financial statement, the P&L balance sheet and cash flow. At least it's okay to start with. Now, so we need to do some historical data analysis. And so I want to start like this. I want to come to, so that everyone can see clearly. I think I have to zoom in. Let me zoom out a bit. Okay, get about 150. Okay, I think this is fine. All right, so we can have MTN PLC. Just moments. Okay. Okay. So we have MTN Ghana PLC. That's what we're going to be doing. And we want to start with form of analysis of sales. So this historical analysis, we want to analyze the historical trading data. So we start with revenue analysis. Now, with revenue analysis, we need to have the years. So historical period, we have from 2020 to 2023. So we go the streets and do 2020, and we have 2021, and then we can look at that up to 2023. That's what we have for the historical period. Maybe let's do some formatting here, and we need to work with standard colors. I think maybe for MTN, this color will do. I believe this is MTN's color. If it isn't their color, at least for now, let's pretend this is their color. And so this MTN's color, I think that's visible to everyone. So the figures are in thousands of Ghana cedis, and we want to do revenue analysis. Maybe this color is not deep enough. Let me see if I can get a deeper one for the gold color I'm using. It appears what I'm doing is not too bad. Now, so we have some brief notes that the team has compiled. So is the revenues that the team has compiled, like a brief note on the summation of the revenue. And let's just confirm whether what is here is consistent with what is on the financial statement. So when I come here and I drag in here to see whether the figures are consistent, I could see that the total on the financial statement is the same as what is here. So I can trust these figures. That's what I'm doing. Are similar things that if you want to do a thing like this, you are likely to be doing. So I go to the data analysis, and I know that the items in the brief notes or the breakdown of revenues are these. So I also copy them. And then I bring them here. So I put them here like this. And what do I want to do? I want to bring the totals for each of those items here. So I bring them here, drag them down here, and then drag them across the years. Then I go ahead to do some total calculation. And so depending on the machine you are using, you may just do alt equal to if you are using Microsoft. But if you are using MacBook like I do, that becomes a difficult task for you. Maybe if somebody could teach me something new today. A circular error. Wow, I think I made a mistake. Okay, so it should be up to 11. That's correct. Somebody can teach me something better today, maybe as to maybe whether there's a shortcut for the alt equal to for MacBook. I'll really appreciate it. We sum that up. So this is all we have in. This is all we have in on the brief notes worksheet. A question from someone said, use black for the letters. Okay. Okay. Victor just pasted the link to the MTN Ghana annual report. Wonderful, wonderful, wonderful out there, Victor. So let me use black instead. Okay. All right. All right. I think that's fine now. Now, so this is the revenue, the total revenue we have. We need to perform some analysis. So one thing I may like to do is to, number one, I love to paint a lot. So do some few painting. Then I come here, I want to do some key performance indicators. I have some key performance indicators. And then usually would love to put them in italics. Since this is the first one I'm doing, it's going to take a bit of time. Then from here, things are going to be better. Now, so what do I want to look at for? Number one, I want to look at matters like general growth in sales itself. So revenue growth. Which type of growth am I looking at? I'm looking at YY. So this is a type of growth. What am I doing? YY is a type of growth I want to look at. Now, when I do this, I put also in italics, but then I do some indentation. So I have to increase the indentation to the right at least twice. I love to do that twice. Then I drag it down so I can do that of others. So the second thing I want to do is that after looking at the overall growth in revenue, I want to take each of the items like network sales or network service. I look at that, interconnect and roaming, and I'm going to explain some of this is what they mean very soon. Interconnect and roaming. Let me do that. Interconnect and roaming. And roaming revenue. I'll explain that. Then we have digital. We have digital and fintech. Digital and fintech. We have that also here. The last one is, or the last two ones are, so we have devices and accessories. Devices and accessories growth. We have that also here. And let's also look at, apart from this, let's also look at the last one, which is others. Growth in others. Okay. So here we are not really doing any, concluding on anything. We're not doing that here. All we are doing is just analyzing or trying to do some historical analysis using YOY. We studied several ways of doing historical analysis. It can be ratios, it can be time-based methods like the KGA, the YOY, and all that. So here, we're just using time-based method. We're doing this trend analysis, right? Okay. Now, the overall revenue growth, since we are calculating growth, of course, we can start from the first year. One thing I always love to do is use the if error function. And I'll tell you why. So we do this for the total revenue, this divided by this minus 1. Now, if error, I want you to return not applicable. Okay. That's what we have for the first one. Now, for the second one, I can just copy this and paste here. Then, all I have to do is to shift this up, shift this also up, then I'm done. Now, going forward, all I have to do is to drag to the last one. So I'm done. This is what we want to do. Now, so when you do this, you just apply the percentages, and this is what we have. This is what we have. Okay. We've not started any analysis yet. But one thing too I would like to do from here is to look at the average YY, average YY, and also I want to look at the CAGR as well. So the average YY is a matter of just taking averages over the period. And then we drag. Now, to give the CAGR, we use this function. Look at it, RRI. Just use RRI. We open brackets. The first element is number of periods. So we're looking at the number of compounding periods here. And here we are compounding over 3 periods to 3. Then, so we have a figure here that is going to grow over 3 periods. 2020 will grow to 2021, that's 1 period. To 2022, that's 2 periods. And to 2023, that's 3 periods. Then the starting value is a PV. So that is this for the total revenue. And the ending value is this. So we want to calculate the average growth rate, compounded growth rate. This is what we have. Let's drag this down one step. Then let's move. We highlight the formula and move it up. Highlight this one to move it up. But the periods still remain the same. Then we just drag down. We are cool to go. Okay. I would love to, for the purpose of the CAGR and average, maybe highlight them so that just show a reference point, what we're doing here. So maybe I'll use a deeper blue for this. Maybe it's maybe that's too deep for this. Okay. I think we are making progress, right? We're learning something good from how I'm approaching this. Yours may be different. Please, I need the file or the document. All WVG. Hey, well, that's I'll try that. That's just quite a lot of ways of just getting the summation. Meanwhile, I can just type my sum and I'm gone. So I don't have to get missing in all this. Okay, sir, please, how do you get all the lines of the sheet? Okay, so to do that, all you have to do is just go to view. You get to view, then you uncheck the grid lines. You just uncheck the grid lines at the top when you get to view. That's what you do. Oh, okay. No, that's to remove grid lines. Oh, Ola, why should I go through that hell? If I can just click on view, then I uncheck the grid lines. Someone said, go over the CAGR again. So look at the formula for CAGR. Let me just highlight the formula for you to see. So see the formula. So we're having historical 4-year period data. And then the number of compounded period over a 4-year historical period is the number of historical periods minus 1. So whatever the historical periods is, just take out 1. So that is 4 minus 1, which is 3. So the first one, the number of period is 3. The second item is when are you starting from, or where are you starting from? I'm starting from 2020. Where do you want to grow it to? I want to grow it to 2023. Then the RRI formula will give you the growth rate, like the average compounded growth rate. CAGR is a way of saying that, okay, so I want to grow something. I want to compound 6 million to get 30 million over a 3-year period. What interest rate can help me do that? Just like with the way we have the compound interest formula, right? Now, the inbuilt formula in the RRI, the algorithm there is basically the algorithm for the compound interest formula. making R the subject. That's the same algorithm that is built there. All right. Good. We've done something good here, right? But that's not complete. Now, I'll tell you why. Let's look at this. I don't want to only look at the growth in revenue. I also want to look at the proportion of each component of revenue to total revenue. So I copy this, I come down here, and we are here. So here we want to look at network service as percentage of revenue. Then here we want to look at roaming, interconnect and roaming as percentage of revenue. And here, the fintech, we want to look at the digital and fintech as percentage of revenue. And here, we want to look at devices and growth as percentage of revenue. Then finally, we want to look at devices and accessories, others or other revenue as percentage of revenue. So we want to see the revenue line item that dominates. So with that one, we can start from here. We use the same if error. I love to do that. So I take this divided by this. And if the response is an error, maybe I'm dividing 0 by 0 or a value by 0, those are non-divisible expressions. When I do that, it's going to throw an error. So I'm saying I must be able to handle error. So if error, then state non-applicable. You need to put it in those two inverted commas. The reason is that the non-applicable is a string variable. Since it's a string, if you don't do that, you won't get a result. Let me show you something. If you don't do that, let's hit this. Oh, you get a result. But if it's an error, you won't get it. For example, let me show you something here. If I make this 0, you see what happened? This is a name error, but I can't find the exact page. Okay, this is a name error. So if it's an error, you won't get a result. But because it's not an error, you are getting a result. But now let's do something better. So let's come here and apply the commas. What happened? We get a result. Now, suppose it's an error. It's not applicable. You get a point. Okay. All right. So let's go back. So that's the reason why we do that. I want, as much as possible, I want to resolve any possible doubt. Now, I want to just drag my things. I don't want to keep writing things over and over again. So let me actually make this absolute. So I can drag. But I made a mistake because if I'm making absolute, I have to make only the row. I have to log the rows and leave the columns. So I'm going to log the rows and leave the columns. So I'll take off the $sign from here. I don't know why they can't make it CD. All right. That's the problem. Oh no, I'm actually logging. I wanted to log the rows. I went to log the columns. So let me log the rows. These are some common errors that you'll be making when you are doing this thing. So I've logged the rows and I moved to this side. And here from here, I can calculate the average. So average of this. So why do we do historical trading analysis sometimes? We do it because also we want to, it will help us in writing our report, a financial model report. When we do this work and we are writing a report on that, we have a lot of statistics to report on. So when you are doing financial statement analysis, you are analyzing the ratios, the historical performance, you have the statistics here already. So you see clearly that a network service revenue dominates. And the network services is the basic service provided, the calls and data services, right? Calls and data services. They are the ones referred to as the network services, the calls and data. Now, the interconnect and roaming is also cost and data, but I'm going to explain that soon. The second one that follows is the digital and fintech, and that's the mobile money revenue, the revenue from the mobile money business for MTN. And device and accessories, they are those phones and things they sell. They sell some accessories and things people buy, blah, blah, blah. So usually they use that to attract customers, right? For loyalty's sake. Then other sources of revenue. But now, coming to the interconnect and roaming as percentage of revenue, the interconnect and roaming works like this. And you have to listen attentively here. I think someone written something. Please go over the kicker. I've done that. Can I choose to use zero instead of not applicable? Yeah, if you want to do. If you want to do. But the question is it zero? It's not zero. The result is not zero. So not applicable will be a better thing to say. If you say zero, you are trying to define something else. Yeah. So device, yeah. So someone talk about devices like MiFi and routers. Exactly. Those are kind of revenues from there. Now, interconnect and roaming, it works like this. You see, this type of revenue works like this. So when you use an MTN line to, okay, zero dilutes your average calculation. That's correct, Daniel. Thank you. Now, when you use your MTN line to call a Vodafone line, now it's a cost to MTN because you are entering into the space of Vodafone or Telecel. So MTN will have to pay Vodafone for getting into their space. So that is called an interconnect cost. Now, same way, if you are using a Vodafone line to call an MTN number, Vodafone is getting into MTN space. So Vodafone must pay MTN. So Airtel Tigo must also pay MTN. So I'm talking about the telcos in Ghana here, those of you outside the country. So the revenue MTN gets is what we call the interconnect revenues. And these can be local calls or international calls. So those are the type of revenues we have here. They are not that much. And there are good reasons why. Because MTN is a significant market player. It's classified as what we call an SMP, a significant market player. So because of that, the revenue they get from other telcos is lower than the ones other telcos will get from them. What I mean is revenue per minute of call placed into their network. So if an MTN number places a call into Telecel space, they may be charging higher than if a Telecel number places a call into an MTN space. So you see this revenue being low, the interconnect revenue, but I see the mobile money really picking up. And even if you look at the growth in the mobile money, look at the mobile money growth, 32, 10, 36. Then if you look at the CAGR growth, about 25%, compared to the CAGR growth in the network, 34. So the CAGR growth in network is still growing. That's about 34. And if you get into the detail of this, you realize that the revenue that is really driving these numbers is more of the data revenue, the mobile data and the fixed broadband, compared to the actual airtime and all that, right? Now, accessories and co are actually not contributing much. Of course, this kind of revenue lines are used to sustain the business, like customer loyalty and all that, and also drive some other revenues, but then they are not actually the core mandate of MTN, right? Okay, so that is a revenue analysis we have there. You may do more. In other words, some cases you may have to plot some graphs, right, to demonstrate some things. To plot some graphs, maybe histograms, or maybe you are plotting a pie chart, or maybe you are plotting a line graph to show how these things, relate. That's another way you can use to do the historical analysis. That's very important. But here, I'm showing you this actually for education purpose, right? We may not be able to do all that. Otherwise, you spend the whole of the day doing just historical analysis. Let's get into the next one. Any question on historical analysis? Is it fine? Is it fine? Do we all get it? Is that something we want to know? Steven says, when modeling, what do we focus on Is it the group or the subsidiary? This really confuses me. Oh, it depends on what you're money. For me, I want to do things at the level of the group because I want the mobile money to be part. But it all depends on the work you are doing for the client as well. MTN listed on the market is a group that is listed. Yeah. So, and a matter to about how significant a subsidiary itself is. If the subsidiary is very significant, extremely significant, you may prefer to just model at the level of the group. If it is insignificant, of course, who cares? You can just do it at the level of the company and you may still get a better result. Good. Great. Are we okay with the historical analysis, at least what we did? Victor said, why are we not calculating CAGR for the percentage of each item? No, the CAGR wouldn't make any sense to do. Because CAGR is looking at the average growth, but the percentages don't reflect that. That's the reason why we are doing for average, only average YOY. Are we okay with the revenue? Quick. We have a lot to do today. We want to hear from you. Are we okay with revenue? Analysis. Are we okay with revenue analysis? Okay, yes, please, yes, Claire. But then something here. Olua said no. Olua, is there something? How was the revenue growth calculated? Okay, so the revenue growth, look at this way. Just see the formula. Look at the formula. Let me know if you're okay with that. Are you okay with that? Suzanne is okay. Olua, are you okay with that? The formula I'm showing you. Are you okay with that? Okay, good. Thank you. Great. Now let's see the next item that we have to analyze. So usually what I would like you to do is that to know what is next or whatever, all you have to do is to go back to, let me see. I don't know if I can hide this thing. It's kind of like, I don't know why it's covering this for me. Guys, just one moment. Let me just hide this so that I can quickly go. Okay. All right. Okay, I think that's okay. Good. So let's get into the next item. Looking at the financial statement, we've analyzed revenue. Let's move to other income. But other income, we have other income for just 2020, 2021, there's no other income. And 2022, there is one other income, but then not significant. 2023. Sometimes I would like to know the nature of this other income stuff. one thing we could do is to look into the financial statement to see what the other income comprises of. So let's look into the actual report to know what the other income comprises of. Then from there, we decide whether it's something we want or we think we will have to focus at all. So let me share my screen. So we look into that side. We check on what the other income is made up of. All right, so other income is 259, note 259 or 2.5.9. Let's check what that is made up of. If this all we're doing is part of the work. Don't think, why are we wasting time doing all this? No, they're all part of the work. So other income. So here's the note on other income, right? Now, so we're told that other income for the company for 2023 relates to consideration for the use of related party resources, services or obligations between the company and Mobile Money Limited. So this is something arising from that relationship. In the normal course of business, the company undertook various transactions with its subsidiary, that's the Mobile Money Limited, during the year. This includes the provision of administrative support service, office space, and other services. The charges are reflected as other income for the company. In addition, an amount of 1,464, which is this amount here, was received in recognition of prizes won for the International Data Privacy Awareness Quiz and Sustainability Challenge from MTN Group. So what is happening here? You see clearly that the other income on the company financial statement includes an intercompany transaction. This has to do with an intercompany transaction. That is, if you take the 1,464 out of the 133,004, the rest is just intercompany balance. So when they were all consolidated to group level, that services that MTN provided MTN Mobile Money, which MTN Mobile Money paid MTN for, those items were taken off. Like, those are intergroup balances that have to be eliminated upon consolidation. So from the perspective of the group, the only other income here is the prices won. So this is the price won by MTN Ghana from MTN Group. So there's an MTN Group, which is not the group you are seeing here. The MTN Group outside Ghana. So MTN Ghana is also like a subsidiary of an MTN Group somewhere. So that's why we have the 1,464. So I don't see this as something which is going to continue. This just purely prices won, right? So we don't have to worry ourselves too much about this. Somebody say income earned from its subsidiary and prices won. Yes, so, but then the income earned from its subsidiary is, from the perspective of the group, no income is earned because it's the same group. So you can't earn income within yourself. So the only relevant income there is the 1,464. And what this 1,464 is a price won internationally from the MTN group. But then this is not something we would like to focus going forward. So we can eliminate the other income. We would not like to get into it. Now, so this is how you do. You don't just go and say, or just say word of mouth that, oh, okay, on the top of my mind, I'm not going to do this, and that is all. The key thing you have to do in this case would be to document it. Why you think that will not work, or why you think you don't want to forecast or analyze or forecast the other income. You have to have it documented. Someone said something, the price value is an outlier. Oh, yes. So we don't really care about it going forward. Now let's look at the next item on the financial statement. That's the direct network operating costs. So when we come to the brief notes we put together, you see the transmission cost, you see the network maintenance cost, you see the lease lines cost, you see the spectrum and regulatory fees. All right, so I think there is a bit of, just a moment, let me confirm something. Okay. Now, so when you look here, let me go back to the financial statement. The direct network operating cost is kind of like the total for, I don't know why I try to pull this and it's giving me, okay. It's kind of like the total for the cost of sales. So take this as the cost of sales, right? So we have the cost of sales as we have it here. That's the direct network operating cost. That's the cost of sales. And these are the other cost elements. So I think I just have to define it properly. So this one is other operating costs. So maybe by taking out that, maybe let's do some more work and say this is gross profit. Okay, just for the purpose of argument. Let's call this line gross profit. You see, we are reworking some of the things. That is all normal when it comes to forecasting. So we sum the other income to it, and let's get the gross profit. Now, so then we less all these expenses, then we get EBITDA. So we can now track the EBITDA from the gross profit side. Okay. Okay. So we are still aligned. Great. So the next item is the direct operating cost. So let's look at the direct operating or network operating cost. The next item we want to analyze. So let's copy the header and let's come here. We give enough space. So we have direct network operating cost analysis. Now, so with the direct network operating cost analysis, we've also been given some brief notes here. Before then, let me hide floating meeting controls. Okay, good. So we have a breakdown here. We have transmission costs, we have network maintenance costs, we have a lease lines cost, we have spectrum and regulatory fees. So let me just copy that quickly and bring them to the historical trading here. Place them here. Now, so we can actually link them like we did for revenue. We link them all here. Okay, we link them all here. Then we can calculate the total. So we get a total. We sum this up. We just bring in everything here. So it's not anything different that we're doing. So we get a total direct cost. Now, again, just as we did for the revenue, we are going to calculate those statistics again. Now, I like to copy and paste things, right? But in a very responsible way. So I'll just copy the first 4 items. Those are the ones that are necessary for me or really needed. So I copy this and I paste there. Then I'll just edit the names. So instead of revenue growth here, I'm going to have direct cost growth. Then instead of network service, here is going to be network maintenance or maintenance. Then I have lease line. So I'm going to have lease line, growth. And then here, I'm going to have spectrum. And regulatory growth. Now, so then let me work on my, however, so you see everything is fine. I don't have to recalculate these things again. They have been calculated already. That's one thing I like about doing my stuff properly and then linking them responsibly. Just that this one is off. So I have to bring it down and drag it down move it to the right. And I have to do the same for the kick as well. Oh, I think I made a mistake. I've exempted one key thing, which is the oh, how come nobody told me this? Or somebody put it there. You left out transmission costs. Oh, wow, 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 wow. Transmission. Thank you, thank you, thank you, thank you. Okay. Thank you very much. Someone did. You know, I told you everyone, if you guys are listening, right? So transmission. So transmission costs. Okay. So we can move this to transmission costs, move this also up there. Then move it down. Move it to this side. Let me check the last one to see. What I just did is just off. Okay. Move this. Then the second item, this will start from the transmission. I don't know why I'm making these basic errors today. Okay. So now, spectrum and all that. So I think my things are in order now. The average formula is still intact. I have to look at that of Kiga. No, Kiga is intact for the first one. And let me drag this up and move it to transmission. To transmission. Okay. To transmission. Good. I think I have that now. Now, so we can also do percentage, right? We can do percentage as well for this. We can do percentage for this as well. So just come back a step down and put that there. So here too, you have transmission costs. I'll tell you why we need to do these percentages. So you see it soon. As percentage of direct costs. Then the next one is we do network maintenance. I'll just say, maybe let me just write for completeness purpose as percentage of direct costs. Then the next one is lease lines as percentage of direct costs. Then the final one is actually spectrum and regulatory. And regulatory as percentage of direct costs. Okay, let me analyze the last things here. So you see the error here because if you make the formula absolute, you see what happens. It's getting anchored to a certain cell and failing to change. All right, so I need to now move this formula to the total for direct costs, which is 35. So C35, I change it there, C35. It falls there now. I hit the enter button. I drag it down, then to the right as well. So this is what we have. We have the average. So we are done with the direct network operating costs as well. And you see clearly what is dominating. Over time, there's a certain cost element dominating. Transmission cost. We will have to investigate why transmission costs grew by 20%, 18%, suddenly, oh, what am I doing? Grew by 17%, then dropped by 2.7% growth, and then increased by 112%. That's quite interesting. It's something which I would like to look into. Network growth. So you see, it's not only transmission, you see lines growth as well. The lease line growth as well. That's also very high, 121%. In fact, it was 139 the previous year. Then I would like to start looking at the amount involved. Maybe the amount involved is not that huge, 29 to 28. Then it grew to 67, then more than double to 149. These are things I would like to look at for, because if things start giving me growth rates that are not regular, then I start getting worried as to how the future should be as far as these things are concerned. Someone said, please the link to the data transfer. Okay, good. Then someone else resolved that. All right. Now let's move to the next item. The next item is what we have here. We have cost of handsets. We have interconnect and roaming. I mentioned something to you about this interconnect and roaming as a revenue. When other networks call into MTN lines, the opposite is cost. Where MTN calls into other network lines, MTN will have to pay. That becomes the interconnect cost and roaming. Good. Oh, sorry. Okay. So let's look at it. We have some brief notes here. This brief note is on other operating expenses. So details of other operating expenses have been provided as here. But on the face of the P&L, we have this summarized here. We have the cost of handsets and other accessories. So what I want to do now is that for the operating expenses, I want to just first create a header, just like what we did for the direct cost here. Let's just first create a header, then we see how to analyze those items. So we call this operating cost. Operating cost analysis. We are making great progress. And we have the items here. Let me put that here. The other operating expenses, for now, in fact, let me call this also operating expenses. We will analyze those ones separately. The question is, even how much are they? If you look at other operating expenses, they look significant. If you get into the details of the other operating expenses, you see that there are some significant items here as well that we can gain some insight into. So we need to analyze that separately. We are not under any pressure. So we need to find a way of handling that. And so we can get these items on the financial statement. So when we get to the financial statement, we come here, and these are negative figures. So I put a negative sign by the formula so I can convert them to positives. Then I drag them then to the right. So I have these figures here for the operating expenses. Okay. Now, I need to calculate my KPIs. But then, just for a strange reason, I want to put the other operating expenses as well here, even though we are going to be analyzing the details separately. But let me just put other operating expenses here for completeness sake. And so I can calculate the total and be able to perform proportional analysis or proportional analysis and see proportionate analysis or whatever. Don't mind that now. What is very important now is getting the points. So we get our key performance indicators as well, repeating the same task. You see that financial modeling shouldn't just be taking financial statement and just suddenly start growing things at KGA rates and blah, blah, blah. No, you need to go through the process. There's a procedure that must be followed, right? Now, so the first one, we want to look at the growth in the handsets and accessories. So handsets and other accessories. Accessories growth. And we also want to look at, I think there's something I need to do here. The transmission distance. I didn't add the YOY. Okay. So we also want to look at the the YY growth in the second item, which is the interconnect and roaming cost. So interconnect and roaming. The third item is the employee. So interconnect and roaming growth. The third item is the employee benefits. So let's look at that. Employee benefits. Expenses, the growth in that. And the next item is the selling and distribution and all that, and marketing. Let's just call that SG&A, SG&A growth. And the last one is other operating expenses. So other operating expenses, other operating expenses. Now, so let's look at the growth rate. One thing I'll again do here is just to copy and come and paste. But there's one more thing we've not done. Usually we also look at the total operating expenses itself, growth rate. So I believe somebody in the chat is likely to put that there. So operating expenses itself must be tackled. Operating expenses growth itself. Now, so let's look at this. Let's get the formula. So we paste this here. No, I'm sorry. We paste this here. Okay. Now, so the operating expenses of the formula is updated. So there's nothing to do about that. Yeah, cool. The next item is what I have to work on. So I have to highlight the formula and move them to the appropriate places so that it aligns. We do that here. Then we drag this down. So this same thing must be done here. We move this one up. We move this also up. You hit enter button. Then I think I'm not sure I made a mistake. Yeah. So you hit enter button, then you drop this down, you drag it down. I'm sure everything is fine. So we are done calculating this as well. Now, so then here we have operating expenses. Here we are not talking about growth, so I think I can delete it. We are talking about proportional items. So here it should be handles and accessories as percentage of operating or of OPEX. You can just say OPEX. And here we're talking about interconnect cost and roaming as percentage of OPEX. And then here we are talking about employee benefit and growth, employee benefit, sorry, as percentage of OPEX. Then SG&A as percentage of OPEX. And then we move to the last one, other operating expenses as percentage of OPEX. Could have done all this before coming to the lecture, but that wouldn't be a better way of teaching a subject like this. I prefer doing it with you here. Now, so for the headset, so we move this up, and then the total, that should be 56, see 56. We bring it there, then we drag down, and we drag to the right as well. Then the average calculation is also dragged down. So we have done this side as well. Let me see the question. Someone put something. Why aren't we using a breakdown on the brief note for the other operating expenses? Yeah, I mentioned that we're going to do that. Let's say thank you for that. Yes, thank you very much to Evans. Yeah, good. All right, so now that we are finished with the total for operating expenses, let's handle that of the other operating expenses. There are two ways we can handle it. We can say that, well, look, looking at this, we don't want to get into the very details of things. Okay, because it may be too much work we need to do. So can we focus at the level of the operating expenses itself? Or we of the other operating expenses itself? Or we want to get into the fine details? Now, one thing I can recommend is that we can look at it at the level. So we don't have to go into the details to focus the very minute component. Now, number two, I can say that, well, this for tutorial purpose. But then if you are, again, doing this for a client, I'm not saying the procedure I'm carrying out is not what you do for a client or at work. This is what we do. In fact, this approach I use most of the time, even though there are more other things I will do, like plotting of graphs and all that to see how things are moving and all that. But then there's nothing different from this that I do. So I can tell you that you can go back to the brief notes and then look at the very details. But sometimes that may not be necessary. You may just want to get the total and focus it at the level of the total. And for now, I want us to focus it at the level of the total rather than getting into the individual components. The same approach can be used. So at least what I'm doing now is giving you some view of how if you are to do it at the level of the total also works. Okay, thank you. Now let's look into the financial statement. What is next? For us to complete the historical trading analysis, depreciation, amortization, finance income, and finance cost. I will say that the depreciation and amortization, we are going to tackle it properly under Capex and depreciation. And when we come to finance costs and all items, we tackle it under funding. So on this note, I want to say that as far as the historical trading analysis, which I want to say for the purpose of argument that the historical trading analysis is up to EBITDA. We are done. At least up to EBITDA. We are done. So we can do, so now that we have this historical trading that we've done here, one more thing I sometimes try to do with historical trading analysis is to look at working capital as well. Is to look at working capital. And then I'll do some other analysis, like EBITDA, historical EBITDA analysis and all that, growth in EBITDA and all kind of stuff. But I would like to look at working capital. So let's take some time to talk about working capital. So let me bring this down to the working capital section, a section to talk about working capital. So working capital analysis. And with the working capital analysis, you go to balance sheets. Now, so what's happening with working capital? The reason why I'm looking at working capital is that, you see, inventory relates to the direct cost matters. Revenue relates, or trade and receivables relates to revenue. You see those, you see the connection. Then we have items like payable, and that relates with what? The cost of sales and operating expenses and all that. That's why whenever I look at analysis of those things, I want to also do the working capital alongside, right? So we have inventory. We have trade receivables. Those are core working capital items I want to pick. Financial assets, no. I'll show you what we're going to do with that. You read what it is about, then we see how to handle it. Growth and sustainability level, you look at that as well. Mobile money floats. Okay, we may look at that. Cash and cash equivalent. So the mobile money floats, the growth in sustainability and all that, I'm going to classify a lot of those things as non-core working capital. And I'll explain to you why. Maybe just for purpose of argument, I'm classifying them as non-core. You may argue with me that the mobile money float is not non-core. I understand. I agree with you. But then I want to classify it like that, just so that I can follow a certain approach I want to use to forecast this working capital. And when to the current liabilities, we have trade and other payables, and we also have, so which is of course like a core working capital. We also have provisions. We have borrowings. The borrowings are here. The borrowings are also under non-current. So we'll treat that when it comes to funding. Obligations to electronic money holders. This is also more of like a payable. But then I'll explain to you. These are usually, if you look at this amount here, it's a payable, but look at this amount here and look at this amount under the float. And tell me what is happening here. You see the figures under the float. Good. So think about this obligation to electronic money holders as deposits or as a total money in the wallet of the vendors, mobile money vendors being held with MTN. To MTN, this is a payable. So you see the total here, the same as the total here. Oh, let me use a color that you all can see. This total here is the same as the total here. So that keeps the account still in balance. Right? So when we forecast that the mobile money float and the current assets to grow at less than 10%, the liability component, which is the obligations to electronic money holders, must also grow by 10%. This is not only for even the vendors or something, even us, the monies we have in our mobile money, the output, right? Those monies are not for MTN. Okay. Sometimes when I take of this, I just forgot the last time how. Okay, I think I have everything here checked. Okay, I'm not sure there's any question. Okay, so let's gather the core working capital, and let's also get the non-core working capital, and just perform some analysis to see how things are looking like. So working capital. So here we're going to look at the core component of working capital. It's a core working capital. And maybe I want to shift this a bit to the left. Now, so here for the core working capital, one thing I always want to do is to look at this in a year, because when in our studies of working capital, we knew we studied all these things. We looked at this in a year to know that total number of days we have in a year, and then use that as basis to do some 50 analysis. So 365 days in a year. That's what we know. 365 days in a year. Then we would like to do some computations, right? But then before the computations, let's arrange now our working capitals. So here we have inventory. So let me make it inventories, right? Let's look at our trade and other receivables. Then let's have our trade and other payables. Good. Now, so let's find a way. Let's just getting them linked here, so we have them on the financial statement. Trade and other, our inventory first. We get our inventory, and we get it arranged here. Then we have trade and other payables. We get it arranged here. So trade and other payable. Oh, did I say payables? Other receivables. Then trade and other payable. we go back to drag that as well. So we've dealt with some current asset and current liability items so far. We need to look at how we do the other one. So we drag this also. So we get a total for core. Do I need to even sum it up? Maybe I should do. So let's get a sum. So sum all this up. So is a total for that. Good. Now, so I need to do some calculations. So I have what maybe what we did here, the working capital days, let's bring it here rather. Let's bring it a bit below here. Let's put it here. And let's delete these. Let's delete these two rows. I think there's a question. To save time, right? Yes, to save time. Yeah. So here we can talk about the working capital days. Working capital days. The historical working capital days. So let me shift this twice to the right. So the working capital days. So we have inventory days. I'm not going to be teaching this thing again because we discussed all this. We did a lot of analysis and calculation around this thing, how to adjust working capital days. We went through all that already, right? So today's class is not for that. It's receivable days. But if you have a question, you can still raise it. I'll respond to it. But I will not go into details on why you are calculating working capital days. Payable days. Now, so let me just give one space. Now, we know that inventory goes usually with cost of sales. So what we do to calculate days, let me run through this again. I told you that the reason for these days things we do is that, for example, if we have, let me start with revenue because revenue is something which a lot of people can relate with. So let me start with receivables instead. So if we have sales made in a year of, let's say, 10,000 cedis or dollars, whatsoever, we know that we're having 365 trading days in a year. I'm not talking about trading days on a stock market. Because for stock market, trading ceases weekends and holidays. So we have only 252 business days. That's what they call them, business days or trading days on the stock market. However, for general businesses, we have 365 days. That's the reason why always the days are calculated out of 365 days. So if we have revenue, for example, here, the total revenue is 6-point-something million. I highlight that there. That's a total revenue in 2020. Can we calculate revenue per day? Yes, we can calculate revenue per day. That is by dividing the 6.033 by the total number of days in a year. That gives a revenue per day. Do you get the point? So that gives us the revenue per day. So when we are talking about receiver, why did you sum up inventory, receivable, and payable, and not my? Oh, I'm sorry. Thank you very much. Thank you very much for that observation, Victor. That's why first I was asking myself, am I actually summing up or actually sum up? I actually have actually summed up. I'm sorry. I'm sorry. I'll address that. So this formula will give us revenue per day. So when companies sell, most of the time they sell on credit. And when they sell on credit, they give some number of days within which the customer should buy, or sorry, should pay. So if a company is giving 30 days, it means that if the company sells today, let's say today is 1st of January, and we are giving 30 days. So when you buy from me 1st of January, I expect you to pay within 30 days. And the 30 days elapse 31st of January. So 31st of January, you must pay. So when I sell on 2nd of January, I expect you to pay by 1st of February. If I sell 3rd of January, I expect you to pay by 2nd of February. If I sell 4th of January, I expect you to pay by 3rd of February. So you see that at every point in time, if the credit policy is followed, at every point of time, there will be 30 days of sales made that is outstanding or yet to be collected at every point in time. So if I know that the daily sales made, the average daily sales made is this figure here, if I need to know so this is the revenue per day, but then it will take 30 days to collect it. Tomorrow's revenue will take 30 days to collect it. Now, if I give a credit policy of 30, which I've been talking about, then there will be 30 good days of sales outstanding. We call that the receivable days. Now, when I multiply that by the sales per day, it gives me the total receivable. The 30 days of sales are always outstanding. So if I multiply this figure here by, I'm just demonstrating something for now, right? By 30 days, in that case, it gives me the total receivable of the company. Just showing you something. Now, knowing the total receivable, can I recalculate back the number of days implied by that receivable? Yes, I can do that. All I have to do is, which we looked at last week, is to do the equal to, go and pick the receivable figure, divide it by revenue. So it's just a change of subject, right? And then multiply the results by the number of days. It's just a change of subject of what I just talked about. So that's why we have the days a year here. So that gives us this. But let me take off the total here. Victor, thank you for your observation. I love this class. Now, so inventory days too, we can do the same. We take the total inventory, we divide it by cost of sales, which is a direct network cost. Then I know it may not be exactly, but then let's just see it follows, right? That relationship follows. So when you are relating things on financial statement, you must be able to establish that there's a relationship between those two items. You don't just relate them. I see people just receivable as percentage of these costs as a percentage of revenue. We don't just do things like that. You know, I told you this time and time again in this lecture that you must, for you to relate something as a percentage of something, you must establish that historical relationship between them. Like revenue and receivables are related because uncollected revenues are called receivables. You see that? Okay, so we have this also here. So see how stable MTN's days are for the receivable. For payables, it's quite funny. But then when you come to receivable, it's quite good. You see, when we start seeing these lower days here, it tells you that there may be problem. Now, even look at receivables. 54 dropped to 29, then dropped to 30, then to 80. There may be a problem. So you need to investigate it. Sometimes they disclose this in an annual report. You can read about it to understand what is happening. Victor says, in the case we have leap year, are we to assume 365 days as well? No, that wouldn't affect the calculation that much. So just go straight with the 365 and we'll be fine. Now, payable days, for payable, we take the payable divided by, now here, there are two possible things that you can do. First, and this is a real challenge sometimes we face in practice. Let's look at the cost of sales to see whether it's higher than the payable. If I say cost of sales, I mean a direct cost here. Look at that. It's lower than the payable itself. So when comparing the income statement and balance sheet items, can we use the average of the balance sheet items? I may have to look at the comment again. Let me just address this. You see that the total cost, or sorry, the direct cost is lower than the trade payables. It becomes very difficult to base a projection on that. So you know how you do. Maybe you've never seen it before, but this is what you do. You sum up the direct to the operating expenses. There are some elements in that trade and other payables that don't relate to direct costs. They may relate more to operating expenses. So you sum up both. But note that that is what you've done. So when you sum them up, then you multiply them as a denominator, then you multiply by the 365. Because all the days you are calculating must be below 365 days. Otherwise, it doesn't make any sense. If the collection is going to go beyond 365 days, then why is it a current asset, a current liability? Right. Okay. Let me address the concern the person was raising. So who was raising that concerns? When comparing the Daniel, when comparing the income statement and balance sheet items, can we use the average of the balance sheet items? Well, like average inventory, no, it's not quite reasonable to use average inventory. I think when people are calculating, yeah, because I understand the balance sheet at a point in time, right? So you think the average work? No. For working capital, no. Maybe for other items, we can use average. Can you take the inventory days again? So inventory days as percent of cost of sales. The thing is that if we have the actual inventories on the P&L, actual inventories booked to P&L, and the cost of sales, that would have been the better denominator to use. But since we don't often have that disclosed, we often use the direct cost or cost of sales to represent that. All right, so we can also calculate some statistics here, and these statistics will surround the average, right? So the average days. So we have average days outstanding. So this is the average number of days outstanding. And these are in percentages. Let me convert my things to days, to complete days. Maybe let me take up the decimal signs as well. Oh, okay. So this is working capital days. Now, there are other components of working capital we've not analyzed. Let me address this question. Olua, can you take the payable days again? Oh, of course. So those are the number of days. Okay, so the point is this: when it comes to payables, it can either be raw materials purchased on credit, or it can be services that are rendered to you on credit. For example, salaries at the end of the year will be accrued. For the last month may be accrued, but may be paid in January. So that salary may appear on the balance sheet as an accrued expense. That accrued expense is payable. So when we say payable, it's not just raw materials. It could even be maybe regulatory fees like tax charges and all that. You know, sometimes you calculate your income tax, but you may not pay. Usually you don't pay at the end of the month. You pay maybe the 15th day by the 15th day of the next month or something. So on the balance sheet, it may be there as a payable. You see, so that's the reason why when you want to calculate payable, you are not interested in just only the cost of sales, because some of the items that are driving the payable, increasing and decreasing payable, may be actually under operating expenses. That's why I summed the two up. Okay, so let's get into the financial statement again. The items under current asset and current liability we've not treated, like financial assets. We have to look at this financial asset, but I'll tell you the story about these items and why sometimes we don't forecast them. Income tax asset. Income tax asset, let's leave it. When we get to tax side, we'll handle it. Growth and sustainability levy. We may have to look at this growth and sustainability levy. What is it about? Then to understand it better. So that is one thing. The mobile money floats. So just to be fair, what I'm going to do is that I'm going to look at the other components of working capital. Can I drag this down? Just a step down. And so I have, this is core working capital. And then I have non-core here before the core working capital days or working capital days. I can make this core. Now, so this is the non-core. Non-core working capital. Now, so the non-core working capital, I can list the rest of the working capital items, like the trade and other receivables. We have dealt with that. Financial assets. So we have financial assets. The income tax, leave it, you look at it when we come to the tax side. Growth and sustainability. So I want to talk about the financial asset, growth and sustainability, and mobile money floats. So you come back here. We have financial assets. Even with the financial asset, let's leave it for now. We'll talk about this also later. So let's rather look at the growth and sustainability levy. Growth and sustainability levy. And mobile money floats. Mobile money floats. So then we come to the payable side of things, and we have the trade payer, we have provisions, we have leave borrowings because we tackle it when we come to funding, then obligations to electronic money holders, and then we have other liabilities. Good. This other liability item, I don't know why I forgot about it, but then we need to read about it. So you see, guys, what I think we should do first is that let's read about these items. So let me open let me stop sharing so that I can show you this. All right. I hope you can see my screen. Now, going back to the balance sheet, I want to show you how we did. So when you come to the current liability, you see there are other liabilities here. We have the lease liability, we have IRU liability, we have other liabilities. So you start seeing that from the lease liabilities are 2.15, the IRU liability we have being 2.18, 2.2 and all that. So actually we can read about some of these things. Let's look at the 2.15. Let's start with 2.15 and see what that is about. 2.15. Am I using the right? Let me go back. I don't know what I was calling. So 2.15. 15. I was thinking about 15 in a different way. So 2.15. So this 2.7, this 2.12, or 2.12, 2.15. Okay. So 2.15, that's what we have, depreciation and all those things. And from there, we have the lease liability. Then we have right of use assets. Some of these things we are not going to focus our attention in forecasting them, right? The RRU assets, that is the indefeasible right of use. So these are our right of use assets. And RRU liability, they are right of use, which is more of the lease as well, but a special type of lease. Then the other non-current liability, actually amortization. They say finance cost paid on the statement of cash flow includes an amount of social relating to interest payment to Ericsson Convert Wallet liability. So these are not trade liabilities. What I wanted to confirm is to see if these are trade liabilities. And you see clearly that these are not trade liabilities. Because they are not trade liabilities, we don't have to worry too much about them when we look at operating assumptions. These are not trade liabilities. So let's leave that for now. They are not trade liabilities. A question here, the G and SL is a percentage of profit before tax, or gross production based on the firm's category. It's talking about okay. Yes, I get it. Yeah, so you'll get to that. Yeah, exactly. You'll get to that soon. Good. All right. Let me show my SL again. Good. So we are not going to waste our time on the other liabilities. And when it comes to the borrowings, I told you about that already. And provisions, oh, we should have checked what the provision is about. I don't know why I didn't do that. Let me just check quickly what the provision is about. So let me share my screen on that. So we check what the provision is about. All right, so back to the balance sheet, we have the provision here, that is 2.27. Let's see what it's about. 2.27. 2.27. It just sucks having to drag this down all the time. 2.27, this 2.27. So a provision is recognized when there is a present obligation. No, that's the definition of the provision. So additional facility, okay, this is the borrowing side of things. Looking at the provision, reconciliation of provision. I'm just looking, there are several types of provision here. Just thinking maybe there is a note, specific note on the provision. Here, they are just accounting items. Okay, so here, the first provision is a bonus provision. So the bonus provision consists of a performance-based bonus, which is determined by reference to the overall group performance in regard to a set of predetermined key performance measures. Bonuses are payable annually after the group's annual results have been approved. This rhymes with performance, right? Then this one, the commissioning bonus. So this relates to the estimated cost of dismantling and removing an item of property, plant, equipment, and restoring the site on which the item was located to its original condition. Now, so the group provides for the anticipated costs associated with the restoration of the leasehold property to its original condition at inception of the lease, including removal of items included in plants and equipment that are erected on leased land. The timing of the provision is expected to be at the expiry of 15 years of site commissioning. The big problem is that we don't know when the site was commissioned. So they may have details of this site, and then they calculated the provision for each of the sites and aggregated the result, which we may not have here to be able to do this work. Now, secondly, usually so what is happening is that they want to restore a site in, let's say, 15 years, okay, after using a site. So they will have to estimate the cost of restoring the site in 15 years. Then discount it back to today, how much the value is. That becomes the liability on the financial statement. So as the time approaches, the time goes by, then that liability will be compounded. That liability will be compounded such that in 15 years' time, we have that amount on the balance sheet ready to be used to restore the land. So this is part of the decommissioning cost, right? So it works like this, that once you have taken responsibility to use someone's land or use a land and use for something, you have also committed yourself to restore the land back. You need to make a provision to that effect. I think that is IAS 37, right? Yeah. Accounting for provisions. Now, so this is the nature of the provision, and we will not waste our time on this provision, right? Try to estimate anything on this. And we have share-based payment stuff and a whole lot of items here. So some of these items, I'll show you how you handle them. If you don't want to take the trouble estimating them and here we don't want to take trouble estimating them because of the time. So the time factor, that's the reason why we may not do a lot of these things. So it just went for me to show you that these two items that maybe as it stands now, you may not want to really take the trouble of working on. Okay. Now, so we have that also dealt with. Other liability, so you're not worried so much about the other liability. The best thing we could do will be for us to keep level, right? But I could see the other liabilities, it dropped, then it's risen again, then there are a lot of things that are determining this. So sometimes it will be difficult for you to calculate how the values will be. Now, when we have borrowings and the current liability, the meaning here is that these are the portion of the borrowing, both the interest and principal component, that are likely to be paid or payable within the next 12-month period. We explained that, or we discussed that at the inception of our training. Now, so provisions, we can keep the provision to at the same level going forward. so that we don't have to worry ourselves about growth. But then as we continue this, if we have a change of mind, we can still see how to handle some of these things. Growth and stabilization or sustainability levy, we may have to look at it a little bit because it may be a portion or a percentage of something. So we see how to do. Okay. So we'll discuss that when we are looking at the task aspect of things, at least for now. So what it means is that what we have here under the historical analysis, what we have, we can then add the current liability component of it, which is obligation to electronic money holders. So let me just mark that quickly and bring that to here, obligation to electronic money holders, and then move that amount also here, which will be the same as the mover money floats. So we have that here. So these other two, I think I'm making a mistake here, right? Just a moment, team. So I think the obligation to electronic money holders should rather be here. Then we can get a total for that. Okay. And also get a total for the mobile money floats. Mobile money floats, also dragged. Then finally, let's check whether this one is also correct. The growth and sustainability levy. In fact, those are items. Let me take it off because I'll be looking at it when we come to the task side. So we have just the mobile money items here. The question is, how are we going to go ahead forecasting them? And one way we can analyze the non-core working capitals will not be the days. Here, we may do based on growth. Okay. So analysis, non-core working capital analysis. Here, we may focus on the growth. So even bringing it below may not be appropriate, or we just have to handle it here. Or to solve the problem, I can bring it here, the entire thing here. And so I can delete this portion here and go back and relink what I had on the financial statement. Then we are cool. Okay. So we are cool now. So here I can do some statistics like YOY growth and all that. That's all I need. I don't need to do any proportional anything. So I can just do the growth. I know the growth is going to be the same. So growth in Momo floats. And here I want to do obligations to holders, money holders, right? Yeah. So let me just pick one of these, bring it here. Okay, so I can move this up. I can move this also up. Then you can drag it. Then drag it this way. Then I can also get the measure figure that's also placed here. Average growth. Then CAGR growth will be this. Shift this one also up. Then bring this also down. All right. Good. As it stands, I think our historical analysis, as far as what we're doing here, at least is fine. Any question? Other than that, we take a 5 minutes break, or we take a 10 minutes break, a tea break. And when we get back, we are getting straight into the model assumptions development. So I do use days in year function to get total days. Oh, yeah, of course, that can be done. I know the effect is immaterial. Thanks for the clarification. Great. Just that, of course. Standard thing is 365 days. All right, so let's take a 10 minutes break. I think that's fine. Drop something in the chat box if that is okay with you. So we are coming back 12 p.m. GMT. 12 p.m. GMT. That's fine from Daniel. Who else? I need 5 more. Hola. Che. Then another one. Fine. From Olainka. Then another cool. Anthony. Okay. Great, guys. So, okay. So let's take a 10 minutes tea break. We'll be back at 12 o'clock. And then we get into model assumptions and development. More assumption development and projections. I'm sorry. Assumptions and development. I'm sorry. Yeah. Yeah. Great. Hi, welcome back. And welcome back. Can you hear me? All right, thank you. Good, 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 good. Great. Now, let me say this. You see what we're doing with the historical analysis? There are more we could do. If, let's say, we have the year-to-date data of MTN on a monthly basis, we can do more calculations. That's what we can do, current trading analysis to know the percentage completion. We can calculate our run rate and all those kind of stuff, right? Which we dealt with on the first day. So because of limitation of data, that's why we are just doing this analysis on annual basis. Okay. Let's now move to operating assumptions. Now with operating assumptions, I want to move this there, just the header there. So operating assumptions, and here is in B3. B3, let me put it there at B3. And then also now make this 150 so that my people can see, so that you can see online. Okay. Now, so we are going to do the assumptions here. And what I wanted to do before starting with this assumption is to write here assumptions. These assumptions. And increase the font size of the assumptions to 18. I want to make it 18. Then I'll come here and say revenue. So here where I'm going to develop revenue assumptions. I don't like something that people do, that they'll go, instead of typing up everything, they'll go and just use their core tool and just drag them, move them to under this. I don't like to do that. I love to always type my things. Then so here, I'm also going to have this. I want to do this forecast over a 10-year period. So from 2023, we go to 2024. And then that will be up to, so 4, 5, up to 33. I think that is 10 years. 2033, that's 10 years. So if I move this up to 2023, that's 10 years. Okay. Now, I would like to use a different color. So MTN's colors are, I think, black and that's yellow color. So I want to use black here for the forecast period. And then one thing I always want to do is that I must be able to document my assumptions. Whatsoever I'm going to be doing, I need to be able to document it. So from the assumption side, I'm creating this below for documentation. So I'm going to merge this. This is where I'm going to do some write-ups. I need to be able to write to explain why I believe something should grow at a certain rate and not at another rate. Let me use some colors here for that purpose. Okay. So let's see how it goes. Now, I want to do this here where for this side where I'm going to be doing my forecast, I want to change the colors, make the color light black. All right, something I don't know the name to give to this color, but I want to call it light black. Okay. Let me see whether any question. No questions so far. I'm not sharing my screen, am I? Okay, I am. All right, good. So now, there's this serious question we need to ask. What is the basis of forecast? Should it be growth or YY growth? Or it should be something else? But then to start with, let's look at the historical analysis. In the historical analysis, let's look at the stability of growth. YY for total revenue is good. For network revenue, it's also good. Well, but for interconnect revenue here, it's of decline. Now, let's see which is more stable. Is it the YY that is more stable, or the proportion of growth that is more stable, or the proportion of the revenue that is more stable? So that question must be answered. Now, if the proportion of the revenue that is more stable, I'll prefer to grow the revenue as a total and then use the proportions to distribute them across. If the YY is more stable, I'll prefer to grow each revenue line item at their historical rates. I think someone asked a question. Okay, no question. That is one thing I can do. So we need to determine which approach is more appropriate for us. Is it YY or the otherwise? Okay. Now, maybe for the reason, if we do proportional analysis, the challenge is that some of these revenues may grow at a faster rate than the others. So it may be necessary to look at the situation at a local level, which means looking at the situation, looking at their own growth patterns, rather than relative growth or relative values. So let's go with the YOY growth. So I'll copy this like this and rather go down here. I'd rather go down it here. So this is what we have. I shift it back to the beginning, and I take off the italics. So this is what I have. So then from here, I want to link. So I'm going to this place, the historical analysis, to get the values for the YOY growths and everything. I'll start with the network service. Then bring it down here. Then to this side. So I'm just moving the things that we did historically to this side, so it can simplify our analysis. Now, so we will need to determine how we want to forecast this revenue. So we also know from the historical analysis what the average YOY had been and what the CAGR had been. So I want to ask you guys a question. What do you think is the most appropriate approach? If we are using a growth rate, what do you think is the most appropriate approach to forecasting this revenue? Should it be based on average YOY? Should it be based on CAGR? Or should it be based on some combination? So I want to see that in the chart. How do you think? How do you think? By looking at the trend, the growth trend, how do you think should be the growth? For example, let's take network service growth rate, growth revenue. Okay, so Victor Sekega, please, when you provide the answer, try to type, provide some justification for your answer. So Victor, try to provide justification. Why CAGR? Why CAGR? And I want as much response as possible to this question. Daniel said, CAGR, average may overestimate growth. Let's look at that. Average 30 versus CAGR 30, 34 versus 34, 6 versus 15, 26, 25, 28, 14, 34. Okay, average seems to be overestimating growth in some instances. Average, we can see some trend growing a certain percentage. Okay. But you see, what we're building is just the initial work. Let us not forget, this is just the base model. Afterwards, we are going to come back to interrogate assumptions again. Can we investigate management growth plans for the subsequent years? Good question. Good question from Evans. Good question from Evans. some of these things we discussed. Combination of CAGR and maybe the growth trend in the industry or MTN's market share of the industry. Now, when you get this industry data, you can go to the National Communication Authority. They have reports on this, or even Fitch Solution provide industry or sectoral analysis for each of these industries. So you can see the prospect, industry prospect around growth. So you can use that to validate whether the rate at which you think this thing should grow. So good responses from you guys, Evans and Daniel so far. And also Navin said, average, we can see some trend growing at certain rates. So Navin, thank you very much for your input as well. And also Victor. So now, so let's say just for the start, right? Just for the start, let's say we want to use the CAGR. But I see, when you come to the side of the interconnect calls, you see that the average is negative, CAGR is negative. You can project this revenue to be dropping. So a better thing somebody may do would be that, well, for the average, I'll rather project it based on the last 2 years and I'll exempt the 2023. Maybe I'll have to investigate why the 2023 was negative. So someone may try to do this up to E and then get a better estimate. Right. Now, the person may also do the same for the CAGR. Because maybe something happened in 2023 that made the interconnect cost to drop. And now, let me say this. I want to suspect in 2023, recently, the government amended some regulations that MTN will have to enjoy lower revenue when other networks get into their calls, their space. I mentioned that. So that's the reason why MTN's revenue they drop. So it's likely that going forward, the revenue may not increase at this rate. So maybe an 11% CAGR may be more representative of the growth in that revenue space. But more and more people will still, more and more people will still be using or be calling into MTN space. Daniel said a combination of CAGR and maybe the growth trend in the industry or MTN's market share of the industry. Yes. Yes, that works. But just that for now, I didn't provide the information on the industry. We can do that as well. So let us not forget. All right. So what we have here, let's just say we want to go with a CAGR. Now, if we want to go with a CAGR, the initial thing we may do is to just go with a constant CAGR and not maybe just average. So let's put in the constant CAGR for each year. So CAGR, we want to do this, age 15, age 16. I think I got it right. Yeah. So I can drag this over a 10-year period, but this will be changed later. And I can also drag this down. So we are just building an initial model, right? Now, so here you comment on the basis of your assumptions. You comment on the basis of your assumption. Why must it grow at so and so rate? Why are you using industry to also guide your assumption? You got to comment on your assumptions. It's part of the modeling process, right? Okay. Now, so that is revenue. Let's get to the next item. The next item, so this is revenue. So we can say that revenue growth. Okay, growth assumptions. Okay, revenue growth. So we come to the next item. And this next item, we want to look at direct network operating costs. This is like the cost of sales then. Yeah. And here, what we looked at for is this, the transmission and whatever and what have not. Okay. We have that. Let's delete the last one here. Okay. Now, with this also, the question is, what are we looking out for? Now, when we get into okay, a chart there, someone said, if you had the industry growth numbers, how would you have combined it with CAGR? Or maybe I could take average of that. Or I may look at industry growth rate and consider if MTN will continue to grow above industry or not. Because if I say average industry growth, since MTN is above the industry average, I can still decide to keep MTN at that level. But then the question is, the government is putting regulations to limit the growth prospect of MTN so that others will also catch up, right? But we don't concentrate on just a single network, and there's so much risk in that. If MTN decides to sabotage everybody, then we are all in trouble. So I will not expect MTN to also grow at a very high rate, right? That's one thing I will not want to do as well. But as I mentioned earlier, we are building the initial model, right? Now, so if you look at the direct network operating cost, let's look at the growth patterns over time. It's also variable, significantly variable. Average 30 versus CAGR of 29, 44, CAGR of 36, 55, CAGR of 15, 85, CAGR of 71. And so the CAGR sounds better to me than the YY. The YY is overstating things. But the question is, what is our objective? Overstate or understate? For now, let's just say we still want to go with the CAGR to start with, right? But then we will present this YY growth there, right? We present a YY growth there. So we come here and we move to the next item. Shift a bit to this side. Then we get a YY. The YY for this period is supposed to be not applicable before, but I didn't put in a formula for that side. And then when we come to the forecasting, we want to go with the CAGR. So the forecasting, we want to go with the CAGR. So we lock the columns and leave the rows. I don't know why I keep doing this. So it's supposed to be 38. Okay. Now, so we get a CAGR here and we drag the CAGR. All right. Good. So then you comment on the basis of your assumption. Why are you forecasting? So there may be times that you forecast that in 2024, it should be this. In 2025, you want to bring it down. In 2026, now we just going at a constant rate, at least just to set our initial model. In 2027, it should be this. 2028, it should be this. In 2029, you could do your own analysis in that sense, right? Okay. Now, so we move then to the next item where we look at the operating expenses. Okay. Now, so I go and pick up for operating expenses. I want to look at handsets up to other operating expenses. So let me just go paste that there at once. And then change this. Now, with operating expenses, again, let me bring the historical YY first. So for operating expenses. Okay. Okay. Now, so the question for the operating expenses is whether we should grow at CAGR or average. So let's look at that of operating expenses to see whether CAGR will still be a preferable rate as which you want to grow as it stands, or a proportion of the total OPEX. That's a bit stable over time, eh? If you look at the proportion, it's quite stable over time compared to the other things we looked at earlier. Somebody will say, well, why not focusing the total operating expense, then taking a proportion for each, because the proportional ratios are, or the ratios are actually stable over time. But then let's look at this too. The growth rate, the range here is from 19 to 21. Here, very bad. The handsets. Then these from 50 to 42. This is also quite volatile. There's high variability here compared to if you look at it in this way. So I think someone put a comment here that he said, what of case when government states that they are expecting GDP growth by 5%, will it affect our assumptions? The point we need to note is what actually drives revenue of the telcos. So, well, of course, people nowadays is about data. Now, the higher the population in the country, the higher the expected usage, right? And the fact that people lean more to MTN, you see a lot of people having to use MTN. GDP growth implies that businesses are going to grow, are going to perform well. If businesses perform well, people get more money. People get more money. What do you think happens? They are likely to spend more. Now, that could also increase data costs as well. They tend to charge more. MTN will tend to charge more on data and all that. And that will bring more revenue to them. So that can also be done. Those analyses can also be done. So please check your YY group for the direct cost. Seems you included direct cost mean numbers, the historical YY I mean. YY for direct cost. Let me check that quickly. YY for direct cost. Yeah, so I'm talking about the direct cost. I mean the total direct cost. That's what I mean. There's no item called direct cost here. So it's a total cost that is, you see direct network operating costs. That's what I mean by direct cost. Okay. Now, okay. So now let's go to, I think there's another question. Let me address that quickly. On the assumption sheet, please. Oh, okay. An assumption sheet. All right. So let me go to the assumption sheet. Direct costs. I included the direct cost numbers. So D37. Oh, okay. D37. This is supposed to be D38. Thank you very much for that. D38. Okay. So D38, this also D38. Okay, thank you very much for alerting me. That's one advantage of working in groups, right? Yeah, or working in teams. Now, so operating expenses, looking at it, for me, a better thing to do would have been to do it as proportional projections rather than CAGR growth. So what I'm going to do, at least to try the proportional side for you to also have a look, is to first take the growth at the level of the total operating expenses, and then whatsoever value I get, then I share it among the various items here. That's what I want to do, just to show you how that also works. So let me show you this. Here, quickly. So we have the operating expense growth. I could actually be fast with this, but then there's no need to do that if at the end of the day, I want you to understand what I'm doing. So we have this growth here. We go to historical trading. We take this growth. We drag that here. Then the rest, I want to focus based on proportions. So I come here and I want to work with the proportions instead. So I come here, I drop that there. I move it. I move this also. Then I took the italics away. So from here, I would rather go pick from the historical trading this data. And that's a proportion, and it must sum up to 100% for each year. Must sum up to 100%. Each year must sum up to 100%. Okay. Now, just a moment so that I can ship this down a bit. Okay. So I can delete this side. Just delete the content in this. All right. Now, so when it comes to forecasting, the interesting thing I can do is just to do the average. So here, because I'm looking at it from this direction, I can directly calculate the average. I don't have to go and link the average from the other side. I can just directly calculate the average of all. And then the following year also will go at the historical average or the average for the previous year, and then in that order. Now, so when it comes to this side, the question is whether it should go at CAGR or it should go at the average YOY. Let's check that. So if it is at CAGR, if average YOY is CAGR is this, I'll prefer to go with average YOY. Since there's no much difference, I'll just go with average YOY. So I'll come here and just do average and start that from here and get the average done. Then what I do is that I drag it. Good. There's a problem. I have to now take this one off, then drag, so that it will be constant throughout. If there are reasons to believe that this will not be a constant growth, you can comment your reservation here. Now, so what are we left with to go for the P&L so that quickly we can go on a break, a lunch break? We dealt with operating expenses and all that. So we can quickly come up with a forecast for P&L. So we're now going to we've moved away from the growth assumptions, and now we are going to look at projections. Starting with revenue projections. So revenue projection is the first item on the list. Now we have made the assumptions for growth, so we have to do with projections starting with revenue. Now, in the historical analysis, we have the revenue items here we want to forecast. So we have that here. We know the historical revenue. We can get it from the historical trading analysis. We have the historical revenue list here. We drag that down and drag that to the right. Great. So we do that, and we can also have a total line for revenue. So that will be sum. I'm always tempted to do the odds plus equal to. It has never been working for me. Okay. So I can drag to this level. And then when I do that, I can underline my thing. The kind of thing I want to use is this one here. To underline nicely. So I need to forecast. We know that we are forecasting revenue based on growth rates. So what do? We come here, we take the previous, we do times 1 plus the growth rates here. We close the bracket, hit enter, we have that. Then we drag it down, then we drag it to the right. Revenue is forecasted. Nice and simple. Now, so we do this, then we need to clean it up quickly. We clean up quickly. Then we have our revenue. Nice and simply done. Good. And secondly, so that our thing looks good and appealing. I don't know why my laptop is not moving. We have this painted. I love painting, trust me. And paint all these things. We have our revenue forecasted. Someone is asking, I would suggest we use Kiga for our OPEX growth as it takes into account the compounding effect of growth, providing a more accurate picture of your company's growth trajectory. Yeah, I agree. I agree, Victor. I agree, Victor. You are not wrong. You are not wrong, actually. I agree. Okay, so you get back if the figures are not looking like were nice. At the end of the day, we can always get back to see. But one statistic, since I'm projecting this thing based on growth, one statistics I want to compute below these is to compute the percentage of revenue. So key performance indicators, I want to calculate percentage of revenue here. So I'll come here, put this, and do key performance indicators. Key performance indicators. And the key performance indicators I want to look out here is a net service network as percentage of revenue. So if error, that I always do, I do this divided by this. Then I lock these along the rows. Then if there's error, it should be not applicable. When I drag this down, I can see the trajectory at the total revenue level. So, okay, so this gives me the proportion of revenue. So over time, based on the projections we are doing, network service as percentage of revenue keeps dominating. It keeps dominating. But if you see, the digital is declining, which is not a good thing, right? Okay, so those are things that we need to see because more people will be using mobile money services. So it needs not to really be declining like that. So it tells us that there's a problem with the projections to some extent. Now, we go ahead to look at cost of sales or direct network operating costs. So we have direct network operating costs. Okay. So with the direct network operating costs, there's some question. I click F4 to repeat the previous format on a new one. F4 is for locking cell. It is shift F4, not F4. Okay. I'm a bit confused here, but let me continue my juvenile SL skills and pray to get exactly what they're trying to say. All right, so we come to this side. We move what we have here, place to the total. We move it to the operating assumptions here. Then we try to bring crossover we have in the historic analysis under this as well. Then we drag it to this level. Then we can sum up the items here. All right, so we can sum that to the end, how we want. Now, when it comes to the net operating cost too, we forecasting it based on growth, So since based on growth, same thing we did, 1 plus the growth rate in question, then bracket close. So we drag that down, then to the right. Now, so we then format whatsoever we have. We format appropriately. We get a total, also formatted. Then maybe we want to draw this as a line. Maybe we want to format the forecast with what we have in the standard formatting. Then we may want to calculate some key performance indicators, also based on proportion. We do the same. So here, we move this to this, and we move this to this. So we can drag this down and to our right. That sums up this as well. So you can start seeing how the key performance indicators are playing out and whether you are comfortable with them. Somebody was unable to download, Isaac. So I think they will address that soon. Okay. Now, so we have our direct operating cost. So I think we can move now to look at the last item on the P&L as far as trading analysis is concerned, which is the operating expense. We go to historical trading analysis, and these are the items we get under the trading. Now, we move them here. So this is what we have when we have them moved to this sheet. Then we ask ourselves, how are we forecasting this? You see that with this one, we're actually forecasting the total operating expenses first before sharing it. So what I would like to do is to first get what the total is to be. So let me create some more space and put total operating expenses here. So over the historical period, the total had been this. So let me put the total here. And this is cost of handsets. Cost of handsets. We have that here. Now well presented. So what we're doing is that we want to grow the total operating expenses. And once we have that grown, based on that, we can determine the values for the components, right? So let's look at how we grow that of the operating expense, the total operating expenses. And we provided that growth rate here. Right? So let me put, I think there's an error, so just that quickly. So then we drag to the end. That gives us the growth. That gives us what the total should be. And then based on this total, you want to determine the values for the individuals. So the values for the individuals, in this case, will be a proportion of the total. So for example, these multiplied by, so since I want to anchor this, I want the rules to be logged, so I can log the rules. This total multiplied by the proportion for handset. So I have that. I hit enter. It gives me for handsets. Start wondering, why is this growing significantly like this? Myself, I'm shocked. Okay. there'll be a problem. There's a problem. So if you look at this, let's see the proportion again. Expense proportion. This is not looking quite good to me. 3.4 as a proportion. Let me see. Okay. 3.4 as a proportion. Okay, now let's look at the growth rate. Let me check the growth rate to see. This is not looking too good for me. If I check the other figures there, like this one, we have here, let me actually try to run this properly. If I look at that of interconnect and roaming, you can see that the growth is cool. If I look at that of employee benefits and the forecast, the growth is cool. If I look at selling and distribution and forecast, the growth is cool. Looking at it from the previous year. If I look at other operating expenses, the growth isn't that cool. It's too high. So I want to investigate some few things again about the proportion. This proportional growth, for example, if I click on this, highlight this, to see what it multiplies with. It looks too high for me. Because then I start to think that there's a problem with my workers. About how the historical growth rates were calculated. So what do? I go back to the historical growth rate for operating expenses. Let me see that of other operating expenses. Maybe something wrongly was paid. So what I have to do is to check whether the proportion is up to 100. So if I check this is 100%. Perfect. But then let me check also here if it is equal to 100. And this is where the problem starts from. Tells you that the wrong thing. This is not equal to 100. So just by looking at my figures, I realize that there's a problem. So the question is, where from the problem? And you see clearly where the problem is coming from. 68, 68. I've picked the same thing for other operating expenses as SG&A. So let me draw down. Let me recalculate this. Now I got 100%. Now my problem got resolved. Now, so if I go back to what I was initially calculating, to see the reasonability of the other operating expenses, it increased was from 90940 to 815. Then it started increasing, which may not also sound nicely. So the whole question is whether the basis for the forecast itself is making sense, taking a proportion. Because it makes sense for the top items here, the middle item, the three in the middle. But it's not making sense for this. It's not making sense for this. Let me get your thoughts. What do you think? Because it's not making sense for the other items. It's just making sense for just the top items we have there. What are your thoughts? Or another way of looking at this to say, okay, so which measure of average am I using? Is it an entire period? Or now that the average is not that much, maybe can I move it to the last 2 years? If I do that for this one, there may be some improvement. And when we come here to, the question is, which other area creates problem? This side. Now, let's look at it now. So you can see that this is now making some level of sense. I mean, for the headset and accessories. Can we sum the individual figures to see if we get the total? Okay, so let's try summing up. Total. I believe we are likely to get a total. if we sum up. So let's sum that up and see. So you see, we've gotten the total, but not in every case. Not in every case, because of how, you see, the difficulty is this. Let me show you. I see what the problem is. So it's good we are looking at this together. You see how we average out this? Let's see. Let's sum up this together. It won't be equal to 100. It's not. It's not equal to 100. It's not equal to 100. So that's where the problem starts from. It's not equal to 100. So maybe we have to discard this approach and rather see how the YY will help us. Okay. So in that case, we may have to go back to the YY because the proportionate is not helping us. So we go to the YY instead of the proportion. I think I have some comments here. Can we sum the individual? Can we check the financials for more information? Maybe we should make the last one the total minus sum of the rest. Okay. Maybe that makes sense. Maybe let me just go back in my Excel and make that change rather. Okay. So what is being suggested here is that the last one here should be the total minus the sum of the first three. Okay. What am I doing? Oh, I shouldn't have done that here. I'm sorry. The total is 100. Just a moment. Total is 100%. So we take 100%, which should be the total, minus the sum of these values here, the first four. Okay, 24. Just a moment. Okay. So let's see how this works. The way I did the averaging is creating the problems. But then I don't want a perfect average. And then I still want some information. I want to be able to get information as whatever I'm doing. So I won't blame myself too much. Now, let's sum up this to see. This is not 100%. And throughout, we have 100%. So we should be likely to have a better forecast. All right, so let's look at the forecast now. So 63 to 87 makes sense. 80 to 1.1, that's not too bad. But then just that the other operating expenses there is quite volatile. Just for a moment, let's just say that is fine. Just for a moment, let's go do other stuff to see how they will also be looking like. Yeah, so we can calculate YY growth for the purpose of the key, because we are forecasting based on the proportions. So if we want to calculate a key performance indicator, a better thing may be to do a YY growth. So let's look at the YY side of growth. So we come to the historic analysis. Then we pick the YY growth as we have it. Okay, the YY growth. So we come to assumptions. We have the YY growth. Okay, so we bring this one here for the headsets, bring this one also here. Give us the YY. Then drag it here, check whether everything is fine. Yes, everything is fine. including the last year, everything is fine. Good. So we need to put here key performance indicators. Okay. Then we can then drag across. Now, so dragging this across, you see the high variability in the historical period, but then the forecast, we expect some level of stability, and all of them are growing at the same rate, which may not really make that much of a sense. But as I mentioned to you, the initial model you build in, there may be these nuances. You just have to take your time all through. When you are done, then you can better evaluate the final result. This is just the initial thing we are building. We have a lot to do in terms of even doing cash flow risk assessment. Okay. Now, so we are done with the key matters in the P&L. And one thing I love to do is, after putting these things together, I want to do some summary to see how my P&L is looking like. So P&L summary, or profits or loss summary. Let me see something here. So I'll have my revenue. So I'll less my network or direct network operating costs. Then I'll less, then that will give my gross profit, but well, let me put gross profit. Then I'll let my operating expenses. Then I'll get my EBITDA. So I'll get my EBITDA. So let's just put those things here to see how P&L and all that are looking like as it stands now. So direct whatever costs, we put that here. Then the next one is the operating expenses. We put that also here. So at the end of the day, what am I doing? Operating expenses. We put that here. So to get gross profits, it's just a matter of summing up the top two, since one is already negative. So we can do that to get a gross profit side of things. We get a gross profit. And we have also for the EBITDA, to get the EBITDA is just a summation of the gross profit and the operating expenses. So we have the EBITDA as well. So operating expenses, we drag that also. Now, let me check something quickly. In my custom, to custom my numbers. Okay, I have the name. Okay, so thing is not quite working well. Now, so I want to change, I want to remove those negatives by my figures. Yeah, so convert it rather to, I'll put the brackets rather than a negative sign by my figures. Okay, good. So I have my EBITDA here that I've computed. So here also, I do my painting as usual to differentiate between the historicals and the forecast. Well, of course, I can do some KPIs. I can do some KPIs. If you are like me, so one of the KPI will be gross margin. Gross margin percentage, and also I'll look at EBITDA margin percentage. I like to do that. So that'll basically be gross margin will be this divided by this, and EBITDA margin will be this EBITDA divided by sales. Anytime we see margin is all a percentage, right, of sales. I mentioned that at the inception. Okay, good. Now, so if you see the EBITDA trend, we have 87, 88, 89, 87, then 87, 86, 85, 84, 83, 81. It's actually declining that's gross margin. The EBITDA, we have 55, 55, 56, 58, improved to 60, 64, some level of improvement here. So it tells you that the rate of growth in operating expenses is not that matching. It's an area that we have to revise those assumptions, go back to relook at those assumptions to ensure that, well, of course, the operating cost side too is also growing appropriately. So someone said the average is being affected by 2022 figures where the country had high inflation, so we can go back to the 2021 figure. Yeah, Felix, that's a great observation to make. Putting in some macro consideration, a great observation to make. As I mentioned, this is for tutorial purpose, so there are lots I should have been covering that may not be covering here. Just one moment. All right, so there was an interruption, so I have to address something quickly. Now, so that's what we've done. So generally, we have forecasted a lot of items. We have forecasted operating expenses, we forecasted cost of sales to say, and we have also forecasted revenue. So generally, the P&L has been done, in exception of issues of task that we look at when we get to the task side. The P&L has been completed. So we are going on break. When we are back, we will start by looking at the working capital side of things. And then from working capital, we look at Capex and depreciation. Then we do some amortization of debt. And then we'll put everything together. Then we do some cash flow analysis. So let's take a 30 minutes break. We'll be back 1:30. We'll be back 1:30 to continue from where we are left off. Any question? So this is quite easy, really quick and easy. Any question? Okay. Are we ready to go on break for 30 minutes? If you're ready, we are coming back 1:30 p.m. or 1:30 GMT PM or whatever. Are you ready? If you're ready, give me thumbs up or say something on the chat. In the chat to show that you are willing and ready to go on break. Let me see something. Okay. Wahab. Okay, cool. Ready. Yep. Felix, George, Evans. All right, great. Uche, ready. Emmanuel, Tay. All right, thank you very much, guys. Let's get on break. Let's be back 1:30 p.m. GMT. All right, so welcome back. Welcome back. I hope you had a great time at lunch. Can you see my screen? Welcome, Victor. Yes, if you can hear me, put something in the chat. Anthony? Yes. Okay. Who else? Yes, I am. View your acres. Yes, I am viewing your acres. Oh, I don't know how that means. Yes, welcome. Yes, yes. All right, Edward. All right, all right, all right. Let's get into it. So we done with the operating statement matters. Let's get straight to working capital. And then with the working capital, we need to make assumptions around growth, around the working capital days. That's how we intend to handle that of the working capital. Make assumptions around the working capital days. All right. Let me move this to 150, set it properly. Okay, good. So let's call it this working capital. Capital is our ratios. Maybe we can call it ratios. And then here we have, or maybe we can just call this place assumptions. That's working capital. And here we have working capital ratios. Working capital ratios. Now, so we can put in the working capitals. So from the historical trading data, we have the core working capital and the non-core working capital. So maybe let's go back and put that distinction there. So we have the core working capital. So we're talking about the core working capital. And then so we can have non-core working capitals as well. Now, so the core working capital from the historical trading, we have, and what we are interested in actually has to do with the days. So with the core working capitals, we have the days in year and all that inventory up to payable days. So we copy that and paste them here. Now, so days in a year, we know that to be 365, or we can just go and pick it. Let me bring this down. Okay. So 365, just go and pick that one up quickly. And the days we've calculated, let's bring them all here. So we calculated inventory days, we've calculated receivable days, and we've calculated also payable days. So let's bring them here. So these are the days calculated. Good. And the days in the year are also here. Now, so we need to now do the forecasting. So I want to hear from you. How do you think the future is going to evolve as far as working capital is concerned? Should we do average or how? Yeah. So let me see your comments on that. Please, where can we have the recordings? Well, of course, you can get on YouTube actually. Okay, someone has just provided that. Now, so I'm putting a question there. How do you think we should grow, or we should look at the movements in the inventory, receivable days, and payable days? How do you think this should be looked at? Let me hear from you. Because I know clearly for the days, it's going to be 365. So that's not a problem. 365 days. How about the inventory days, receivable days, payable days? Should we take the average or hot? And if average over hot period, are we taking average? So Anthony said receivables quite stable, so average is okay. I agree. Daniel said receivable days and payable days are fairly stable, so we can use average. But for inventory, we should investigate. That's true. And the Olayinka said average looks good for receivable and payable. Agree. So we take average for average. We take average for payable, for example, and we do the same for receivables. See how it looks like. Okay. I love the thought process. I love the thought process. Now, so when it comes to inventory, we need to investigate, right? Now, there are issues with inventory because, see, inventory, when we're calculating inventory days, we did the inventory divided by cost of sales. But then the cost of sales item is not quite, it's not every component of cost of sales that we run into inventory or that has a relation with inventory. That's why we have those troubles. But I mentioned earlier to you that when you looking at inventory days, the best measure on the P&L should be the item that relate to inventory. That is the cost of sales, not entire cost of sales. But here, but for the purpose of approximation, and of course, which we also use in practice, we just use the cost of sales in total to handle that. So someone said, Victor's average is best used in working capital. Well, yes, average is best used, but if we look at what we're seeing in inventory, if we take average, for example, let's see what we have with average days. If you take the average, this thing keep popping up. Okay, so if we take the average, we have 15. It seems 15 is a decent thing to use. Moving from 18, so from 18 to 15, it's not too bad of something to use. So maybe we can use the average here. Okay. We can use average here. Now, so we're not doing badly at all. Okay, so let's do some mental work here. Now, so we can go ahead to do the forecasting and go ahead to forecast the working capital now. So we come here. So here is going to be projections. So this will be projections, working capital. So let me just do that quickly. Projections, working capital. So let me copy the headline here. So projections, capital projections. Now, so we have so what we're going to be having, if I can go back to, I think there's a chart. Somebody said the payable days should be constant. Yes, if you say should be constant, you mean the forecast, right? Oh, okay. I think I made a mistake. And the same thing applies to these two. I was doing average of averages, like moving averages. Thank you very much for that observation. Now, so, okay. Now from here, if I go to historical trading, I have the inventory or I have the actual description of the items. I move it to the working capital here. Then I take my time to link the historical values as I have them here. So I do that to this point. Now, going forward, oh, there's one thing I should have done. Oh, sorry. One thing I should have done, which I've not done. Which I've not done. I want to quickly do. I don't understand why I started working in this way. There's a way I intend to forecast this. And suddenly, I started doing something else. So let me put this in here. Let it be here. And then with that, we can just draw the ones at the top here, days in year. And then next thing we do is to take them one by one. So we have in trade, or we have in inventory. Inventory is the first one. We can put inventory at the top here. And we know inventory will go with direct operating or network operating cost. Then the second item will be trade receivables or trade and other receivables. So is going to go with revenue. Then the third item will be trade and other payables. Trade and other payables. And if you recall the trade and other payable, we didn't use just direct network operating cost. We used direct network operating cost plus the operating expenses. So let's just call that total cost. Now, let me shift this twice or 4 times to the right. This also 4 times to the right. I think it's actually 5. Okay. And this 1, 2, 3, 4. 4 times. Okay. Now, then we have changes, or we have what we call net working capital. We have our net working capital here. Then the next thing we do is changes in net working capital. Now, so let's bring the things here. For inventory, over a historical trading period, we have this value. So we can drag that for historical trading period. And for receivables, a historical period, we have this value. So we can drag that over a historical period. For payable, over a historical period, we have this. Payable. We have that here. Now, so we drag that as well. Okay. Now, what's the direct network operating cost over a historical period? So that one, because we have already created the operating assumptions, we just go there straight and fetch that information. So direct network operating cost, we can fetch it from here. And in fact, it will even give it a forecast. It's able to provide us even with the forecast. Revenue, we can go to the same operating assumptions and then fetch the revenue. It will come with the forecast because we have built those models already. The next item is a total cost, which is the operating cost plus the direct network operating cost. So, sorry, operating expenses plus the direct network operating cost. So we go back to the operating assumptions and we pick the direct network operating cost and add that of the operating expenses to it. Now, that is this. We'll put it here. Let me format my things properly. Okay, good. I think some of the things are not formatted. Let me handle that quickly. Okay. Now let's look at the net changes or net working capital. That is the current asset component minus the current liability component. So inventory plus trade minus the payable component. So this is what we do, right? Good. All right. Now, so the next thing to do will be to look at the changes. Now, we understood from, or we were told, or I told you, or I reminded you from the previous sections that if we have the net working capital growing, it means that more working capital is required. So that's a cash outflow. So how we calculate that is to take the previous minus the current. Because if the current is more than the previous, it means you require additional investment in working capital, and that becomes negative. Okay. Now, that is the formula we place in there. Then we drag. So whatsoever we find here is the investment we require in working capital. Let me format this properly so that we can all see the actual values we're dealing with. Okay. So go to custom and we pick this one here. I think this different one. We pick this one. Okay. Okay. You do the same custom. These things I never like doing them because they are quite tiring to do. Okay. Good. Now, so what I can do, I want to bold the very things I need. So I bold inventory, I bold trade receivables, I bold trade payables, I bold net working capital one. That one I'm going to bold those. Now, and again, I want to calculate the inventory for the forecast period. Now, what do I need to do? I already have my inventory days here. If I divide my inventory days by the 365, then I get it multiplied by the denominator. That will give me the value of the inventory I intend to keep. So, but because I don't trust Excel's board mass, sometimes I put my things in brackets properly. Now, so when I multiply that, I get my inventory values. So this is what I have. Okay. Now, so when it comes to receivables, I do a similar thing. I take the receivable days divided by the 365, the number of days in a year, number of trading days, multiplied by the revenue below. That also gives me my receivable balance. Go ahead to do that for the trade payables. I take the trade payable days here, I divide it by the number of days in a year, then I multiply it by this value I have here. We have it here. So you see clearly that in some of the years, there is no need for working capital investment. In fact, you actually withdraw from working capital to finance your operations. In some years that we have negative cash flow means that we need to invest 117 million in working capital. Here, there will be a release from working capital. Here, an investment is required. Here, there'll be release. So each time we have a release from working capital, we have a positive cash flow in. When we have a negative working capital or a negative change, it means that we have a negative cash flow. There is a need to invest that amount in working capital. And that can be financed from operations, operational cash flow, or the cash flows from operations, or any other means, maybe from financing, or maybe sale of assets. Right. Now, so let me just do my final touch. So what I love to do is to draw some lines, not necessarily a very thick line, something like this, between them, something like this between them, something like this between the figures, and finally, something like this between the figures. Now, why do we need to do all this? You know clearly that the numerators, inventory, receivables, payable, they are going to balance sheet. The changes in net working capital is going to P&L account. Sorry, it's going to the cash flow statement. It's going to the cash flow statement. Okay. Now, we have other components of working capital. Let me check if there's any question so far on what we just looked at. Someone said, Anthony said some base inventory days divided by amount of the next period's cost of sales instead of historical cost of sales. Explanation is that based on your projected activities in the next period, you like to acquire the inventory in advance. Your thoughts? No, you see, I understand your point, but you see, what we try to look at is that we are looking at what is the value of inventory outstanding from the trading period. So you must use the total cost of sales for the period. You know, revenue, trade receivables only is quite easy to understand, maybe to use to explain these things. That if I've sold during the year and I've sold 1 million, I'm asking myself, out of the 1 million revenue I've earned, how much is actually receivable? So it's not a future thing. It's more of, as per the period under consideration, how much is outstanding? Same thing applies to the inventory, right? Victor says we can also go to accounting and pick for negatives. We can also go to accounting and pick for negative. Oh, okay, great. That's true. I was thinking the net working capital for 2021 should not be in brackets. Net working capital for 2021 should not be in bracket. Let's see whether that is true. Okay. So if you go to the for 2021, if you go to the working capital workings, let's look at what's happening. There's a decrease in working capital requirement. That's the whole idea. There's a decrease in working capital requirement. So because a decrease in working capital requirement, that's more of a release of working capital. It's quite counterintuitive, right? Now, let me give you an idea of why that is true. If you see all these areas, you can see that whenever there's a decrease in working capital requirement, the corresponding thing is a cash inflow. It shouldn't always be like if net working capital position changes to positive before you say that, well, there's a movement or whatever. It can still be negative, but if the level is dropping, it's a good thing. So if it is positive and the level is rising, it's a bad thing. Right. And if it's a negative too, and the level is rising, actually it's a good thing, because if a negative is rising, what I mean is that it's turning into positive. But if the negative, or you continue to get into the negativities, then it means that working capital requirement is actually you realize that the working capital requirement is actually improving. Now, what I want to say here is this. If you look at this, they needed 749. Now, what additional working capital? But now, additional working capital needed is 631. So there's a reduction in the level of working capital needed. Right. Okay. Now, let's get into the other component of working capital. But just a moment. Okay. Anything more in the chat? What he's actually saying is that don't forget the value is in negative already. Oh, I'm sorry. So oh, come on. I think maybe I have to refresh my words, what I said earlier. So the reduction in the value, we need additional working capital, but the additional working capital we needed is 117 million rather than what we don't need, or a release. So a drop in this value means we actually need more working capital. I'm sorry. That is about 117 million. I asked that because the formula for change in working capital is the previous, the current. If it's negative, it should be around. Oh no, so because we're taking a negative number out of a negative. So negative times negative will be positive. That's why we have like, it's simply to say negative 749 plus 631. So the answer is still negative this. So if you can see the formula, you see what I've done? This minus this. Because we are subtracting negative from negative. The answer actually the second negative will be cancelled out to positive. So it's all right. It is clear now. Okay, good. Okay, so now let's get to look at the other component of working capital. Let's see. So in the historical analysis, we discovered two other components of working capital, which is the mobile money floats. Now, so non-working capital, like the mobile money float, let's look at it. So we go to working capital here. So we are still on working capital projections, but this is for non-core. Non-core, I told you that I'm not saying that mobile money float is non-core, but then this for operations purpose and all that. I just want to separate it from the traditional working capital component. That's what I'm calling the non-core, right? So non-core working capital. So there we have two items we want to handle. And these items are the mobile money float, which is more of a current asset, and the obligations to electronic money holders, which is which is a current liability. I'll almost say in a non-current. So we have that here. Now, one thing I want to say is that I think we have done analysis of that. If I get it right, it seems we did some analysis. Yeah, we did some analysis here when we're looking at the key performance indicators. Now, so one thing we can do is to bring that analysis first to bear. So we are going to, in the working capital workings here, we'll bring in the analysis first. So this is the why we did. So this is YOY for the mobile money float, and also YOY for the obligations to electronic money lenders, money holders. And so we go to historical analysis and then just pick the YYs that we've computed earlier. Then we decide on appropriate way to, to forecasting them. Okay. Okay. So this is what we have. And this is the growth rate we computed. Okay. So just to check whether everything is fine. Yes, everything is fine. And going forward, how should be the growth rate? If I should ask you, going forward, how do you think is the growth rate? If you look at a historical analysis, the CAGR is 35, average is also 35. So in this case, as I mentioned, both CAGR and average growth is 35. So we can just go with the average, 35. 35 here. It's approximately 36, right? But then if you check, it's 35 point something. Now, based on this, we're able to forecast the mobile money float. So let's do that now. The mobile money float and the other one. Now, so let's bring the historical figures here in the historical trading. It's the same amounts as we saw earlier. Then we now grow, we take this, we multiply it by 1 plus the growth rates as observed here, bracket close, and then we grow. Same thing applies here. So we grow, we just drag it down. Same thing. I see. Any question? Any question? I want to possibly address any question that anybody has before going on. Any doubts anybody wants to express on anything at all before we go at it? I see. So in other words, let me go into that to check what is being said. Okay, so why am I having, okay, I can see the distance now. All right, so a question here, any of the two work, however, let's use average. Okay, so in other words, so can we also forecast Momo float as a percentage of Momo revenue? No, no. The Momo revenues are more of charges. It has not, it will be difficult to do something like that. It's not quite an appropriate way of handling it. The assumptions of 2025 onwards has to be in percentages. Well, okay. It's in okay. Okay, thank you. So it's a matter of just converting it. This in decimal, so let me just apply the percentage to it. Thank you very much for reminding me. All right, so this is what we have. Now, this is one thing I want to say. You see, this thing will have no impact on the cash of MTN. It has no impact on MTN's cash. You know why? Because this is current assets. If it increases, and this one reduces, current liability reduces, and they are all increasing and decreasing by the same amount, they cancel out. You get a point? So an increase in the current asset here will mean that cash is going out. And an increase in current liability means cash is coming in. So the sum of the two is actually zero. So it has no impact on the cash flow statement. Yeah, that's a contra entry. So we don't really have to care, from Lucy, we don't really have to care about the impact on the cash flow statement. So to even calculate changes in this capital or whatever, it's not necessary. All you have to do is to put it on the balance sheet, and then we are cool to go. At the end of the day, it's the same impact. We are adding the same amount to current assets and current liability, so nothing will happen. Okay. Stephen said, is it good to separate line? It is good to separate line items non-related to revenue, and those are forecasted using the YY. Yes, of course. Now, so we are done with the working capital items. So we're almost there. Let's move to the next task. The next task is to look at depreciation. But I want to first look at funding. And from funding, we come to depreciation. So depreciation should be the final thing we handle. Then we can put our model together. But as I always say, the most important aspect of modeling is all we're doing. That is the assumption side. Putting a model together is a matter of just linking every other thing to the P&L and the balance sheet and the cash flow. And that can be done in 5 minutes when you are done with every other thing, right? Now, so let's look at their debts and see what they have. So on their financial statement, we see, let me reduce the font a bit. Okay, on their financial statement, get to their balance sheet, you see the borrowings here. They have some borrowing, and they have been paying down. They're left with just 73 million. Just 73 million Ghana cedis here. And there's a current liability component of this borrowing, and that's 158 million. So they expect to, in other words, settle this 158 million in this 2024 financial year. Now, so we need to understand whether they have some information on these borrowings. If I say they have some information on the borrowing, I mean the interest rates and the number of years outstanding for this borrowing to be fully paid down. So let's get into the audited or audit report. Now, so let me reshare my screen, share the financial statement. So we get to the balance sheet. The non-current, we have 2.26. That is what it is, 2.26. Note 2.26. That's what we find. You find that 2.26. 2.26. 2.26. Now, so this is what we have the borrowing. Now, so let's look at the borrowing. What is this about? And there are several types or several information there, but then not all of them will be relevant to us. So let's read through. Let's just read through and see. So borrowings are initially recognized at fair value net of transaction costs incurred. Borrowings are subsequently measured at amortized costs. So there are just a lot of information here on borrowing, which is more accounting. Okay. Now, so let's see what they have here. They have summary of borrowing arrangement. So I think that is what will interest us. So summary of borrowing arrangement. They have additional facility, additional term loan of 450 million, bearing interest at 34.7579% per annum, repayable starting 24th December 2022 and expiring on 24th June 2025. Right. Now, don't forget their year end is 31st December 2023. And they have this take that it took on 24th of December 2022, and they must be done paying by 24th of June 2025. Now, so when you look at that, you see that this is a 2.5-year loan, right? A 2.5-year loan. So because by 24th of June 2023, that is half a year, then we have another 2 years in addition, so 2.5-year loan. The facility is secured on total asset less float. Okay, less floating asset. Okay, good. So that's just the some additional terms that we may not need for the purpose of the work we are doing, right? Now, so movement in borrowings, we are concentrating on the group side, right? So at the start of a year in 2023, the borrowing was 375, and then repayment on borrowing was 150. At the end, they have 224,997. Movement in capital transactions, and there are more of additional matters, the amortization for the year and blah, 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 several other stuff. Interest accrued. Well, no more details are provided as to how some of these things have been done. But then all we know is that they have some debt they need to pay by 24th June 2025. What I'm going to do is this, that I'm going to assume that this outstanding amount here is going at an interest rate of 34.7579. I assume. And just so that, or for the purpose of us doing the work, this loan will expire by 24th. So let's assume that that is also going to expire 24th of June 2025. Beyond that period, there's no loan. So let's be guided. That's what we're coming to do. Beyond that period, there's no loan. Okay, so let's look at it. So we have this figure here, which they'll be reporting, which is 224,997. I think there's some breakdown here as well. And so they have the 224,997, and then there was some kind of movement here on amortization and interest accrued for the period. And the balance at 31st December that goes into the balance sheet itself is 231. Now, that is grouped into current assets, or current liabilities and non-current liability, with the current side being 158 and the non-current side being 73. Okay. So we have the interest rate 34.7579. 34.7579. Now, so let's go back to our Excel and see how that works. So 7579. Just don't want to forget some of the details. All right. So let me pick this. Sorry. Let me pick this, and then I move it to funding. Place it here. I increase this a bit so that you can see whatsoever I'm doing. So I move this, I mentioned, or this here, I call it funding. Now, so funding, I want to treat the debt side first. So what am I going to do? I have just one debt instrument. So that is simplifying my work. So type of debt, well, we can call that, sorry. So yeah, let me put here debt. So here we can start with type of debt. And the type of debt here, we can call this term loan. And let's say the principal amount. So for the principal amount, we have that on the balance sheet. And that is both the current and the non-current. You add both together. So the current is, maybe let me just link it to that side. There's a question. Somebody, okay, thank you very much. Thank you very much, Victor, for putting that there to really help me. Okay, so maybe let me just come here and I can go and add. So for the borrowings on the books, for the current, that's the current side, and also for the non-current side here. Let me add both. So I have this, right? Now, interest rates. So already someone has done a job for me. Victor has done the job for me. I'll come here straight away and look for the interest rate. The interest rate is 34.7579. 7579, 34.7579. So 7579%. That's the interest rate. Then the remaining tenor of the loan is 2.5 years. Now, there is a way I want to handle this. So that I can make it a model that I can easily adjust with the timing. So I'm going to assume that the remaining tenor, and the loan is amortized on monthly basis. So the remaining tenor, I want to assume that the remaining tenor will be the 2.5 years expressed in months. So we know that we have 12 months in a year, and therefore for 2.5 years, we should be having a total of 30 months. So the remaining tenor is actually 30 months. Let's put that here. So 30 months. So we can do the remaining tenor in months. So that's going to be 30 months. I hope that's clear. And then now we are doing amortization from the period in December. So let's just say the amortization is going to start effectively from January. Okay. Now, so starting dates for amortization, that's the remaining period, right? Because the figure we have here is a figure at the end of the year. So if we want to do the amortization for the remaining period, then we must be starting from January. So the starting date is actually January. So we are looking at 1st of January, 2024. 1st of January, 2024. That's the starting date. Now, let me see if I can format that time maybe to an appropriate whatever for me, but maybe for now it's fine. Now we have the starting date for whatsoever we want to do. So we can go ahead and draw amortization table or how we want to go with amortization. So, of course, we have years. And having years, one thing we can also have is the months. So we're talking about the months in a year, maybe starting from January up to the final month over a 2.5 year period, right? So we have a month here. Then we can also have days in a year. Or maybe when we start with months, we can have days in year. Then when we have the months, then we can have these in months. Great. I think there's a question here. Opening principal. Oh, not yet. We've not gotten to opening principal yet. Now, so we have this in year, we have months, we have this in months. Okay, so here we are able to calculate the number of days in a month. Then the next one, we have usually this could be floating rate, but thankfully for today, this is a fixed rate bond, a fixed rate instrument. So this is not floating rate. So since it's fixed rate, we don't even need to introduce the interest rate in this column. If it were floating, we will have to do that. If we were floating, we will have to get the interest rate and do some simulation around interest rate in the column here. So based on that, we can just quickly move into the principal. So opening balance. Then if there are any additions to the loan in the period, we can call drawdowns. That is added, then we can have the amortizable balance. Then interest accrued on that balance. Then we also have interest paid. Then we have principal paid. Then we have closing balance. Then we can add other things like cumulative interest accrued. We can add cumulative interest paid. And finally, we can add cumulative principal paid. We can add all these to it. Okay. Now, just to make this, look at this properly here. And align these things properly for our amortization table. Okay. All right, so then the last one, cumulative. Let me just do the two decimal as I always do. Okay. Good. So we have our headers. We have our headers done like this. So maybe we can do some coloring, right? Maybe we can use black for this purpose. And the writings will be in white. Okay. Nicely done. Now, since we are doing amortization from January, and from January to December, the year is December, it means we have 12 months. We have 12 months in the financial year. So what we do, the starting period. There is one last thing I wanted to ask, I didn't add, which is the grace period. So in case there's grace period, we can have that too. Grace period, or what we call the moratorium period. And here the grace period is 0. All right, so we start from here. To get the grace period is supposed to be 0. I have to format the page here. Okay. Now, so to get a days in a year, we know we want to work with the difference, the issue with we can use this formula, this in year. Let me see whether this function could help us. This in year. Yeah. So one thing I can do is to let me just see. Or is it this? I think there's a formula, it's short for somebody put on the in the chat some moment ago. Some of these things doing, just forget all your formulas. We want to get a number of days between the years. All right, so if somebody can put it in the chat, that would be great. That would be quite helpful. Otherwise, there is no need. All you have to do in some of the loan agreement you see, they can tell you that the convention, and let me put it there as well, which MTN didn't disclose, but then those are additional terms that can be disclosed. I want to quickly put here. You can see something like day count. That's one thing you see in loan document, day count. And day count, they can tell you actual versus actual. Or usually you can see actual versus 365. Or actual by 360. We have that as well. That's one way of looking at it. Now, so here, I want us to do actual by 365 for this loan. So the actual by 365 means actual number of days divided by 365 days. Right. Now, so let's get the days in a year. It will purely by that 365 days. You don't need to worry about days in a year for each of this year. So you just get your 365 days. Now I'm looking at 2.5 years, which is actually 30 months. So I'm going to do this numbers here, just up to 30, just to help me carry out a task. So I have up to 30 here. So this will also run up to 30. There are 365 days in a year, in each case. Now, the months in question, we use the EU months function. We take the starting months. Now, the month starts from 1st January, and I want an increment of 1. Let me check this properly. So I can use the short day function. It gave me up to 29 of the, but then this is not what I want. So another way of handling it is to change the starting date here to 31st of December, 2023. If I do that, the following one is 31st of January. So I start with 31st of December, 2021. Of course, so I'm able to get whatever I'm looking for now. So going forward will be these. There are 2 ways I can still handle this. I can just do this, comma. I'm sorry. So I can just do this EU month. If I pick this, then comma, the numbers that I've written here, then I close my brackets. Then in this case, I can actually drag. So it will give me all the days, but then I have to log the first one. I'm sorry. So I have to log this here. I have to log it accordingly. Then I drag. So you could see the dates here. And from here, I can calculate the number of days between dates. So I do for the first one, then going forward, I can do for the subsequent ones. This, and I can drag down. So just check it out. Just 1 minute. Okay, I'm back. Now, so this is what we're doing. And I hope to this end, we are still on the same page because this is not different from what we've been doing since last week. I think last week we handled this. So this is not different from what we did last week. Okay. Now, there is a way I want to improve upon what I place here. Maybe I should just rework something out here. So I gave you the time that, or we saw the time that the debt must be fully paid off. And that is 24th of June. I think 24th of June, yes, 2025. Maybe we can add that also to this these items here. Okay, so we can call that final or loan due date. Should we call it loan due date? Also, we can call it maturity date. Okay, so if we call it maturity date, that will be 24th of question maturity date. Okay, thank you very much, Victor. 24th of is June 2025. We have that here. And we can actually use a function to determine that. We can use the date if function to actually determine that the number of months between the two dates. So this will be this. Then this. So it have to be dated if. I made a mistake. Dated if, yeah. Now, so you use a dated if function. This, comma this. Then the last side, you have to specify what you need. So I need it for months, so that it's able to calculate for me the number of months between today or January 2024 and the final date, which is 24th of June. Of course, approximately I should be getting like 30 months, which I indicated earlier. Now, I think there's a bit of a problem. This will not really be correct. This will not really be correct because if you look at from 31st of December 2023, oh, I think I really make a mistake first. So that's supposed to be, so 2.5 years. Is it 2026? Let's check whether it's 2026 rather than 2025. It's correct. Okay. Maturity will be in 2026. Let's check. Just be a bit confused here on what we just read. Let me check what we just read again and to see. Oh, 2025. It's 2025. Oh, okay. So starting on annual repayable starting on 24. Okay, I was swayed by the 2022 there in the book. So I thought it's supposed to be 2.5 years in all cases. So actually left with 1.5 years, not 2.5 years, left with 1.5 years. And 1.5 years is 18 months. But then the point is that because the maturity date is on 24th and not on the last day of June, is giving me 17 months rather than 18 months. So we need to really go with the date classification itself as 17 months, right? Sorry for that. I was seeing this as 2022. That's why I was thinking of the 30 months earlier. So this is fine. It's not entirely 18 months. The absolute number of months is 17, as we have here. Okay. Now, great. Let's continue. So having this down, we can also have in 2024, we're starting from January up to December 2024. So then we can wrap and maybe do some centering. And 2025 carries the rest. And we don't need the rest of these items here. Now, so opening balance, can have the opening balance here. The opening balance is actually the figure we have here. is the opening balance. There's no drawdown. Therefore, the amortizable principal is the sum of opening balance and the drawdown. Accrued interest, very basic. We are doing actual by 365. So actual number of days in a month divided by 365 days in a year. What did I just do? So E. Okay. Then we multiply that by the interest rate. What's the interest rate? Is this, and we log the interest rate. This is a fees rate. So if it is floating, that's where additional considerations need to come in. Then we multiply this by the amortizable balance here. Now, just a moment. Now, what we're doing is very simple. Now, we can build this worksheet as we did the other time. Can we deannualize the rate? Yeah, that's what I've just done. I deannualized the rate. That's the reason why I took the number of days divided by 365 and multiplied by the rate. I've annualized it. So I've gotten actually a monthly rate I use for the work. Now, we can build this worksheet such a way that it becomes self-balancing. So we can try a lot of things to do to see which one works best. We can do that. That will call for the fact that we can set that. Just a moment, set. Okay, no. Okay, so this is the reason why we can't. A colleague is just telling me maybe idea about what to mean by de-annualizing a rate. But then if we see rates, the rates stated are actually stated rates, they are not compounded rates. They are not what we call effective rates. No, they are stated rates. If it is effective rate, that's where we de-annualize it by doing the reverse compounding, which is more. But then these are rates stated these are stated rates. They are raw rates. So we all have to just divide by 12. But then because we are using day count conversion, here we do the days divided by 365. And then we multiply. Okay. Now, just a moment. Okay. Now, this is all we've calculated, which is correct. So let's drag it. And the interest paid is just by negating the interest accrued, and we are good to go on that side as well. Then the principal paid, we will need to treat that as well. Let's assume that this principal is going to pay the equal installment. Now, in equal installments, all we need to do is just to take the amortizable principal and divide it by the number of months or the remaining tenor. So then we have to log both. Both must be logged. So when we drag, it stays constant. And we put a negative sign by it so that the payment will be negative. So we have that also down. So we can drag it. Then the closing balance. So closing balance will be the amortizable balance plus the accrued. Since the interest paid is in negative, you add it. And this one to negative, you add it. So we drag that also down. Okay. Now, so the closing balance then becomes the opening balance in the next period. And you drag that also down. And then the amortizable principal too is dragged down. So our expectation is that by the 17th month, we must have finished paying. And let's check whether that is true. So this is the point that we were done paying. This is the point that we were done paying. So if we trace these points, you see that at the end of the day, it's going to fall in the 17th month. So you see it here clearly. So these are months, the 17th month. That's the year in which we're done paying. So that's very clear. Okay. Now, but you see, let's continue with the rest. Then I'll show you something. You see what just happened to me? Because I indicated that the number of months over which I'm going to pay is 17. is lower than the 30 months I placed here, there are a lot of other calculations that are done below. And I don't like this. I want this to be self-balancing in that if I change the tenor, all these areas will tend to zero. I don't want them to be calculated for me. Before we look at that, let's complete the statistics. So the accrued interest, we have that here, and we want it to be cumulative. So we add this to the accrued interest here. So we drag it down. So when it comes to interest paid, we do the same thing. Get an interest page, and the cumulative interest page, we have this, and add it to the cumulative interest page and drag it down. Now, when we come to the principal, we do the same. Pick the first principal. The second one is a cumulative. The first, addition of the first and the second principal. So we've done that also, like this. Okay. Now, having done this, as I mentioned earlier, I want my thing to be self-balancing. So there are some controls that I am going to put into this to ensure that whatsoever I'm doing is self-balancing. And I have to start the controls from this area. Now, I must state that, and also for some reason, I need to really do this. Otherwise, it will create problems for me later when I'm doing other things. So I'm going to include some if statement. So if, and with the if, what I want to do is that I want to check that if the number of, or the remaining tenor here is greater, that's very important to me. If this remaining tenor is greater than these, then continue to do this for me. What I'm trying to say is this, that I want this calculation or these months to be displayed only when the number of items or the numbers are written here are below 17. If they're above 17, you stop giving me numbers. And what you should rather give me should just be 0. So let's see whether that works. But then I have to log this first number here. So if I log it, I'll be able to give me what I want. Okay. I think there's a bit of an issue. Let me resolve that quickly around this. Humans choose, yes. So I think I put a multiplication sign here, which is supposed to be a comma. Okay. So now the rest must also follow the same thing. For some reason, I have to drag just for the first one, then check something. What I want to check is that, for example, there's some moments. Now, the date I place here as the starting date is locked, so I have to move it. I have to move that back to, this is to 13. Okay, so this 13 must change to the date I have here. Oh, okay. I think it's fine. Good. The approach I'm using here is fine. So you're going to see something soon that is happening. Now, so I'm saying that this 17 here, as long as this 17 is greater than this figure, continue to give me this month here. Otherwise, give me 0. This is supposed to be 0, but because these are date formats, that's why it appears to be giving me 90 something. And if I take the date format away, it is 0. And these are some of the challenges I have when I specifically use this laptop for some of these things, because it's supposed to just give me 0, 0, 0, but then it ended up giving me date, which I don't really feel comfortable with. Okay. Now, so when it comes to the days in months as well, I want to do a similar thing, that you only calculate the days in months for me as long as this figure here is greater than, but this one greater or equal to, for some reason, is greater or equal to the figure here. The same thing that we just did. So if that is the condition, then calculate that for me. So I'll log this one also on this. Otherwise, whatsoever you're doing should be 0. Otherwise, it should be 0. Let's see how that also works. Okay. So the second one is not picking this. So D21 minus C14 is supposed to be picking from here. Okay. So when I drag this down, we have the same thing. You see that from here is 0. But the question is, this date is -4 something. Because when I was trying to do this, I think I should have just left this also in date. So it's supposed to be, just a moment, guys. Let me check this properly. Because it can't be that figure that is presenting there. As to where that is coming from, it's quite surprising. But then you understand that it's actually taking this minus this, which doesn't make sense. So let me see whether I can tweak the formula some way. So if I take off the equal to sign to see what happens if I take off the equal to sign. So let me now drag to see what happens to me. Good. It works so well without the equal to sign. But I think the equal to sign place, that was actually the error. Now, so when we're done, you get to see the importance of what we're just doing, why we are doing all this. Someone put a message there. I mean, calculating a month's rate and multiply it directly. Oh, yeah, you can do that. That's what we did actually. Why don't we say EU months less or equal to 10 now? Less or equal to 10 now. That will not work. The value if true, value if false should be 0. No. You see, less or equal to 10 means that you are saying that they should only calculate this. They should only calculate this. Look at this formula. Let me use this to explain this to you. In this formula, we are saying that if the tenor is greater than 1, continue to calculate this. If you make it, if the tenor is less than 1, when will the tenor be less than 1? It will never happen. It will only happen after 17 periods. So all these areas will be 0, 0, 0, 0. From 1 to 17 will be 0, 0, 0. So that's why if the tenor is greater than 1, and all this area, the tenor is greater than these values below 17, is greater than all of them, right? Or is greater than values below 17, or from 17 and below. Now, next thing we do, opening balance is fine. Then the amortizable principal to generally is fine. Then when we come to the interest expense, we need to handle the same thing there, because we want the interest to only be calculated for a period. Beyond a certain period, they shouldn't calculate any interest for us again. It should be 0. Okay, so if same thing we've been doing, if this period, that we have here is greater than what we have here, then do this. Otherwise, do this. Now, so I think otherwise, do this. Otherwise, put 0. So I just have to log this, and then that side too is sorted out. So we don't want things to keep adding up things or calculating things there and then makes everything look some way for us. Okay, so the interest is being calculated now on that basis. So you can see that going forward, the whole place is 0. The whole place is 0. And that's what I'm talking about. Okay. Now, we also do the interest payment the same way. So now you can only get the interest payment only between now and the maturity date. Beyond the maturity date, don't pay any interest. That's the whole idea here. So what do? We do the same if. So if So if this period is greater than this, then do this. Otherwise, it is 0. Then we just log this. We just log this all throughout. That is done for interest paid as well. You see, now be checking the whole thing. You see that here to the principal is all true. It's just calculating the principal all true. But then we can control this so that the principal is not just calculated from now to any time period at all. We can control this and also specify, put in the rule that if this is greater than this, the first month, then do this. Otherwise, do this. So we just log this as well. We log it, and we are good to go. What is it I've not done? If greater than this, oh, okay. So I need to take off this, comma. Okay, good, it works now. Now, so then we drag. You realize that the rest is 0. You realize that suddenly, once you hit the enter button, the rest is 0. Okay. Now, let's get to the closing balance. Since we've done for principal paid to, let's get to the closing balance and do the same for the closing balance. But, well, for the closing balance, think about it like this. Just think about the closing balance like this. The question we need to ask ourselves is, why is it that, as it stands now, the things keep calculating, even after putting on in all the rules we have here? We can also specify how the closing balance should do. But more importantly, what we're supposed to be specifying is not the closing balance. We're supposed to be specifying for the amortizable principal, because if the amortizable principal at a point is 0, we are good to go. So for amortizable principal, which is the addition of this, all we need to do is to say that, just a moment. I think some few things have changed here. So whether the formulation or the formula is still carrying out the task that we requesting it to perform. Okay. No problem. Let me see. The interest, accrued interest paid. Let me just sum up something quickly to see where the problem is. There's yeah. So the closing balance is not 0 for me. So I want to just check something. 2, 3, 1. Okay. So there's a bit of a problem. I know where the problem is coming from. Okay. Now, let's look at this. If I look at the timelines I'm having, it seems that the 17th month is actually 0. There's no month in the 17th month. And so there's no interest also accrued in the 17th month. And also there is no interest payment and there's no principal repayment as well, all in the 17th month. So I think I have to fix that problem really quick first. Let me change how I put in the dates and just see how something changes. Look at my formula, is not conclusive. Okay, so in the 17th month, we have the final month. The 17th month, we have the final month. Okay, good. But then the rest of the month is supposed to be 0. Okay. There's a bit of, because of the equal to I didn't bring to the first one, and I later brought to the second ones and it wasn't giving a result. So now I think I can go ahead and bring my equal tos. So if I go here, I have to bring the equal tos for you to give me a perfect response, a perfect answer. Yes. Somebody will say, oh, there's nothing like a perfect answer. Let's just say a good response. So I have to put the equal to sign here. Since I brought the equal to sign to the first one, so that it includes the 17th month. Because I didn't bring the equal to sign, it wasn't including the 17th month. So you have to be greater or equal to. So let's try this one now and see. Good. So it has included a 17th month. So we have this. You know that the debt actually expired on the 24th of June. The 24th of June have not been included. But we can make it inclusive though, but then for now, we can leave it. Now, so when we come to the opening balance and all these balances here, and we come to the amortizable principal, we have all that also done. We come to this side, that also done. This side, also done. Principal. So we need to check whether the principal is up to 17 months. And this is 16 months. It's supposed to be 17 months. So all these things that we have done without a greater or equal to sign, we have to put the greater or equal to sign there. So if we take the interest as well, there must be a greater or equal to sign there to see how this calculation now changes. Okay, now, if we take the 17 month, you still see some things getting calculated properly now. The greater or equal to sign must be there so that the 17th month will be included. Okay, so greater or equal to sign must also be here for the 17th month to be included. Good. Immediately we did that, the closing balance ran to 0. So now we have amortization done over 17 months. Someone said, I don't write the function well. No problem, I get you. You can use mass or mean in place of the if function. Oh, yes, you can use mass and mean. So whichever is the maximum or the minimum, you continue to do something. Yeah, that is true. You can do. Okay. Now, but then I need to put the if statement also in the cumulative interest, cumulative principal, interest paid, and then the cumulative principal. The reason is that if I do that, it will stop summing up things once you get to a certain point, right? So if we do if 17 here is greater or equal to 1, then you keep on summing something. Otherwise, you stop the summation. So if this condition is true, so let me log this here, log this also. So if this condition is true, keep on summing things. Otherwise, make it 0. Okay. Why is my... Okay, I need to take off this. Okay. Good. Now, so you see, once you get to the 17th month something, it stopped. But then I wanted to stop earlier, even earlier than that, right? But let me see. Good. It's because I put it here. It has to be in the second month. You know, I'm talking about the second element here. The second element here. So that must be in the second month, actually. Sorry for that. So now it will be correct. Yeah, accurate now. Now, when we come here we do the same thing. We do the same thing. So I can actually copy and just paste here and edit the formula. And also copy this one, paste here, and edit the formula. It will work. It will work perfectly in exception of this. I'll have to move this one back. Then the rest are correct. So I press enter, I drag. So when we share this with you, you can take your time to go through. Go through the worksheet to familiarize yourself better. Now, so principal side as well. So you move this to this side, you enter. You have the principal page. So let's see. So you can see that the amortizable principal, I don't know why, is all 0. Everything else is 0. So all we have to do is just to format this properly to see how our worksheet is looking like. And let's see whether we can do some analysis, further analysis based on this to change some dates to see how the rest of the things change accordingly. If I want to do some scenario analysis on how interest exchange rate, or if you want to restructure the debt or something, maybe we want to change the tenor, we want to see the impact. So let's look at something. Now, let's make this tenor 10. Let's change this to 10 and see how our worksheet responds. You see what happened? immediately we change to 10, you see what happens. Now, you see where the closing balance is. At 10 years. If I change it to 15, let's see what happens when you change to 15. It's automatic. So we have a self-balancing work where this amortization sheet. You see what's happening? It's fully amortized by the 15. Now, if we change this to 20, let's see 20. Same thing. This is 20, 20th line. See, it's fully amortized. Good. The rest of the date size and all, whatever, I don't mind the dates the way they are doing. But then, as much as we know, I just mistakenly deleted a very important thing, which a formula we put here, which is actually dated if, to calculate the number of months in the number of months between years. So we have dated if, and we have the starting value minus the ending value. And then we are specifying that to give us month. In fact, this is not different from what we see when you do modeling in Python. Okay, so we are done with the debt side. Now, maybe let's shift the debt a bit below and handle equity, components of equity. So for equity, so as I mean, we are almost done, right? With assumptions and all that. For the equity, let's go back to operating assumptions and let me just pick these headers. Just pick these headers there. Now we get to the equity. Equity. Now, so equity here, I want to talk about stated capital. But that depends. Let's get to the IFRS and see how the equity structure is. So we have stated capital, other reserves, and retained earnings. Now, so let's start with the stated capital first. Funding side, opening balance. Now, profit after tax or earnings after tax. Then we have dividend paid. Well, we can also talk about shares. What am I saying? Am I adding these things? Why am I dealing with written earnings? Don't mind me. So, new issuance or equity issuance or new issues. If issue some new equities or something, share buyback. Share buybacks. And let's see, let's have closing here. Closing balance. Now, so let's just put the opening balances there. So we go to the FS. We go to equity. We get an opening balance. Now, we actually can, let's start from 2021 so that we can use the 2020 opening balance as starting point. I'm sorry. 2020 as opening balance. Let me see. Okay. Okay. So we get the closing balance for 2020, which is on the financial statement. So equity is a closing balance for 2020, and that becomes 2021's opening balance. We have that. So new issues, no, we didn't see any issue coming on. We are not making any assumptions around the issuing a new share or something. So we close this, we get this to this level. And then we also get this to this level. So this gives us actually the balances for equity. So these are the equity balances for the period. As far as MTN is concerned, our modeling of MTN is concerned, I need to be careful how I use my words. Our modeling of MTN is concerned. Okay, it's a public company, so there's nothing wrong getting their data and analyzing. After all, this is for educational purpose, right? Now, so we have this, and we draw this. We also do some painting, what we've been doing all this while. We do that here. Now, we look for the second one, the second item on equity, which is retained earnings. So retained earnings. I don't know why I can't just use whatsoever I have at the top. Let me use the entire thing here. So we have retained earnings. Now, for retained earnings, hide. So we have opening, we have profit for the year, or earnings after tax. Then we have dividend paid. So let's get an opening. Again, we go to the financial statement. 2020 retained earnings openings is this. So profit for the year, we go to the FS and get the P&L and get a profit. But then it's not quite straightforward. It's not quite straightforward like that. There may be, if you get into the changes or the statement of changes in equity for the company, you may see more information than what I am referring to here as a movement in retained earnings. There may be much more information. So maybe for the purpose of time, what I'm going to be doing is that I'm going to delete up to this period. I'll delete up to this period so that we can focus primarily on 2023 and the years after. Or I'll even delete up to 2023 so that we can focus on 2024 and the years after. I think that will actually be better. Otherwise, we have to go into the account and try to now get the details of dividends paid and all that and present all those historical data here. So let me just go back and pick these things again. Stated capital, the opening for 2024 is that of 2023 closing. And the retained earnings, the opening for 2024 is same as the 2023 closing. Now, then there's one other thing that we need to take account of, which is the other reserves. So at least let's build a schedule for other reserve as well. Even if there's no other reserve, we can still build a schedule for other reserve. All right. Now, so other reserves. So other reserve opening, then let's call the difference movements. Movements in the other reserves. So this could be revaluation reserves or translation loss on remeasurement of equity investments and all those kind of stuff. Now, so the opening balance 2023, we go there, we pick the 2023 opening balance for that, and that is this figure. So this is how that is also looking like. So equity is done as well. So once we prepare the P&L, we get the earnings after tax, we just put it here, and we are good to go. That's how easy is it. Not anything difficult to worry about. Good. Now, we can come out also finally, as far as equity is concerned, with dividend policy. If MTN wants to pay dividend, we can project some level of dividend, right? But then usually these things are based on firms' own policies and maybe the historical trends and all and what have not. So dividend policy. So we can have dividend policy, which let's make it 20% of earnings per share or total earnings for the year. We can set something around that. So based on this, we can determine their dividend. So we bring the earnings here first. We bring the earnings here, and based on that, we can determine dividend paid. And dividend paid will be the product of the dividend policy or the dividend payout ratio times this. So the this dividend policy is actually, let's just call it dividend payouts ratio. And so when we multiply this, we get the dividends that we send to cash flow statement and also to net off against retained earnings. So we get a dividend paid. If we do that multiplication. And this dividend paid is what we finally bring here. We must make it negative. So we're just building our worksheets down so that once we start doing those other calculations, these things will adjust on their own. Okay. The last and final thing is Capex. Now, at this moment, I want to give a 10 minutes break. I think 10 minutes break is fine, right? Guys, we're supposed to close by 3:30, but then just grant me an opportunity so that we can handle this together and end it today being the final day. So I may eat a bit into your time. So can we take a 10 minutes break and get back at let's get back 3:25. Let's make it 12 minutes, 3:25 to continue. Is that okay with everybody? If that is okay with you, please, I want to see your hand. I want to see your hand just to show that that is okay with you. And we take a 10 minutes break, get back, and we get into Capex. You look at Capex, and from Capex, we get into, then after Capex, then we can enter into, we can put everything together in a P&L balance sheet and cash flow. Okay. Okay, thank you very much. Yeah, so let's take 10 minutes break. Let's get back 3:25 p.m. GMT, Ghana time. Great. All right. The numbers keep reducing. Only the, only the, only the, only the, only the strongest shall survive. Only the strongest shall survive. So I have on the call, number of people are Angela, Benjamin, Bernard, Belandley, Daniel, Edina, Edwards, Emmanuel, Eunice, Evans, Farida, Felice, Festus, Frederick, George, Gladstone, Godlove, Jose, and Ibrahim, Isaac, Ivan, Justice, Kelly, Kelvin, Kwesi, Mohammed, Nana Sewa, Stephen, Suzanne, Uche, Benjamin, and Francis. Great. Let's get it on, guys. Now, so let me share my screen. So we get to Capex matters. And we're going to make some simplistic assumptions around Capex. Not necessarily assumption, but what I want to do is that if I don't want to get into the very fine details of Capex, right? So I want to do things at the level of the balance sheet. Now, so like for example, if I take property, plant, and equipment, there may be fine details of property, plant, and equipment, but then I'm not interested in that. At least for the purpose of this work. If it is like real office work where I need to do this modeling for a client or something, I want to do a valuation or something, I may want to, get into the details of each of the components of property, plant, and equipment. I may be talking about building, furniture, and fittings and all that, and perform the depreciation calculation and all that across. Now, so I'm going to show you what I'm going to do. Simple, but sure. What I'm going to do is that I'm going to go first into the annual report. And what I want to check in the annual report is I want to check the depreciation, the total depreciation for each of the line items or the class of asset. We have property, plant, and equipment. We have the right of use asset, and we have the intangible. So looking on their P&L to start with, they have depreciation for right of use and that of the PPE bundled together. And intangible is clearly stated, amortization. So I'm fine with that side. So I just want to now look for the portion that belongs to the PPE and then take it out of the total in order to get a portion that belongs to the right of use asset. So let's see. Total depreciation, trying to get that quickly. So we use that to do our work. And not only the depreciation also, we need the total value of the cost of the assets. Then we also need the accumulated depreciation. So let me show my screen so you see what I'm doing, where I'm getting some of these things from. So let me share my screen. Okay. So this is a PP worksheet or PP notes actually for the group. And I'm looking at the notes as of 2023. So December 2023 is far below. So here I'm able to see both the accumulated depreciation and also I'm able to see the cost. So the cost of the assets or the total PPE is 11,551,289. Okay, now I have it open. So maybe I can now just put together my worksheet and then start from there. So the PPE, let me just copy what I have here at the top to PPE. I think I can copy to this level so that I can have the PPE there. let me see so that I think maybe I can rotate. Okay, someone has brought all those things here. No, I'm not sure what the person pasted. Who pasted this? Addresses the name. Victor, I'm not sure this addresses. I think this is a wrong page that you pasted up. Okay, Julius, why don't we consider the trend of dividend policy to project the dream? Of course, we can do. So that is just something I put there for a moment. Just for a moment, please. Okay. Maybe let me just put my Excel sheet together. So let me share my Excel sheet first, just to get that information. Now, so assumptions here, I want to look at PPE assumptions, and here I want to look at costs. So with costs, let me increase this to 150. Increase this to 150. So for cost, we have opening balance. So I'm putting all the PPEs together, right? Then I have additions, and usually I'll have disposal as well. And sometimes there may be a write-off, a non-current asset write-off. So we have the write-off also there. Okay. Now, then we have the closing balance. Then from here, we will also need accumulated depreciation. We also need accumulated depreciation. So let me put that also here. Accumulated depreciation. Accumulated depreciation here. So for accumulated depreciation, we have opening balance, we have depreciation expense for the period, and there may be disposals, and maybe let me take off the write-off, then we have the closing balance as well. So this one is for PPE. Then we can have the version 4. Now, when we have this, we can actually deal with the depreciation calculation for accumulated depreciation before, or sorry, for PPE and all those things before we move to another asset base. Okay. That's one thing we can do. Now, so after doing this, we get a net book value. We get a net book value listed here. And the net book value is the cost less accumulated depreciation. Then we can also have our Capex plan. We have a Capex plan. So if there's a plan to have Capex, or maybe capital expenditure, I mean investment in fixed assets as far as the PPE is concerned. So we can have a Capex plan here. Yeah, our Capex plan lead here to start with. Good. All right. And of course, Capex plan, we are going to develop one. One thing we can do is to base the Capex plan on, we can say Capex to, or we can do a revenue to Capex ratio. So we will look at historical Capex, revenue to Capex ratio. And based on that, we may be able to forecast what the Capex for the future will be, knowing the revenue for the future. That is what we are going to be doing. Okay. Then from there, from the Capex plan, we can do our depreciation calculation. We know the Capex budgeted for every year. Based on that, we're able to calculate our depreciation. Now, so the depreciation calculation, we need an appropriate depreciation rate. One thing we can do is actually to get the depreciation rate for multiple periods to start with. So depreciation calculation. So we can do the depreciation expense for multiple period historically, and we get a depreciation expense, and based on that, we can calculate the average depreciation rate for multiple period. Average depreciation rate for multiple period, and then we can average that out, okay? And that becomes the forecast depreciation rates we can have. Somebody asking a question. Thanks. Are we getting a workbook after the class? Yes, we do. Okay. Okay, Victor has projected some of these items here. Thank you, Victor. Okay, now, so we can get the depreciation calculation once we get an average depreciation rate. So to get a depreciation calculation, there is something we're going to be doing. We are going to arrange the years in this form. So we have 2024, starting from 2024 to 2025, going in that order. So we are going to do that, and we can drag that up to 2032, the period we are dealing with. We can center that there. Now, so here as well, let me maybe just for a moment, maybe shift this down just twice, and then have here years. Okay. Now, so I have my facts on another laptop, so I am going to be referring to that laptop for the facts. So that I can progress really fast. If I see the facts, I mean the information I need. So 2020, maybe I can start from this side. I can start from 2020, 2023. So or we can start with 2022. Let me get the input openings for 2022. For 2022, the total assets we have, let me see, 2022 total assets at the beginning of the year for the cost component is 7,397,992. 7,397,992. All right. Now, so during the year, we have additions of 17,24,995. Now, the reason why I mentioned earlier that I'll be using some average depreciation rate is that we're having multiple assets in the PPE asset stock, and they may be all coming out with different depreciation rates, right? And there's a disposal that amounts to 15,360. Then we have a reallocation. So the term here is reallocation that they have. Reallocation. A reallocation of 51,771. Okay. So then the closing balance, we have that. So this is a closing balance at the end of the day. The 91,59398. Good. So that's what we have. Now, so the closing balance becomes the opening balance in 2023. Now, so additions in 2022, in 2023, we have an addition. I'm trying to just get these things from, so it's kind of like some way. 2,3, we have 2,3, we have 6,1, 6,1, 4,1,3. Then disposal in the same year was only 5,313. And then reallocation was 35,791. Okay. So we still have the closing balance there as well. Now, so that becomes the opening balance in the year of forecast. Good. Now, when we get to the depreciation side of things, the opening balance in 2022 for accumulated depreciation, the opening balance was 3,494,91844. Then the depreciation for the period, okay, so there were some few items again, apart from just depreciation for the period. They have what they have disposal here. That was actually arranged in this order instead. After disposal, the next arrangement was a reallocation. So just want to match the arrangement, reallocation before we have depreciation expense. Depreciation expense for the period. Then they have another line item called other movements. So let's just match them. Other movements. Okay. So the opening balance is this. The disposal for under that, when assets are disposed, the accumulated depreciation associated with that asset must be taken out. So I must put it in negative. Then reallocation 18, that must also be taken out. 18, 134. 18, 134. 134. And then the next item being the depreciation charge was negative 719, 464. 464. And then other movements, we have 126. 126. So the closing balance on the accumulated depreciation, the closing balance on accumulated depreciation is proudly this amount here that we have. Just a moment. Sorry, that depreciation for the period shouldn't be negative. I should have taken that off. So 419, 178, 612. 612. Okay, so this must also be negative. Other deductions, okay. All right, 360. Good, I have it right. Now, so that becomes the opening balance in 2023. There's a question here. Why is reallocation in asset cost not negative? Okay, so look at the cost being negative, mean that could be a reallocation. Okay, don't take my word for it, but then these are the network equipment. So that's maybe a reallocation to that particular asset class. Also from a certain asset class to this particular asset class, right? Okay, we can read more about it, or you can read in the annual report, but then they have their own definition of what reallocation should be. You get it? So that is actually increasing that. As per that. So I'm just picking the historical figures, just to start with. Now, disposal for 2023, the disposal was minus 4,556. 4,556. Then reallocation was minus 35. Minus 35,793. Then we get to depreciation charge, 881,772. Then we have the final one. Why am I doing depreciation charge? I'm putting negative. The reason why these negative things are confusing me was because of how their things are arranged. They also put a lot of things in negative. So reallocation is supposed to be in positives. Okay. And I think reallocation here too is positive. So this is more of like a new asset being introduced into the asset group. Yeah, maybe from another group to this asset group. Then other deductions or other movements is actually 27. Is 27366. Okay, so in total, we have 5118735, which is as per what I have here. Okay. Good. Maybe 2 years back is just fine. We don't have to go way back into the past. So when we come to the net book value, the net book value is basically just taking the total cost minus what we have here. Total cost minus accumulated depreciation. And that gives us the net book value. Okay. So let me just work on this. In fact, maybe I should just take this particular line of the other 2 years. Oh, so I can start from this year. Okay. So let me just group this properly. And then also use customs to put them properly in respective places. Okay. Then also come here. Then use the custom again. Those items that are purely negative or something, I can put them some brackets around them. Okay. Okay, good. So we can do for the rest. Of course, when it comes to debt, we may not be making decisions concerning disposal. No, we won't do that because we don't know anything about the company as far as that is concerned. So when a depreciation is calculated, we should be able to get a measure of the total value of the depreciation. But we can calculate the Capex to depreciation ratio at least for, or revenue to Capex ratio at least for 2022 and 2023. So we know from the financial statement that the revenue for 2022 is this figure here divided by the Capex for 2022, or which is the additions for 2022. So addition for 2022 is this figure as well. So when we divide that, it gives us the Capex, the revenue to Capex ratio. And one thing I can do is that I can format that figure better and to put some times things around it. So I come here and I put X by it, and that gives me 5.7 times. Okay. Then I can also put that if error, then all you have to do is to just to say not applicable. Not applicable. So let's drag. So the rest will be not applicable until we get some good values there. Okay. Then we can also get average depreciation rate. This is how I calculate the average depreciation rate. I want to look at the depreciation expense for a period divided by the average of the opening balance of non-current assets and the closing balance of non-current assets. This is how I intend to handle this. Okay. So this is the average depreciation rate. This is what I mean by the average depreciation rate. So I'm doing it for both years to get an average depreciation rate. So that is purely around 9%. You see that's quite consistent. So if I take the average of the historical, I think it's something good enough for my forecast as the depreciation rate that I'll be applying throughout my forecast. I think there's a question. Let me address that quickly. Let me see that. If they give us information. Okay, disposal is unusual. Okay, as I said, if they give us additional information regards to sales of our yes, that's true. Steven says, my guy, you get energy. You stood your ground whole day. You are a champion. Thank you, Steven. It's just the motivation coming from every side just to get this done. Thank you very much. I appreciate that. Okay. Now we can do our depreciation calculation, right? Now that we have here, what we're going to be doing basically is to bring the Capex we want. But then first, let's forecast the Capex, right? If we know that's the Capex to depreciation ratio, and historically, these have been the Capex. We have the Capex basically here, additions as this. We're able to bring that here. It's all happening the times, and I have to just format it properly. Okay. So this is the Capex we have. To get the Capex for this period, it's a matter of just multiplying this problem here. Since we have the historical Capex to depreciation ratio, I would have just calculated the average. Yeah, Capex to revenue to Capex ratio. I kept mentioning depreciation, please. Don't mind me. I can just calculate the average, and it's quite stable. So if I calculate the average, I'm fine to go. So this is the average. So once I know revenue, I'll just multiply. Once I know the revenue, since this is revenue to Capex ratio, it means that all I need to do is to take revenue and divide it by this ratio. Then I'm good to go. So first thing to do is to take revenue. For 2024, what's the revenue? So I go straight to key assumptions and start the revenues matters from here. This is the total revenue divided by whatsoever we have here. 2024 divided by the depreciation, whatever for 2024. Hit enter, then it's giving me this. I drag it, I reformat it properly. I have my Capex calculations done in touch. That's cool. Now, so these are the Capex assumptions we're making. Yes, you may disagree, but this is what we're making at least for now. Okay. Now that we've just completed that, what we are going to be doing is this. I want us to present the same Capex forecast we have here, the same Capex forecast we have here. I want us to present it in a vertical format so that we'll be able to do our calculations easily. So how do we do when matters arise like that? We use the offset function. But then I want the offset function to move in a certain direction. So let me put some figures there here, right? Now, this is what I want to do. So this should be 2, 3. It should be up to 10 or over the period. I want to, this is what I want the algorithm to do. I'll put the algorithm here and I'll ask algorithm to be moving in steps towards here and be putting the values here. You see, you move in those steps and put the value. So I'm going to use the offset function. That will help me to do that. So if I take the offset function, what I'm going to be telling offset function is that go to the value before the value I want to pick, or it can be anywhere at all. But then because I start the numbering from 1, it must be before. So that I can, if I take my first step, it falls on the first value. Now, I need to log it. And this is what I'm going to do. Offset function goes like this. Am I going to move by rows? No. You are not to move along rows. I want it to move across columns because this is column 1, column D, column E, column F. I want it to move across columns. So row, no. Don't move across rows. Now, I want it to move across columns. Suppose I wanted to rather pick an item here to pick this average depreciation. I would have said, move some number of rows down and move some number of columns, then I pick it up. But here, I don't want it to move across rows. It's just entirely columns, column movement. So row is 0, column, move 1 step. With columns, I'm telling it to move 1 step. If you move the first step, it's going to land on the 2024 Capex plan, which is 3.something million. Let's try it and see. It lands on there. You get it? Now, it lands there. Now, if I drag this the next, it's going to move twice. That's the 2. It moves twice, and that will pick 2025. Okay, Victor. So what I'm saying is this. I want to rearrange. It's like transpose. I want to transpose whatever I have at the top here horizontally to a vertical format here. It's just a transposition I'm doing. And you can use a transpose function to do this, but I love to use this to do this, right? So I'm not going to move across rows. Moving across rows means moving vertically. I want to move horizontally. So I'm going to move along the horizontal line. You can copy and use space special and then select transpose. No, I get it, but then, it looks like I'm overdoing what I'm supposed to be doing. If you change it, how is it going to be like? If you want to change things, so this is what I do. So I can drag and I'm done. I've moved it. So if something changes, that also changes accordingly. Okay. Now, what am I aiming at? The additional Capex that I'm purchasing, I want to be able to depreciate them. That's what I want to do at the end of the day. So what do? I come to the first year that a Capex will be purchased. This Capex will be purchased. I love this function. Normally I do transpose before. Oh, okay. So this Capex will be purchased in 2024. And so depreciation starts from 2024. Let's just use a straight line depreciation. Or can we use straight line or reducing balance? Let's use the straight line to solve this problem. Straight line will work because the 8.6% is way below the, below, because if I do 1 divided by 10 is 10%. So this, I'll still have some asset left. Okay, straight line. So let's start from here. So all I do is just take this and I'm going to anchor it. I'm going to anchor this. Just a moment. Okay, take this, let me anchor it, and then multiply that by this, by the depreciation rate, right? Now, so you are going to be depreciating this asset across, that Capex across. Then the second item, look at it, will be bought in 2025. So you pick it, you anchor it, right? You anchor it, and then you move it. And what am I doing? You multiply it by the 2025 depreciation rate. I will depreciate 20 from 2025 going. The third one, you know what it means, will be depreciated from 2026 going, and so on. So let me just do that quickly. There are faster functions to do this. There are faster ways of just running this, but I am just doing the overdo because I want you guys to know what is going on. Let's see, amazing. I see. Okay. Then the next one, we come here, we pick this balance, we multiply it by this. Then we anchor it. Okay, that we do. Then next one, we pick this, we multiply it by this. Then we, sometimes even the functions, I'm missing in the functions. Yes, so then we pick the next one. We pick this. Then we, okay, so I think that is it. So we anchor it. And we multiply it by the applicable rates. Then we drag. The next one, you see why we need to do this thing at the level of the asset, a PP, if you have to go into the very details. But when I do these things formally, I do them at the level of the individual asset. Especially if fixed asset dominates the company in questions, if fixed asset dominates the company's financial statement. I think I picked the wrong thing here. So let me move it down. Okay. Okay, so next one, we pick this one. Am I doing the right thing? Okay. 1 to 9 years. Okay, I mixed up the years. Okay, I get it. So 2030, whatever. Then we log this as well. The next one will be to pick this multiplied by this. Okay. Oh my goodness. Okay, so then we drag it. Right? And the final one, you know, we missed 1 year, right? It's supposed to be 10 years, right? Supposed to be 10 years. So we miss on 1 year, one particular year. So this is supposed to be up to 10 years. So I think it has picked it now perfectly. So the final year is this. So we multiply this, by the 10th year. And then we bring this here, we bring the dollar sign here too. Then see what we've done. Looks like a waterfall, right? Now, let's do relatively reference to the rows. Yeah, we can do that. I get it. We can do that and then drag. I don't want to just do that and just drag everything in. Oh, everything is going. That can be done. I see. Okay. So now we've done this. The next thing to do will be to sum up so we can get a summation of this. So to get a total, a Capex that the company has invested in or we plan to invest in. So this should be total Capex, and we can also get total depreciation. You can get total depreciation as well. And total depreciation from the Capex will just be the summation of this. So we've summed up all this together. We have this. Look at that. Very beautiful, right? So this is a total depreciation from the additions to Capex. Okay, total depreciation to the additions to Capex. And then once we have that, how about existing depreciation? So existing asset depreciation. Because there was some asset before we are now investing in new assets. So depreciation from existing asset will be a depreciation rate multiplied by the previous year closing balance or the opening balance of the asset. Now, that gives us this, of the PP, that gives us this. And then we sum that together. This gives us a total depreciation for the year, as far as PP is concerned. So you can see that the total depreciation for the year is made up of the depreciation from the new investment in Capex plus the depreciation from the existing PPEs. I think that makes a lot of sense. So total depreciation for PPE is this we've just completed. So what we do is that if you look at existing depreciation, you see that going forward is 0. It's a matter of just dragging this, and we have that also done. So we have the existing depreciation also like this. Now, we need to put in the Capex to see how things are looking like. So let's put in the Capex to see. So additions to PP, we can sum up the additions, and the additions, or we can link the additions, which we have here from 2024. We're having some good additions to PP. And that's what we have. And we've also calculated depreciation. So we have done, or we are done with cost, we have done with accumulated depreciation. Okay, let's handle the accumulated depreciation for the rest. So we link opening balances to this. And of course, this is recorded on YouTube. So take your time to listen to it. Take your time to listen to it. You can go back to watch that on YouTube. And also, as I mentioned, we will be doing a valuation training somewhere in August. Of course, in KPMG, I will be doing some valuation training or something. I think that should be awesome. Of course, you can check it on my LinkedIn page. And if you don't mind, you can follow me on my LinkedIn page as far as these things are concerned. So depreciation expense, we get a depreciation expense for 2024 here, the 1.2 something million. We put that here, we drag that to this side. There's a chart in the comments. Some people are streaming through YouTube. Yes, that's true. Now, what did I just do? Just move that. That's bad. Now, so I'm done with this side too. Hooray, we just finished with the depreciation side. So we know the total depreciation in 10 years' time. We know the cost or the historical cost in 10 years' time. And we also know the net book value in 10 years' time. Isn't that interesting? We have been able to handle all this. And you'll be wondering if our balance sheet will balance. Trust me, it's going to balance. We're doing things well, so balance is going to balance. So what we did is for PPE. Now, you may be wondering how. But imagine if we are to treat the PPEs one after the other. or the various components of PPE, then by now, you will be having serious headache. Now, that tells you why you will be doing a financial modeling. It may take you 3 days to finish, or 4 days to finish, or 5 days to finish, or even 2 weeks to finish. It's all about what you are working on. The next thing is right of use assets. Right of use assets. We're just going to use the same assumptions we have earlier here. We have the cost, we have accumulated depreciation, we have, do I have it there? We have the net book value. I think my accumulated depreciation, my writing is wrong. Connect with Julius. Okay, thank you very much, Ikuya, for sharing that. What if some existing asset will be fully depreciated along the years? Oh, yeah. Of course, that's what I'm saying, that if you are to do this properly for a client, you would like to take it an asset after an asset. You will not pack all of them together. So I agree. Kelvin, I agree. So you will not have to pack all of them together. I agree. All right, let's continue. Now, so this right of use asset, we need to also get information on the right of use asset. So let me put that there quickly. For the cost, you can see that there have not been any additions, right? There have not been any, though this is the right of use as assets and liability, measurement of right of use assets. I think this is the correct workings, right? The right of use asset. So if you, let me just cross-check something. A team member is showing me something on the right of use asset. Just to cross-check, 1 for current amount of right of use asset for the group, 148.4. Okay, that's correct. Thank you. Now, so we need to also get same information from right of use. Opening balance for 2022 for the right of use assets was, I just have to bundle all of them together because there's no opening balance and there's no actually additions in the course of the year. So 118. So in the total is just 2293,406. And during the year, there was no addition, and there was no disposal, and there was no reallocation. So same value at year end. Then that starts 2020, whatever. And then, but then it appears that in 2023, there was an addition. So if you can calculate this for me quickly, there's a difference between the three. We have 3089,623. 623 we have here minus what we have here. And so this is actually the addition. So let me paste here again. So I paste values. So we have this remove. We have this remove. So the total is 3089,623. Perfect. So the accumulated depreciation side too. So this is actually making our work easy and simple. So 1096,844. 1096,844. And then here we don't have anything. We don't have anything here too. Nothing. Oh, there should be a depreciation for the year. I'm trying to look at why the depreciation for the year have not been disclosed in their books. They've not disclosed the depreciation for the year in their book. But then you could see in 2023, they're able to disclose that. So of course, guys, let's just assume for now that we don't have the depreciation expense for 2022, but for 2023, we do have. For 2023, we do have. So for 2023, disposal is 0, we have reallocation to 0, and we have depreciation expense. All we need to do is just to take the difference between the 1,414 549, 1484549 minus cost of what we have here, and that's, let me just copy and repaste, paste as value, and take off the last one, which is movement, and then we have 1484549, period. Wonderful. So we'll not work on the intangibles for me. Okay, now let's look at it. So now we have gotten all that, and we need to look at the capital expenditure in respect of the lease, right? So the question is, can we come out with the lease to, or the revenue to lease ratio, or revenue to additions to lease ratio? Maybe that will help us as well. So if we take the revenue figure for the period, first we need to get the lease amount. Of course, the lease amount here is 0. If we track it, it's actually 0. The additions to the lease. Okay. Just one moment. All right, so let's just say there have been an addition, but then how we're going to be treating these additions is just going to be different from how we treat additions when we're looking at the PP, lease additions. Now, so let's look at this for 2022. 2022 was the addition, there was nothing there, and then we can drag, right? We can drag across 2023, which is already here. Now, so we now have to get the revenue figure here. I don't know how accurate this figure is. Let me take it back again. So I go here and I pick revenue for 2023. Is it 2023 or 2022? 2023. I pick revenue figure for 2023. Well, so 2023 revenue, I bring that there, and it give me this huge figure here. And an average is taken. Maybe this average makes a better sense. It's like half of last year, so that we can stabilize the ratio a little bit, right? We can stabilize the ratio a little bit. So taking 16 times or something is just too huge to see. Okay, so then from here, we do this, multiply by the revenue, just as we did earlier. So where's the revenue? We go to assumptions, 2024 revenue, we get it, we enter, then we drag. So we can have some lease additions regularly, or additions being made to the lease on a regular basis. Now, to get this, to do this offset stuff that we've been doing, this was anchored to an earlier calculation, so we need to change the anchor. So it is here, 88. So we drag it and everything recalculates. Everything recalculates. Okay. Everything recalculates, as you see. So how about the depreciation calculations? The challenge is that we may be having some problems when we were copying this. For example, here, it's supposed to anchor to this, right? So it's supposed to be 96. It's supposed to be 96. So here the calculations are faster because a lot of things have been done already. 96. And here's supposed to be 97, 97, 97. So then we do the drag. And here it's supposed to be 98. The reference is 98. So it can pick the Capex there. And here's supposed to be, and this side is supposed to be 99, then we drag 99. Remember that this is the last side, then we put everything together. Then have 100. Then from here, we have 101 referenced. These are huge, huge figures. Here we have 102. 102 referenced. Okay. Reference. Here we have 103 reference. 103 referenced. And here we have 104 reference. And finally, 105 reference. I just don't like how huge these figures are. I don't know, but these figures are just huge. You know why? Because of the mistake I made. I was multiplying the revenue by that. I should have been dividing. So the revenue we had here should have been divided by that. How could I make such a fundamental mistake? Look, to err is human, man. Okay, so this is a better measure now. This makes much more sense. Exactly. It's because you use absolute referencing initially. That's why it's not changing automatically. Yes, definitely. Yes, so now depreciation on existing. And again, oh, I didn't calculate the depreciation rate on the ROE, the right of use assets, which is more of the lease. I think that's automatically calculates. Yeah, it has calculated automatically 7.2. And that's what we're using. Let's say the existing asset depreciation, is it properly calculated or is referencing to cost? It's supposed not to reference to cost. So we need to change it. It's supposed to reference. Oh, sorry. Did I say supposed not to reference to cost? I think it's referencing the right thing we want it to reference to. So that is fine. Now, so then we do the summation. That has been done automatically. You have the summation here. You have the summation here. Okay. Now, someone asking question. Let me see. It's normal to make mistakes. The worst is not to uncover and correct them. That's the truth. That's true. Thank you, Stephen. Yes. So if you look at the depreciation expense for the calculation in 2023, it's actually 44. It's actually 14.4, but then the averaging gave us that. Maybe let's take it off so that it's just exactly 14. Now, exactly 14 is giving us this as a total depreciation. Okay. Now let's see how the net book value is looking like. If the depreciation is such value. Okay. So this is correct. So let's see how the net book value is. This is a net book, oh, sorry. This is a net book value. At the end of the day, it's still positive. That's the most important thing. Okay. Averaging of the rates. Okay. No, this is fine. It's fine. All right, because I wasn't having depreciation for the previous years. That's what I just took the last year. Okay, now let's continue. We are left with one more thing, guys. Those leaving, you are not leaving. Oh, you are with me here. I know you are tired, but you have to stick with me till we all finish. Better is the end of a thing than the beginning. So the end is always glorious. All right. Let's continue to see. Now we finish the ROU. The last thing will be for intangibles. So let me get for the intangibles. Let me just copy this, do for intangibles, just for all righteousness to be fulfilled. We need to ensure that we cover every loophole. So we have intangible assets. Intangible assets. And there's something in the chat. It's normal to, okay, Chief, you are not drinking water. No juice. Kindly get something, I beg. Hey, who is Steven? Steven, we need to talk. Anthony, no projections for lease liability? A very important question. That's a good question. Hey, yeah, what's a very important question? What's a very important question? Steven said, let me help with lease liability. Daniel said, Steven is my boss. Oh, I see. Great, great, wonderful. Now, the point is that because I was so focused on this list to get this thing done quickly, I've even forgotten that there's a lease liability component that should have been created. Now, the whole idea is that because if you are creating a lease, you are creating, it's not a cash that is going, so there must be a corresponding account. So if asset is rising, there must be a corresponding account. Then that becomes the liability account that we have to create. You see, the lease liability, which is the present value of future lease payment. Well, a key assumption we can make is that, or one assumption we can make is that the lease liability is equal to the lease asset. So whatsoever additions we are making also becomes also a liability in itself. We can do that and then do the amortization for the lease as well. It's just a matter of, like what we did for the loan, we can just do the same, right? Otherwise, if we don't create this liability, the balance sheet will not balance. It won't balance. So it's good that Stephen has brought this. Oh, who brought that to? Stephen has brought, no. Anthony has brought that to my knowledge. Thank you very much, Anthony. Now let me clear off these intangible assets quickly. So regarding intangible assets, let's get that quickly done. The cost for 2023, additions 2023. Okay, so the cost for 2023 is opening for 2023. Okay, let me start with opening for 2022 first. So opening for 2022 is 1393,290. Then we talk about additions about 246,674. Then we have relocation of 51. You see, there was a relocation earlier. If you recall, there was a relocation earlier. We're thinking about where that money, the questions about relocation was relocated from intangibles to tangibles. We had saw some 51 million something. So 766. That is here. Now, so that gives us this figure here. Then becomes an opening balance here. In addition, in 2023 was 924,402. Then we also have a relocation of 13 or -928,928. All right, that gives us 2,498,672. Of course, that's a balance at year end. Okay, now let's get to the accumulated depreciation component of that. So here we have 6 614 and 421. And then when we talk about relocation, we have 18941, 18941. And then we have 170 for the depreciation or for the amortization. Let me call this amortization expense. And amortization expense is 170, 177.60. So the total is 804122. Correct. Now for 2023, we have the relocation being 9617. 9617, negative 9617. Then we have the amortization expense for that period, or for 2023, being 3334608. Okay, 11. So we have 1129, 113. So I think that is clear now as to what we're doing. So the net book value at the end of the day will be 1369559. Correct. Great. So we move straight to the additions area of what we're doing. Now, so additions to revenue ratio of here, we first put the addition to revenue ratio and revenue to additions ratio. So we go to the financial statement, we get a 2022 revenue, we pick it up and we divide it by the additions in 2022. So 2022 additions to the cost is this. So that gives us this ratio. And we have this. And then the lease additions, or this one will be additions to intangible assets. So we just see additions. Additions for this period is actually this. So we drag that as well. So this is what we have. Now, so going forward, it's a matter of taking the revenues in the forecast period and dividing it by the ratios. And then that gives us this. So we're assuming that every year there will be additions, right, for MTN. Now, the depreciation calculation, here we have amortization calculations. So maybe I can change the write-up instead of depreciation and call it amortization, because depreciation of intangible is called amortization. Amortization calculation. So here we have amortization rates. Amortization rate. So the average amortization rate have been computed. Our formula, when we copied, our formula is consistent. Okay. Here we can take the average to the historical period. So that's also done. Then let's see whether our formula is working properly. No. So it's supposed to peak at 138. So 138, is supposed to be these values being picked. So we enter and then drag. That's why we have is giving this value of setting zero. No. So this should be a sum. So start looking at something like this from here. Then we bold this. Okay, just correcting some few errors there. Now the depreciation will be calculated in reference to the first one, 146. Then that is dragged. 146 is dragged. Then the second one will be 147. 147. Then this is also dragged. Then the third one is 148. 147 and 148. 148. and it's also dragged. Then we have 149. 149 is also dragged. Then we have 150. Then we drag that also. 150 dragged. Then we have 151. Dragged. 152. Drag. Then we have 153. Drag. 154. Dragged. And finally, 155 dragged. Okay. So 155 drag. Good. Let's check whether every calculation is correct. Yes, they are correct. Just checking out this. So is this speaking the right figures for existing asset depreciation? Oops, it's speaking it right. And that is exactly what we want from it. And the second one is, are these figures here right? Yes, they are right. Very correct. So now when you're done with all these things, do something like this here. And that's what I want to do. Number one, I want to summarize the depreciations. So summary. So I have summary here. The first summary is depreciation and amortization. So here, PPE, then I have to right of use, then I have intangible assets. Intangible assets. So the PPE depreciation, total depreciation for PPE, I think let me just start from, since some of the years I don't have, so let me just start from 2024 because that's sort of interest to me. So PPE total depreciation is this. Then I come to right of use total depreciation is this. Then finally I come to the intangible. That's 1, 2 is this. So the total is actually the sum of all these three here combined, then dragged. So I have this. Perfect. Perfect. Now, the second thing I want to also summarize is I want to summarize the net book values. So the net book values are of interest to me. So net book values. So the same PPE, REE, and intangibles. I want to get them all summarized here. Intangibles. So PPE for net book value for PPE, we have this value. The net book value for ROU, we have, or intangible assets. That's the same. Oh, sorry. ROU separated from intangible asset. Must be crazy. So we have that also here. And the last one is that of the intangible assets. Yeah. Then from here, you sum up. You sum up as well. Then the last thing, so you get this summation actually. The last thing I would like to look out for after doing this thing is the Capex. I want to summarize Capex because I need that so I can put in my cash flow statement as the total Capex for the period. Yeah. Okay, so let me summarize this. Come here, and then we put, I want to get a summary finally of my Capex. let's see how that works. So the Capex to, I have the 3 items here. The same thing. Oh my days. Okay. For the Capex as well. So all I do is to go. I do PPE Capex, PP Capex up there. Then I move to the next Capex, which is actually ROU Capex. We have it here. Then the last one is a Capex for intangibles. Have it here. Now, so then you sum up everything you have here. Sum them up closely, and then you drag them there. Good. So this goes to my characteristic. Now, with all this that we've done, I can say we are done with the PPE then. The last thing that I want us to do will be the issue that popped up of the issue of the lease liability. So can we get the implied interest rate on the lease? Let's check. Yep. Someone is checking for me, so we know whether there's an implied interest rate on the lease. Okay. Get the implied interest rate on the lease. Okay. If we get an implied interest rate on the lease, we will be able to determine or to see the lease liability, and also so it will help us really, really well. So we'll go back to the funding just for the purpose of the lease, and so that we can deal with the lease. So let me copy what I've just done here, because I'm going to use a similar amortization schedule. Okay, let me see how this amortization schedule works. So type of debt, this is a lease. I need to know now the balance of the lease as it stands. We have some balance on the balance sheet there. So if additions are made to that balance and amortized together, of course, we will still arrive at something similar. Well, look at the balance sheet and let's talk about lease. That's the last thing we want to talk about before we put together a financial statement. So if we search through this, we see the lease liability here. There's a lease component in the other liability as well. But I know we are going to struggle ourselves through a lot of things. The lease liability is about 1.7 million or billion. And then when we come to the asset side, it's about 1.4. So 1.7 billion. What I'm interested in is to know the implied interest rate on the lease. We can search that to see if we get something. Otherwise, we can keep the lease constant. You create the liability and keep it constant as though it's not been amortized. We know it has to be amortized, but just for the purpose of time, we don't want to get ourselves worried too much. Just for the purpose of time. If you like, we can do that. And what it means is that, in other words, we can even create the lease. Good. See, we're supposed to be closing around 3:30, right? I've actually chopped so much into your time. Today being the final day, there are more things I want to show you. So what I'm going to do is I'm going to create the lease liability, but I'll not amortize it. Do we all agree that we create a lease liability on the balance sheet? We will not amortize, we will not amortize it over the period. It will just be constant because we don't want to now define the terms of each of the lease. Usually, yeah, is that okay with everybody? If you are fine with that, please give me thumbs up in the chat box to show that you are okay with that. And then we can continue and just hold the lease liability on the balance sheet constant. We understand. Great. I love that. My people understand. So just in the interest of time, so we're going to create the lease, but then we will not amortize it. So what we do is that, let me go back to the funding so that we can create such a lease. So let me delete what I duplicated here for the purpose of the lease calculation, and then introduce something on the lease and just put the lease amount there and then run a balance through. Okay. So lease liability. And I want to leave the one in the current liability there like that. I don't want to go and touch it. So I'll take the one on the non-current side. So non-current, just in the interest of time. In the future, videos will be created on each of these individually to explain them further to you, those of you who will be interested. Non-current lease liability. Now, so the opening balance in 2024 for non-current lease liability, as per the balance sheet, is taken under non-current liability, and we have it here. Okay, let me see more charts. But in the interest of time, we agree. Sure. Maybe the other wants to own it. Maybe the MTN wants to own it. Stephen, we will need to meet. You need to find a time and have lunch. Because today I realize that you really interested me. So opening, then additions to the lease liability and payments. Let's get another line called payment. But so we can get a finance cost on this, then meaning we need to create additional tables so that we can also get the payments. So payments can be the combination of both the interest payment and the lease principal repayment. All right, so I'll just stretch this to the end. And so there have been some additions to the lease. So that will be, I want it to approximate the Capex, right? So when we come to the Capex, we look for the lease Capex, which is the ROU. And also by the Capex is for 2024, that is the addition we intend to have to the lease. Create that. That is quite huge, eh? MTN will never be happy with us for doing such a thing to them, for planning for them. Actually, some of these things we've done here, more discussions. If you're doing this for MTN or you work for MTN, you may have to spend more time having discussions around some of these things, talking about their strategic plans and all that, as to how they intend to approach the market going forward. Right. Good. Okay. So very important. So we've just handled the issue of the lease liability. At least our balance sheet should start getting in shape. Now that we've done with all these things, let's move to the next. We've just finished model assumptions and development. You see how long model assumption development has taken. We can now move to the model output. Okay, in the interest of time, my suggestion is that you've nailed it well on how to forecast similar. Let me read that. Nail it well on how to forecast similar line items. Let's balance sheet items constant balance. And let's get to cash flow statement quickly and check out. Oh, you're right. You're right. Exactly what I'm coming to do. So I'm getting straight to the balance sheets. The key things, we have actually looked at them. You don't expect this to be, we will not actually expect this to done completely for every line item. Can we have one more meeting time? Oh, for now, maybe you have to plan something else another time. What I want to do is this. I want to, for these items here, I want to duplicate the sheet again. There's a reason. I don't want to follow the same approach here historically. Okay, that's okay. Now, so let me go to some of this. Okay, operating, whatever. Let me copy this thing here and go to P&L and paste it here. And then let me then let me drop it. Okay, there's a chat, some messages in a second. A session of valuation will be really helpful. Yeah, please, let's have one more meeting. Can we have one more meeting time? Oh, I've learned a lot. Thank you so much. Okay, so guys, let's just complete this, and afterwards we have that conversation. So, we are almost done with what we're doing. So let's just balance this. Now, so let's have statement of profit or loss. Let's have something like this. Statement of profit or loss. And how I want to do this is that I want to start with revenue less cost of sales, or less operating or direct operating. Let me see. Direct operating costs. In fact, it's called direct network operating costs. Operating costs. Then you get gross profit. Then we less, there's an item called other incomes in the historical period. Other income. Then less these direct blah, blah, blah. Then here you less operating costs, operating expenses. Less operating expenses. And afterwards, you get operating profit. What I'm preparing is much more concise compared to what was reported on the forecast financial statement. So yeah, finance costs and all that. Okay, so let me do something here quickly. This is actually EBITDA. Then we less depreciation. Okay, so since they separated it, let's also just separate it. Less amortization. And then we have operating profits, less finance costs. So finance costs, and add interest income. Interest income. So we have profit before tax and profit after tax. Okay. Now, so let's do that quickly. So revenue, we can go straight to the operating assumptions and pick that from there. So these are revenue. So we can drag everything. Other incomes, we can go to other income, we can just come here and pick it for the historical period. Then direct operating costs, we go to operating assumptions and get direct operating costs. So this is the direct operating cost, direct network operating cost. Then from here, we get gross profits. Get gross profits from here. We group this properly. Then from here, we go to less operating costs, less operating expenses. So operating expenses, we go to this side and then pick up this from operating expenses. Then when we do that calculation, we take out operating expenses from gross profit, we get an EBITDA because this operating expenses doesn't have depreciation. So from here, depreciation, we move to depreciation and we can find that under Capex. That's why we summarize it nicely. Depreciation, I'll pick, I'll add, okay, so for historical period, I have depreciation here, which have been added already, and I will say depreciation amortization here, but going forward, there's another way I'm going to handle it. Operating profits is then the sum of EBITDA and depreciation. We have that here. So at least for now, let's try to drag just to satisfy ourselves of what is going on. Okay. Because we don't have other income for the forecast period. Now, so EBITDA can go, but then we need to now bring the depreciation. The depreciation for the forecast period, we can find that by adding PPU and this PPU and ROU, which is the right of use asset. Then amortization can be found by taking that of this, the intangibles. Oh, what am I picking? Found by taking this intangible. In fact, there should be a negative sign by it. Let me put that quickly. Then when we come here to, should be a negative sign, but with bracket so that the negative multiplies to. Now, so based on this, we can drag up to this point. And then operating profits, we can also have this dragged or true. Then finance cost. Let me check some comments here. It is good you've abridged the line items P&L. We can do same in balance sheet and cash flow. So that other income be part of it? No, yeah, but we have not determined that. I think after obtaining gross profit, we are to add other incomes. Or as per how they have arranged this, that's what I've done, something like that. Yeah, we can do it like that. We can do that as well. I agree. I agree with you. Some water. Okay, so finance costs or whatever, what we need to do, I think in the historical, they have some finance cost items in the historical. They have that up to this point, and finance income as well. So let me just change this to finance income. Finance income. So we go to the historical and pick that as well. Finance income. We get this. So we can drag this to this point. And let me just go ahead and this is supposed to be tax, right? Corporate tax. Corporate, let me see, corporate tax. And before profit after tax. Good. Corporate tax before profit after tax. Now, so we going to pick this and add that together, and that gives us the profit before tax, right? Now, so what we do is that for the finance cost, what we do is that we need to go and pick up some summation or sum up some few things in the finance. So with 2024, we have some loans. So we go there in the funding. We look for 2024 interest on loan. So 2024 cumulative interest accrued by, so that is row 58. Row 58, I think I'm picking the right thing. Yeah, row 58. We don't need to sum up anything because we are picking the cumulative for the first time, row 58. So we put negative by 8. Now, for the second year, it's supposed to be, the second year is supposed to be the same row 58, no. So the second year, which is 2025, by then, they must have finished paying by May. So is the interest accrued, the last one, minus the previous one paid. In fact, the previous one paid was row 52. So row 52 rather, minus this one. So that the total interest paid should be, I don't think this figure is correct. I don't think this figure is correct. Let me check again. I doubt this is correct. Row 58. Row 58. No, it's supposed, yeah, row 50. It's supposed to be row 58 minus that. Okay. So I'll go rather and do row 58. So I have to go back to my P&L and do row 58. So it should be row 58. So that when I sum the two, it will be equal to the 60 something. Okay, good. That's fine now. Now, so we've done that. So over the forecast period, nothing. And corporate tasks, let's bring the one there in the historical period. Then we can put some simple if statement. So corporate tasks, I'm adding this and this together. And that is giving me this. Then after tax, profit will be this and this. So we just drag this. Then, now, the corporate tax for the rest. So if this, oh, sorry, if this is greater than zero, then it should be 35%. I think 35, right? 30%. Because 25% plus 5% left, so that's 30%. So we have 30% multiplied by this. Otherwise, it's zero. So I'm just trying to put in if statement that if profit is zero or below zero, that's negative profit, which is net loss. Don't calculate any tax on that. Calculate tax only when profit is positive. That's the meaning of the if statement I've just put in there. Okay. Okay. So let me format this properly. And that summarizes our P&L. That summarizes our P&L. So we go to customs, more than this here and this here. Perfecto. All right, so we have a profit and all those things calculated. Then we come here to and do the same so that we have our things well done. Okay, guys, our P&L is ready for inspection by who it may concern. Then we quickly look at our balance sheet as well. So maybe let me just duplicate the balance sheets. Or in other words, let me just get the various items I need. Let me get all of them, the list of the items here. Or copy them. Let me copy them entirely, rather. Let me copy them. So total assets and liability. And go and paste here. Let me paste here instead. Okay. Okay. So this is what I have. Copy and paste. It's something, balance sheet will take a minute of 30. That's if you are doing magic. A minimum of 30 if you are doing, oh no, come on. It won't take. Let's see if we can do magic. Today is the last day, so better is the end of a thing than the beginning thereof. So let's look at this and get it done. All right, so statements of financial position. Okay, so let me close some these things just to align things better. Let me close this side as well. Close this side as well. So we have total assets and summation of all these give you the assets value. Okay, so over the forecast period. Okay. Then we have the current assets. Let me delete this. A summation of all these. All these sum together. Then the total asset being the summation of that. And then we have equity and liability. The summation of all this. Then we have other assets, blah, 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 blah. Then someone said Command Shift Auto Sum. Command Shift T. Great. Today, someone has taught me my nightmare. I've never taken time to actually look for. Thank you very much. Thank you very much, Kelvin. Thank you. Command Shift T. All right. So total liabilities and assets. Okay. Wow. We have our balance sheet here now. So we need to make some edits quickly to see if we can do the magic that is expected of us. But currently, is the balance sheet in balance? That's the first thing you must always do. Check if the balance sheet is in balance, right? This is not in balance because of the cash. So we go to the cash flow statement and go and pick the cash. At least for now, let's copy the historical cash balance and paste there for now. When we have the cash flow statement, we can better link it. So balance sheet, so we paste the cash, then and everything should be fine. So paste special space values. Yeah, the balance sheet is in balance. So we can now start our work. Now, are we done with PPE? Yes. So we go and pick it up. So PPE value 6432, we go to Capex and pick the net book value for PPE. We pick it here. Then we pick the net book value for ROU. We have it here. We pick it. Then we finally pick that for intangible assets. Of course, if I knew, I should have just dragged. We have that. For the financial assets, we keep it at the balance sheet level. For contract assets, we keep it at balance sheet level. For deferred tax asset, I don't even need to look left or right or center. I pick it up. Balance sheet level, I'm fine. We drag that. We have the total assets. Since we start doing some magic. Okay, so total asset is there. Inventory, we have it in the working capital. Where do we have working capital? We have our inventory calculated. And that is this. We pick it up for inventory. We have this. We take trade and other receivables. We go there as well. We pick trade and other receivable as well. Then we move and look out for financial assets. We keeping it at their level, balance sheet level. Income tax for the purpose of time, we keep at balance sheet level. Sustainability levy for purpose of time, balance sheet level. Mobile money float is going to be growing. So we go to the same working capital. We have the mobile money float for 2024. We pick it up. Then cash and cash equivalent, let's leave that for now because that's going to come from cash flow statement when we prepare the cash flow statement now. So we drag whatsoever we've done now to this. This is what we have. Next, stated capital. Let's go. We pick it from funding. We've done that already. So we go to 2024. We pick it. Then we look for other reserves. We go to funding. We've done that already. So we pick it up. Next time we go to retained earnings. Again, funding is where we go. We pick it there. We press enter. We pick it up with the total. We drag through to the end to get to the promised land. Now, non-current liability, the borrowings. So from here, we reclassify the current liability, the borrowing, as part of the non-current liability, if you recall. So what I'm going to do is that I'm going to go to funding, and I'll be looking for the closing balance at the end of 2024. And the closing balance at the end of 2024 is the balance, this 68. We pick it. Then deferred tax, we keep it at historical balance. Then lease liability, we have a new balance for that. Even though we've not amortized the lease, we have a new balance for 2024. We pick it up. Then we move to provisions. Who cares about that? We keep it at 2020, the balance sheet level. Other liability, we keep them at balance sheet level. Projects. From here, we move to the end. Now, we move to current liabilities. Trade payables, we go to working capital. We pick that trade payables here in working capital. Then we drag it. Now, we move to provisions. Provisions, who cares to protect that, at least for now? Borrowings, we have already moved that to non-current, so we don't even need to project it. Obligations to mobile money, electronic, whatever, we have that. So we go to working capital. We have forecasted that, and that is consistent with the current asset side. So in fact, the impact on cash flow statement is nil. Good. So what did I just, I think I've started to make silly mistakes. G39. G39. Oh, I went to pick this. Instead of picking, I went to pick the percentage for me. Okay. Yeah, so this should be entirely zero. Okay. Now, other liability, we keep it at historical level. Then we just drag. So look at the total here. It seems we are doing the magic, right? And the difference, by all means, will be from cash. A cash flow statement is as terrible as anything you can find in the world. It's all because of those huge provisions we're doing for Capex and all that. Subsequent borrowings linked up, it's wrong. Oh, really? Why? Why do you think it's wrong? With the finance cost, can you use, say, the 2023 actual finance cost and divide it by the average of the total loans to get a percentage? No, that's not a proper thing. Always, you have to revert to, always get to the loan documentation. It's a better thing. Yeah, margin has happened, Stephen. I told you the margin will happen. Okay, because it could be take 5 hours to do each line item in balance sheet. Yeah, I get it. Phyllis, what you said that subsequent borrowings link up, it's wrong. Year-end figures. Oh, really? Let me see, because did I? Oops. Okay. Yeah. How could I do this? Let me check something here. In fact, the borrowing was fully settled in 2025. So all this period is zero. Yes, thank you. In fact, when I was dragging it, I dragged the borrowing too, which was a wrong thing to do. I dragged it because the borrowing was the fully settled. That's if MTN doesn't plan on taking any new loan. Okay, thank you. Let's look at the last thing, cash flow statement to fulfill all righteousness. All right. I'm not going to go through all these things that they are doing here. I have no reason to go through all these definitions. So what I'm going to do is that I'm going to have a more concise cash flow statement. So let me just take my headers and I'm good to go. just my headers. And I'm cool to go. My headers, I'm fine, I'm cool to go. Okay. All right, so statement of cash flow. Statement of cash flow. So I'm going to divide this as cash flow, cash from operating activities. Then I'll have then here I'll start with EBITDA because I've already determined EBITDA. Then I'll less net net movement or net investment in working capital. Then when I do that, I'll get operating cash flow. Then when I get operating cash flow from here, I'm going to get, I'll less my finance cost paid, or you can just say interest paid, and then less tax paid. And that will give me net cash flow from operations, or cash from operations. Now, then from there, I'll go to investing cash flow or investing activities. The company also involved in investing activity. And here I'll get acquisition or purchase of PPE. I'll get purchase of PPE, and the second part is I will get disposal of PPE. Then should it just be PPE? I should just say Capex, right? Capex and say PPE and intangibles. That should be a better thing to say. Then disposal of assets. Then the next one, I think they have some financial instrument or something. Yeah. Yeah, exactly. So proceeds from disposal of PPE. Then purchase of intangible assets. Okay, maybe we can separate the purchase of securities, investment in integrity capital. Okay, investment in integrity capital and purchase of securities. Like, in fact, let me just take this thing. In fact, why not just taking everything there? They also appear irrelevant. Okay. Okay, so we put everything here. Then we have net cash from investing. Then I move forward to look at the final side, which is financing activities. Financing activity, someone said the Capex can be projected together or individually. Well, it depends on how they want to do, but then here I projected PP together, right? I did revenue to historical Capex ratio, and that was what I used as basis for the projection. Okay. Financial activities. Okay, so here, and so I can go back, I can still go back and check proceeds from borrowing, repayment of borrowing, payment of stamp duty for scrip dividend, and principal element of lease payments. Okay, so let's see that. Now let's link things to see. So historically, let me even see, things are not aligned properly historically. So it's going to be even difficult for me to do those analysis. So you see that what I'm going to do for the cash flow statement will be to rather focus on just the forecast period. So I'll come here to the forecast period and just ask myself, I think this last thing I have to do, changes in cash and then beginning cash balance and then ending cash balance. I forget this side. Cash balance. Now, so beginning cash balance for 2024 will be that of 2023, ending cash balance for 2023. So I move to the FS and I look for 2023 cash balance, and then I have this. I pick it up. That'll be the beginning. Now, so let me start the forecast period, how it looks like. So I can take off this historical period. That will waste my time because the cash flow statement for the historical period wasn't aligned, has not been aligned in this particular form. So EBITDA, we start with that. So I go to P&L, I pick the EBITDA calculated for that period. I go to working capital to calculate the investment required in working capital, which is this. Guys, do you recall that changes in net working capital? That is it. That's what to pick. Then when you sum up the two, you get this. Then you got to get its drag. So you get its drag accordingly. And this is the operating cash flow. Interest paid, go to the funding sheet and look for the interest paid here. For the first year, which is row 58, the interest paid is this amount. Then the interest paid for the following year is the interest paid, or the last interest paid, minus the interest paid here, the previous year. Of course, this cumulative figure. So if you subtract it, you get the difference. Now, so that's all you need for that particular period. For the tax paid, you go to the P&L account and pick the corporate tax for 2024. Then for net cash from operations, you do this. You subtract that from it, and this is what you get. Okay. Now, getting this, we get to investing activities. You are moving really cool. Investing activities for purchase of PPE, we go to Capex and depreciation. So PPE, purchase of PPE, that's the Capex here, we have it. So it must be negative. PPE alone is almost consuming all the money. There's no disposal. Purchase of intangible, we go to the same Capex. Then intangibles, we have that here. By the time you realize intangible and Capex have consumed all the money for MTN as per our projections. So then purchase, no, I'm putting something wrongly. What I just do, I was trying to put purchase of lease into the cash flow statement. That's the biggest error of all time. So that doesn't work out. So the rest actually, I don't need them. Purchase of securities, we are not purchasing any security. So I can actually delete it. Disposal, we are not disposing of anything. I can delete it. Then net cash from investing activities. In fact, investment in integrity capital, we don't need it. So at the end of the day, we just calculate the net cash from this activity. So we do that and drag it. Now, next item, proceeds from borrowings. They are not doing any borrowing. No borrowing. There's something in the chart. Let me see. You just showed us a day in the life of a financial modeler. It's not easy, man. Steven. Our WC our working capital increased in 2024. So on the working capital sheet, cash flow sheet, is a change not supposed to be reflected as a negative figure? It has increased? Really? Really? No, I'll get back to that. But then let's just complete this. Repayment of borrowing. We go back to same place for funding. Repayment of borrowing. So we're looking for the principal paid, and rule 52 will give us that information, the total principal that was paid in 2024. Then the formula sheet does what kind of error is this? So rule 58. Okay. Then in 2025, the borrowing repaid, the principal borrowing repaid was this minus what was initially paid, 58. Okay. No stamp duty on scrip dividend, and scrip dividend is when you use shares to pay dividend, right? So that may trigger stamp duty. Principal elements of lease payment. No, we are also assuming that there's no lease payment, right? So when we do that, we have net financing cash flow. Net financing cash flow. So that will be the sum of all these things here. Let's see, all these items here. Okay. So from there, let's balance a cash flow statement. So this is the opening. These are the changes in cash and cash equivalent, which is this. If it doesn't balance, we look for the difference. We give it out as assignments. so we have this. Oh, come on, it has to balance. No. So with this here, we have a closing, and beginning is the ending from the previous period. So this is very funny. So we have this here. This may not be correct. As to what may cause it not to be correct. No. I think there's an issue with the cash flow statement. I believe there's an issue with the cash flow statement. Let me just check something quickly. Yes, just a moment. Just trying something to see. Just trying something to see. Yeah. Okay, so just try to organize this properly so I can check where the problems are. Check where the problems are. Okay. Let me organize this quickly. See where the problems are. All right, so 3 million from here. So actually, if I take my huge working capital side, but then the figures I'm seeing here are quite huge. They are not normal figures. That's what I'm having problem with it. They are not normal figures. They are too huge to be considered here. Someone is saying something. You can share the difference among us. I can share the difference among you. Everybody should take something. No. This may just be one error somewhere, which we can figure out easily. Okay, so this is smooth growth, so there wouldn't be a problem here with the P&L. Coming to the balance sheets, let me analyze that so that I can also see the growth, how smooth the growth is in the elements making up the balance sheet. Okay. So the balance sheet difference is just what we have in here. 39, 35. Difference is very small. And the growth in the key elements of the balance sheet. You see, the cash flow statement, if we put the values there, it will throw everything out of gear. I don't want to even put it there to start with. It appears to me like there's a significant problem. I will have to check. To climax everything, we would like to hear about events after the modeling period. Yes, you're going to hear events after the modeling period. for now, let me resolve this funny issue with what we built. Look at the cash and cash equivalents. The growth, this is giving difference of okay, cash and cash equivalent. Okay, if you look at the cash, 18 to 8 to 11 to 50 to 21, 28, 38, 51, 67, 89, 115. Oh, I think I've done that. No, the balance sheet I've done that. I was thinking I've not linked something very important, which I believe I did. Oh, nobody told me this. So let's go to funding. We didn't link earnings after tax. Oops. So P&L. Now there's a problem. There's a bigger problem. Earnings after tax have not been linked. What kind of error is that? Earnings after tax have not been linked. So let's do that quickly and see. Okay. Let's go back to our balance sheet. Okay. Now let's go and put the cash there. Then we see what else. What again haven't we linked? That if I analyze my error rate, the way the error is going, there's something that have not been properly linked somewhere. So dividend, oh, come on. So at the end of the dividend will be a contra, will negative stuff because it's not in the cash flow statement as well. So it will impact. Now look at written earnings needs to be linked to balance sheet. We've done that. Oh, okay. Somebody actually put it there. Cut else. Let me see if there's any. Let's check the PP acquisition to see if the lease items have not been included. Written earnings. Okay, so let's check the PP acquisition to see if the lease items have not been included. Okay, so let's check. Just I believe they have not been included, but then let's still check again. PP acquisition. So we go to cash flow statement. PP acquisition. E11177. Then we have E173, E177, and E173. How? E177 and E173. No, there's something going on wrongly. E177 and E173. How? Balancing can take a no. There's a fundamental error here. How could I go and pick net book value and place it in cash flow statement? When I was going to pick the Capex, I mistakenly pick it from the net book value. Let's correct that error first. So the PP one is 177, ROE one is 178. So thank you very much for throwing my attention to that side. I wanted to deny, but then something said go. I wanted to deny to say, oh, it's been done. Then I just heard something say, oh, no, 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 just try it. You may never know, you know. Let's now look at the balance sheet. Okay, so you see things are looking nicer now. There's something growing over time, bloating out over time. And if we calculate this minus this, I don't expect this to happen to me, given that I was thinking that I was actually doing, let me see the other suggestions. This will get interesting. Written earnings needs to be linked to, oh, that balancing can take a full day. Let's forget. Oh, Stephen, balancing can take a full day. We should forget. I've never seen this guy. No, it's not going to take a full day. It's not going to take a full day. Just like I mistakenly linked something. Something could also be mistakenly linked. I'm going to try some things to see. And I'll be able to balance it. So you just watch what I'm going to do. It gets about 50 here, meaning there's an additional 10 million here. Okay. 10 million here, additional 10 million. This doesn't catch 10 million. Additional 10 million here. Additional 10 million, additional 10 million here. Cash looks like an area where a lot of those matters will be hidden. There's an item here, deferred liability. Okay. Lease liability. The question is if I've taken the right thing to the lease liability. So this for funding, F87. Let me just go there again. Funding F87. I want to balance this before I leave here. So this is coming from G178. G178. Let's check what is G178. Your E178. E178, right of use. So which one have I placed in the cash flow statement some moments ago? E178. No, there's still a mistake in what I did. Capex is for intangible supposed to be E179. Intangible, E179, not 178. Okay. Now let's see the balance sheet. Let's go into the previous position. E179. Okay, so this is what I'm going to do. I'll sum up the total for these two and reconcile. So this plus this, no. This plus this, just to reconcile, to see if that's truly equals. Yeah, it does. And what it can never be the loan side. Borrowing, no. So the loan side can never be. This shouldn't be something that should turn a problem. Of course, the task has been properly picked. PLG22, PLG22. Tasks have been properly picked. PLG22. That's been picked properly. So there shouldn't be any cause for concern. Choose a block and use goal seek. Oh, no, it won't work. Check the equity side. Okay, someone asked me to check equity side again. Let me go. Now, anything anybody tells me, because of the pressure on which I am to get this thing done, I'll go and do because I want to get my work done. Equity side again. Okay, so what I should rather do at the equity side is that I'll take profit and I'll be adding from here to see whether it will give me the same. the profit in the previous this thing. I'll get a profit here, and I'll be adding the profit to see whether it will be giving me the figure I expect. Otherwise, I cancel that side to that. No, the problem is not from reaching earnings. So now the question is, where else? Now let me go to the P&L and just check whether my additions are right. If my additions are right, then that solves that side too. And here, they appear to be very right. Let me calculate the sum of my depreciation. This plus this, depreciation and amortization. Okay. So the finance cost, the reason why I don't really want to even go there is that the loan got paid the second year, but the difference persists, so it can be that area. Let me take the amortization and depreciation here. Depreciation and amortization. That is correct. So it can be depreciation and amortization. It can be. All you know, there's one thing there. Scenario says it will take another 1 hour minute. Dashboard will take 2 hours. Okay, so we are not, so we won't do that today. We'll find another time to do that. Okay, so we just want to help. Julius have done so well. Really appreciate it. Thank you. Okay, just want to do another reconciliation on asset. Now I know it's not borrowing, it's not equity. So I want to check asset to see whether it's asset. Guys, just be with me. Some of these things are very important for you to look at. So what I want to do is that I'll take the Capex. I'll bring the total Capex here and total depreciation here and check out something. So total Capex is Capex for 2024. Total Capex is this. This is a total Capex, and total depreciation for the same period is this. So we have Capex, total Capex, we have total depreciation. So if I take total of the assets that we looked at the movement in as well, and I know that this is a total Capex plus the original as an existing asset, and I subtract the total depreciation, I should get this figure. Let me see whether if I add the asset, I'll get that figure in 2020, this thing. If I add this plus this plus this, will I get this figure? There's a problem. Let me check again. So I brought total Capex for, let me try again, because I believe this is a potential, this is an area for problem, and we can resolve it from here. The total for Capex in 2024 for all the assets we observed movement is this. And the total for the depreciation and amortization for all the assets as well is this. So I know that if that is the case, then if I add all the assets in 2023, all the assets that saw a movement, and I take the assets plus the Capex minus the depreciation, I should be able to arrive at a net book value equal this balance. But what I have is this. And let me check whether this is consistent with the net book value. The net book value that I got here is exactly the 12 point something million. So where is it what I'm having? So the question is, where from this net book value of 11 million? So I have to check. So E717, E171. Let me check. So that's supposed to be for PPE. E171. What is it picking? It's picked the right figure for PPE. The second side is to check. This one is E178 for ROU. There's going to be a problem. E178. See what I went to pick. So that's where my problem all started from. Because of course, sometimes you are in a hurry, you want to quickly pick up things, you ended up picking something like this. So it's supposed to be this ROU. So you're supposed to be picking this. I want to pick something else. And this one, intangible, is also picking a wrong thing. Oh my goodness. So when fully picked, the two is supposed to be the same, but then there's some kind of small error. I believe that has to do with some approximation error or something. I'm not really much interested in that for now. My interest is how I get my thing balanced. Okay, so guys, do you see where the final error is? Are we making progress? Are we making progress? Those who are running away, look and see what's going to happen. Julia has done so. I really appreciate it. It's actually coming from the other line item that simplified. Intangible assets, consistent with the really, thank you guys. Working in a cover. Did we capture the movement between 2023 and 2024? Now, all those things have been done. Now, we are making progress. Where the problem is now is just in 2024 and 2025. There's a problem. And if there's a problem, it has to do with the debt, because it was only the debt we repaid 2025 and 2026, or 2024 and 2025. Let me see this side. This minus this is what? This amount. This amount is looking familiar. And it's this. What is this? Provisions. Oh, we didn't drag the provisions. We didn't drag the provisions. We left it out. We were keeping it constant. We left it out. It's a problem associated with just sometimes dragging things. The last one, we are making it. We are making significant progress, guys. 120,000, let's divide by 2 and see. 6262. 120,000, where could that be coming from? And that is in only 2024. So it must be an item, perhaps, that have not been dragged as well. I won't allow that to keep me from balancing this. I must balance it. I must get it. I must get it. So 120,000. Oops, I think someone is putting something in the chat. Let's see. PP difference. Oh, okay. Okay. Yes. There's something going on somewhere. Let's see. PP difference. This minus this is equal to 120. Wow. Let's see where that PP difference is actually coming from. Why are we having that PP difference? That's where the problem is now. Why are we having a PP difference? Now, to start with, let me get the opening balances that I use in the PP work for 2023. So 2023 PP work. Opening balance for net book value. On the net book value I use are this. So we have this, which is consistent with what we have. And then the second one, we have the next item, we have this, which is not consistent with this. The third one, we have this, which is also not consistent. I don't know why they are not consistent. Yeah, but then we should be able, let me just check that, because the problem is just the beginning. So we got this 11,551 correctly. If you can confirm those figures for me. 11,551 and net book value. This is what I did, which I believe is correct. 6432, that one is correct. Then when we come to the second side here, we did this net book value 1605. And on the balance sheet, we are having, okay, so 1605. Let me pick that quickly. Then compared to what is on the balance sheet, 1605. And on the balance sheet, we are having 14 something. You see that 120 there? You see that 120. Now, let's look at the last one, intangible. Intangible, 1369. Okay, 1369559. 1369559. Correct. So the problem is with ROU. The balancing for ROU is what the problem is. So let's check the opening balance for ROU and the closing balance for ROU. Perhaps we've used the company rather than the group. That could be the problem. So that's the only source of the problem. You see, so this is coming from data gathering state. If you gather the wrong data, you're in trouble. So let me get into the financial statement and see. So it's supposed to be for 2023. I'm just checking up something here, guys. 2023 is supposed to be 16. It's supposed to be 14,84549. Then I did this. And my question is, how did I get to this answer that I got to? Let me go to the Capex and check what I did for the Capex. So for the Capex under the ROU has really created so much problem for me today. Oh, my days. My days. I use the carrying amount rather in place of the accumulated depreciation. No, I think there's more of a bigger problem because the way they presented their accumulated depreciation wasn't proper. So when you see the carrying amount, you may think it's for accumulated depreciation rather than it was for the other side. Okay, so all right, so it's 10. Just a moment, let me do this quickly. It is actually, oh, I see. Oh, I see. So the closing balance is actually 1605 here, 074. 1605074. And then the depreciation for the period was 104044. Yes, I'm doing something in 2022 first. 044 plus 1501 030. Good. So this is the depreciation. So in fact, this was actually the total depreciation. They didn't make any distinction between opening balance or whatever, and that's created a whole confusion, right? So I'm taking off this opening balance here just to put the depreciation itself here. So when we come here, the ending depreciation was provided, and the ending depreciation was actually 1019 or 1019 480. 1019 480 minus this beginning depreciation. So that gives this. So if you copy this and repaste, paste special, you want to paste only values and take off the minus sign here, then you're able to get the depreciation for, oh, it was actually, I was actually transposing, it's just a transposition error here. So I'd rather put this here. There's too much pressure. Then put this here. So this rather result in this. So let's just say this is the depreciation for this period rather. And this is a closing balance depreciation for 2022. In fact, this closing balance depreciation it's not like this is the total depreciation for 2022. So then here, the depreciation just a moment for 2022. Okay. So 104,510 is for 2023 depreciation. But then there was an opening depreciation. Let me just have that calculated here now. Good. So we have 77 plus something that gives a 10 actually. 1096,96844. Okay. 1096,844. Good. And from here, some additions were made to that. And that increased the depreciation to 16,050,74. Then we subtract this one from it. So this is the total depreciation for this for the year. Okay. Okay, 074. Okay, good. 14. Okay. Now it's perfect now. So if you go to the balance sheet, we should be fine. Good. Set it. Get to the balance sheet. We should be fine. So it was just a data issue. It was just a data issue. But I want to check one last thing before we call it a day. So going back to this, because I've changed the methods on depreciation, the depreciation rate is going to increase significantly. You see, so we can base it on just the last year. Yeah, we've done that. But because that figure wasn't a total depreciation for 2022, it just happened to be that they've not presented their case properly. So we are done. Sometimes it's good to be having those errors there and there. Help you to just go through this test properly. If not for time, we would have gone to return analysis and earnings. The earnings side, I wanted to use Monte Carlo simulation to project the normal distribution or the distribution of, I'm not going to do it, trust me, the distribution of earnings in let's say in the next 10 years, in the next 15 years, in the next 20 years, how the capital earnings, or maybe we can look at the EBITDA, the distribution of EBITDA in some next year, and you can calculate, for example, we can calculate the 75th percentile, or maybe calculate this distribution, or calculate the EBITDA at 75% confidence, 80% confidence, 90% confidence, and you can do some plots, histogram plots, apply normal distribution, and used to do some nice things like earnings at risk analysis and all that for a company, and a whole lot of things I wanted to do. But then, given that time hasn't allowed us to get into this detail, the valuation I'm going to do, or KPMG is going to organize, that is a paid version, right? We're going to be doing those earning analysis, not just earning analysis. We are going to get into valuation of companies with contingent cash flows, application of real options, right, to valuation. We're going to get into all that. So it was a great time with you. Let me see real size. Oh my goodness. PP, if we use this no be cookathon or singathon, this is modeling tone. Today, Stephen just want to. Stephen, let's connect. Stephen actually has assigned a class for today, and Asombroso, just amazing. Uche, thank you very much. Great exercise, scholar. The live workings really helps. Yeah, sometimes it's good for it to be like that. Stephen, I said you are a big man. Stephen, Julius is good. You made it. Tenacity. Thank you very much. Let's connect on LinkedIn or we can present to the board now. Not yet. Okay, let me say this. How we develop is just an introductory model. This model have to be refined. You recall when we're going through this for the last 2 weeks, I was telling you that these things, you build a base case model and then adjustments are made to the base case model depending on what you think the future is going to hold. A lot of adjustment you have to go back to the assumptions, refine the assumptions. Some things are going faster than you think they should be growing. You got to refine all those assumptions. So this is the base case model we built. This is the reason why this can take you 2, 3, 4, 5, 10 days to just build a model. It's not the initial model that is the point. You can use a day to build an initial model and use a week to validate the model. You see, and we made it. Oh, thank you guys. Kudos. Kudos. And thank you, Julius and the society. Paid lecturers do not even make time to lecture into details. I appreciate it. Thank you. Thanks for your guidance and expertise in advanced modeling. Your ability to break down complex concepts into understandable pieces has been incredible. Thanks, Julius. So, well, great comments there. I'll be happy to have some of these comments on LinkedIn as well. Maybe if you can tag me on LinkedIn and also hashtag CFA Society Ghana. If you guys can do that on LinkedIn, so you make comments on LinkedIn, you hashtag CFA Society Ghana. At least for you can mention me in comment. You can mention the CFA Society in the comment, and that will be quite helpful. And also follow the society page. And not only that, also you can also like the society YouTube page, CFA Society Ghana. And thanks for your guidance and expertise. Well done. Hi, Julius. Can we state contact? Why not? So on LinkedIn, contact me on LinkedIn. Thank you so much, Julius. Then we are already connected. Oh, I see. I'll check it out. And it was a great time. Thank you, CFA Society Ghana. Thanks so much. Thanks, Julius, for everything. Thank you too. Thank you all. You well done. Incredible. Thank you very much. A lot of lessons to learn. I gave up on CFA, but I'm resuming today. Resume with fire. Julius, I've sent a request. Good. I'll honor that. I'll connect. And as I mentioned, it will be very important for us, for you to put those messages on LinkedIn and get us tagged and get myself tagged, get a CFA Society Ghana tagged, and also. So let's always, nobody should leave. Equia will be coming to give the closing remarks. Please do well to share the Excel doc. Yes, will be shared. I have sent Julius a request. I'll respond to that. Amen, come. So I have a colleague here who worked with me in KPMG and at KPMG. So you can follow him as well. His name is Ebenezer Boatin, one of the brightest brains, of course, you think about. So just say hi to, he has been helping me putting together all this. So talk.
All right. It was a pleasure working backstage for Julius and the rest of the team. Good to connect you to all. All right.
Great, thank you. His name is Ebenezer Boatin, so you can connect with him on LinkedIn as well. Thank you all. So Equia, all right, great. Equia, I think it's time for you.
Yes, I am here. Hi, Julius.
Yeah. Great.
Hi, everybody. And thank you so much for sticking it with us today. It's been a very engaging, fun, and, exciting session. First of all, Julius, we are so appreciative of your time and sharing your wealth of, knowledge and expertise with us. That was very nice. And for everybody on the call, we hope that it has been very informative. As Julius said, every slide and the workbook will be shared. I will do a full compilation of all the 3 days and I will share them with you after this session. But it would come with a survey. So your suggestions on what the next session should be and suggestions on what other things you would like to see from the society will be deeply appreciated. So yes, enjoy the rest of your evening and then have a great week from starting on Sunday. Yeah.
All right, thank you. Bye-bye. It's a eat heavy. The banking modeling. Then we do that another time. Good. Oh wow, wonderful people. Can we get a certificate of participation? Oh, that one you can send a message to the CFA study. Thank you.
That will cost much.
Yeah.
To probably design it.